Open this hearing of the Parliamentary Joint Committee on Corporations and Financial Services into wholesale investor and wholesale client tests. I begin today by acknowledging the traditional custodians of the land on which we meet and pay my respects to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearing via teleconference and in person. These are public proceedings being streamed live via the Parliament's website, and a Hansard transcript is being made. I remind all witnesses that in giving evidence to the committee, they're protected by parliamentary privilege. It's unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as contempt. It is also a contempt to give false or misleading evidence, and witnesses also have a right to request to be heard in camera. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind any committee members and witnesses who are appearing via video conference and who are not speaking to mute their microphones. I now welcome representatives from Halo Funds Management, Wilson Asset Management, and Mr David Love from the Financial Markets Association. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. So now I will ask you for the Hansard record to please state your name and your full name and the capacity in which you appear today. We'll start, I think, with the people online. Ms Golden and Mr Manning, do you want to give us your name and title?
Good morning, everyone. My name is Lisa Golden. I'm the Managing Director of Halo Funds Management, and I'm joined by
Andrew Manning, and I'm a consultant to Halo.
Thank you very much. Mr Wilson.
Jeff Wilson, Founder and Chairman of Wilson Asset Management.
Andrew Hassett, Corporate Affairs, Wilson Asset Management.
David Love, General Counsel, the Australian Financial Markets Association.
Thank you very much. And I understand you have opening statements that you wish the committee to pay some attention to. So we might once again start with those who aren't in the room. Ms Golden or Mr Manning, do you have an opening statement?
Yes, thank you.
Ms Golden.
Halo's investment. Thank you. Halo's investment fund aims to resolve funding issues in retail pharmacy, which is a $20 billion industry and a vital component of the nation's frontline healthcare. Only pharmacists can own a pharmacy, of which a large cohort is approaching retirement and looking to sell to the next generation. The principal asset of a pharmacy is its goodwill, which makes the banks, even more than usually, conservative when assessing credit applications. Consequently, the next generation of pharmacists is struggling to bridge the gap between available finance and the market value of a pharmacy today. Our fund is both a source of capital that provides funding for young pharmacists and an opportunity for retiring pharmacists to invest in an industry they understand intimately. Increasing the income or asset threshold will prevent many of them from being able to invest where they want to. This will further frustrate the ability of young pharmacists, particularly women pharmacists, which represent 66% of the industry, to own pharmacies, refresh the industry and provide better and more efficient community healthcare services. This may lead to talented pharmacists leaving retail pharmacy to the detriment of public healthcare services. Most, perhaps all industry sectors have their own funding and investment traits, and well-intended safeguards may have unintended consequences. Income and assets do not equal investment knowledge or skills, and therefore our recommendation is to leave the thresholds as they are and explore other ways to protect the interests of people who want to invest in wholesale funds like ours.
Thank you very much, Ms Golden. Appreciate that, and we'll now go to Mr Wilson.
Yes, look, thanks very much for the opportunity to appear before you today. Can I take my sort of opening remarks as tabled?
Yes,
and then
please,
can I
and just speak to them briefly?
Just, yeah.
That's a winning performance, Mr Wilson, can I say?
I think you've already chaired the chair.
If I can ask you for one thing.
Yes.
And that's to carve out all ASX-listed companies from this legislation. And Wilson Asset Management, and that's the company I set up in 97. We manage about $5.5 billion on behalf of about 130,000 shareholders. We are classified as a wholesale investor, and we benefit from the sophisticated investor rules. So therefore, we are a major beneficiary of the current legislation. The frustrating thing is nearly 40% of Australians, the 7.7 million Australians that invest in the stock market, that aren't classified as sophisticated investors, miss out. If a company is raising capital and doing a placement, then we can participate, and that money is raised at a discount to the market, and then we can sell the next minute to the retail investor. And we, in our submission earlier this year, we did the numbers for the last 4 years. It was about $15.7 billion that they've missed out on because of that. So what I'd like you to do is change the rules so every Australian is a beneficiary. The ASX listing rules are very continuous disclosure is very strong, and similar to New Zealand, which had a legislation similar to us, and they changed it years ago to allow everyone to participate in capital raisings of listed companies if they comply with a continuous disclosure. So what I'd like is just to give everyone the opportunity broadly to level the playing field. So that's our major push.
Thank you.
Thanks.
Thank you very much, Mr. Wilson. Mr. Hassett, you're here backing up the team.
That's right.
No
No comments
statement.
from me.
Okay. And Mr. Love.
Thank you. Well, thank you very much to the committee and Chair in particular for the opportunity to present AFMA's views on the wholesale investor test that we're looking at today. AFMA, the Australian Financial Markets Association, represents the interests of over 125 participants in Australia's wholesale banking and financial markets. Our members include Australian and foreign-owned banks, securities companies, treasury corporations and traders across a wide range of markets and industry service providers. Our members are the major providers of services to Australian businesses, institutional investors and superannuation funds. The distinction between retail and wholesale clients is commonly advocated from the viewpoint of who should come under the umbrella of consumer protection. And it is assumed that the majority of presenters to this inquiry will take this perspective. AFMA's intention is to broaden thinking about the distinction between the purpose of the law in regard to retail investors and the regulation of wholesale markets and their participants. Existing definitions are complex, but are embedded and work reasonably well. Historical events impacting consumer protection were not a function of wholesale classification thresholds, with little evidence to suggest that consumer detriment would have been solved by affording customers more retail protections. We support the desire to simplify and streamline the current regime in terms of the number of tests applied for determining the wholesale client status and the regulatory source placed across multiple parts of the Corporations Act and Financial Services laws. AFMA's core message to the committee is that the issue of the wholesale investor test should not just be approached from the consumer protection standpoint. It needs to be understood that there are separate spheres of financial services regulations dividing into consumer protection and market integrity. The wholesale markets vastly dwarf the retail participation in financial markets in terms of turnover and impact on the economy as a whole. The main direct consumer participatory route is through direct investment in listed equity markets. The bulk of individual investment in the Australian financial markets is done through the intermediary route of superannuation, the funds of which are managed through collective investments in the wholesale markets. Outside of superannuation, the most common investment route is through managed investment schemes. This makes eminent sense as it allows for risk diversification for a large part of the population with only small amounts for investment. Consumer protection does not have a role in wholesale market regulation, only market integrity. The law needs to have a clear, workable delineation between these two spheres to make clear to ASIC what its role and regulatory responsibilities are. The distinction between retail and wholesale clients permeates the whole fabric of financial services regulation and consequently the way financial services industry is structured. Many business models rely on the definition in structuring their businesses, and change will bring disruption and attendant costs associated with implementing change. These impacts will not be uniform across financial services, with some businesses being much more affected than others. The main goal of proposals for reform is simplicity and clarity to establish easily understood, consistent boundary lines. Our overarching feedback is that the wholesale regime is not uniform. It is made up of a number of tests used for different purposes and seen from different lenses. Firstly, those consumers sufficiently literate to make decisions without standard consumer protection clauses, i.e. sophisticated investors. And secondly, those sufficiently wealthy to take up their own actions to protect their interests. Changing the thresholds across wholesale classifications will impact advice and product accessibility for customers and creates an increased compliance and administrative burden for member firms. We note there is a lack of demonstrated connection to specific consumer harm resulting from these thresholds, which results in a lack of clarity as to where and how threshold increases across the tests will materially uplift protection for consumers. Change to regulation should focus on simplification and alignment across all definitions of retail and small business, across all definitions of small business, consumer and retail, and providing a clearly delineated boundary in which professionals can manage their business in wholesale markets. That's the end of my prepared statement.
Wonderful.
I'm sorry I burdened you with a prepared statement.
No, it's great actually, and it's very good to have it in writing. So, you know, when people provide us with something in writing, we of course can interrogate it a little more efficiently. So we appreciate your work and the thinking that goes into preparing that. It is very important to summarise complex things into a short a summary is not an easy task, especially when there's a lot of emotion involved in some of this, because we're talking about people's lives and the outcomes of decisions that make material changes to people's lives for the better or for the worse, which is why, with the wisdom of those who've gone before us, we've ended up with this different categorisation, with an intent to protect those who have the least knowledge and are vulnerable to being the prey of other more knowledgeable people, entities and structures, and that's why we've got this retail wholesale divide. It's not malicious in design. It was probably very, affirmative of people's rights and protection in its design. Nonetheless, we're here today, and we've had an extraordinary day of evidence yesterday around these matters. I just want to ask you a question in the context of some other work that the committee has been doing, which is with regard to financial abuse. A person who you may know of by the name of Catherine Fitzpatrick is now doing a lot of work through a social enterprise around enlivening the financial services sector to the reality of financial abuse. We know that physical proximity provides a particular kind of opportunity for abuse, but as soon as there is a separation, there seems to be an escalation of the use of financial product in all its forms, alongside government agencies, to weaponise whatever tool might be at hand for people who would abuse others. I'm sure it has some place and some presence in the products that you manage, and I just want to raise your awareness about it and ask you if you could take on notice the thoughts about the risks for weaponisation of the products that you have as a tool of financial abuse. I think we're at the beginning of a journey, a thought journey about what that looks like, and Catherine Fitzpatrick's phrase is safety by design. And there is some work from the committee that you could have a look at if you were interested. There is a research base that's growing about it as well. So that's my question on notice, if I could. There has been some debate in the last 24 hours of our evidence about grandfathering. If there were to be any change, what are your thoughts about grandfathering current arrangements, or will that be too cumbersome and would there be unintended impacts from your point of view? We might start with you, Mr. Love, this time.
Firstly, to your previous point on issues around financial abuse, I'd note that the Financial Industry Council of Associations has urged its members to look carefully at how financial products might be used for malicious purposes in that sense. And it's certainly that the case, I think the industry across the board from the product provider side of things is vitally aware of now and already highly sensitised to.
That's very good to hear, Mr. Love. Thank you.
With regard to your the question, though, I think grandfathering is an issue of transitional arrangements, basically. I see that as a matter down the line. Now, if we're just looking at the wholesale definition, which in a sense, if we're just talking about that in itself, it is a negative definition. It's basically what's not retail in our space. Our industry body is arguing that there really needs to be a very clear boundary between institutional market activities and their regulation and issues regarding retail consumer protection. AFMA is completely on board with the need for retail or consumer protection. It depends which products you're looking at across the board. Our concern is with the increasing complexity of the current regime, because our submission goes to the issues relating to the fact that these days, big financial institutions have not to just worry about where the definition is between retail, wholesale and sophisticated investors, but has to worry about small business definitions in particular and consumer definitions in, for example, the ASIC Act as well. These all feed into where you put the boundary and how you onboard clients and what protections are given to them. Those protections are not debated. They're considered to be very important, and the work that ASIC does in that space is considered to be very important, and we fully support that. Where we take issue is that ASIC tends to conflate often issues of consumer protection, retail investor protection, with issues and matters when they're looking at the regulation of wholesale markets at the big end of town. So I'm talking the difference between a sophisticated investor with maybe several million, as opposed to, transactions with derivatives where people talk in, billions of dollars in yards and that sort of thing. They're completely different worlds. Mm-hmm. And so we're keen that there is actually a more full review of how the law actually delineates in what I would call institutional markets, just to get away from the word wholesale. Okay. From retail.
That's a very interesting discursive tool that you've given us there, because I don't think it's been put in those terms in the evidence that we've received so far, that sort of institutional dimension for clarification, because people do get that.
But there is already partly in the law and existing definitions of a professional investor, for example, which has presently been incorporated into reforms that are before Parliament now with regard to foreign financial service providers. So it is used in the parts of this already exist in the law. However, trying to explain all this and say, that's the clear line between the two, it's very hard because you have to bring in all these other elements to explain it. And, I'll go maybe further on later on, but that's really at the heart of what the Australian Law Reform Commission was talking about in its report and recommendations, which we highly commend.
And you do push for simplification and clarity based on the fact that there is incredible confusion among market participants and regulatory bodies, and perhaps that might explain to some degree why by the end of yesterday we were sort of asking the question, what problem is this seeking to fix, and why is ASIC, why do we have the ASIC submission that we currently have, given the problems seem to be in a slightly different place, like it's a misdirection, is I think a summary of my takeaway from the evidence yesterday anyway. But I'll go to Mr Wilson for some comments around the matters that we've opened, and then I'll come to you, Ms Golden or Mr Manning.
Look, thank you, Chair. And obviously from our perspective, and we said earlier, we think the current legislation looking at ASX-listed companies is flawed. To cut out the retail investor from participating in those capital raisings. But in terms of the grandfathering, in terms of your question, to me that's sort of a worst case scenario, and in terms of the aspirational people that are trying to get ahead and have decided to invest money, by increasing the threshold, then obviously they've been cut out. So you're really giving the baby boomer or the older people
further advantage.
Yeah, another advantage. So to me, younger people these days, it's very tough out there, and you're just going to make it tough for them. If you decide to grandfather. But that's sort of the feedback on that.
Thank you. While we're talking about young people, we did get some evidence about that yesterday. I'll come back to you for a comment in a moment, just about the profile of your investors, how many young people are engaging with you, and how you're managing to allow them access to sophisticated products. Like practically, how do you manage that process? Ms. Golden.
Yes, hello. I think to echo the points largely made, grandfathering is really, it's a transitional issue. From our perspective, we are actually able to project or predict the impact of these changes. And therefore, what we can project, though, is that if there is a change, it will have a significant and almost certainly catastrophic impact on our fund. So, to grandfather or not to grandfather, I think the issue from our standpoint is that we oppose the need to change the thresholds as they exist, because it will impact the ability for, for our cohort of investors, particularly older pharmacists investing in pharmacy, in an industry that they know. The flow-on effect of that is without that investment and that capital available, we have an inability to bring young pharmacists into ownership. So these changes, we're opposed to changes, particularly, and if you are going to make a change, one around, please don't change the indexation is probably the worst thing to change. We can't predict the impact, but we know that this will almost certainly be catastrophic to our fund.
Thank you. Thank you very much. Mr. Wilson, can I just come back to you for the comment on young people, and can I ask you to speak to your second major theme in your submission around enhancing the sophisticated investor test with regard to financial literacy tests, because that was the subject to some discussion yesterday.
Yes. To me, the model. Well, first of all, one of the interesting things is the products that we manage are listed on the stock market, and so we end up having investors. But the interesting thing is our investor profiles. There's a lot more younger people. We've noticed over the last probably 5 years. Like the average age of our investor would be that 65 to 70. The baby boomer or the self-managed super fund. But there's a lot of, over the last probably 5 years, the percentage of younger investors has definitely increased. And then the question was.
Well, the financial literacy test is something that you recommend.
To me, that's right.
Yeah.
To me, and I think there's a very good model in Singapore, and it's and if you look at the Singapore model, what they have is actually a financial literacy test, and it's quite complex, because there's various carve-outs in terms of. If you work in the industry, if you've got a degree, and then you've got to do a test. If you don't do those, then you do a test. And I actually think that if you look at the Singapore model, that was another way of looking at it, because just because A, you have money, or B, you don't have money, doesn't necessarily mean you understand the risks you're taking when you're investing.
Yes. Which is why we've ended up with the definitions that we've got, I suspect, right? So we start to go around and around a little.
That's right. Yeah.
One of the discussions yesterday was the fact that there are new products that emerge, and that a moment in time declaration of what is it, the QAC, the Qualified Accountant's Certificate, is one way in which there's some sort of assessment, but we've seen an increasing use of those and the potential for their exploitation. We also had some discussion about new products coming and people perhaps doing a micro-credential on engaging with venture capital or engaging with angel investor structures, and thereby, getting a sort of qualification that would allow them to engage in a more sophisticated way with one particular product, that there's a range of options there, and that it's not necessarily a degree in a financial related area of study that would make somebody capable of undertaking the learning necessary to be successful in the financial space. So that there needs to be a number of different pathways.
I think if you look at the Singapore model, that's what they have.
Okay, well, we'll do a little bit more on that. Mr. Love, did you want to make any comment on any of those matters, and then I'll go to Senator Scarr for a series of questions?
Yeah, well, again, as an industry association that's really representing very large financial institutions and brokers and other people in this market, we are fairly agnostic on the sophisticated investor test, although certainly we were closely involved nearly 20 years ago when it was being created and put in place at that time. Whichever way you go, there will be examples of cases where people will lose money if they're a sophisticated investor, however they got access there. And when they lose money, they will complain about it, and they will look at ways to undermine the qualification of why they were allowed to be a sophisticated investor. That's just the way the world operates at the moment, and we see this time and time again. Everyone's happy while they're making money.
Until they're not happy.
Until they're not happy, and then everyone sort of oohs and ahs over what route they got into, with products that maybe are complex and all the rest of it, and on which there was a significant downside. I think whatever system you do where you bring in people into that, you're going to have that continuing problem. Now, that's a role I see for a regulator as part of its, as a role of in protecting people in that space. And so we still see that there is a role certainly for ASIC to work in that space with those people and to look at how they are entering the market and how they're accessing the market. To me, that's a different definition that's a different issue to institutional market definitions. Yeah.
So this is quite a different view from Mr. Wilson, who wants everybody to be able to take advantage of. I think you said 15.7 billion, and people are missing out on that.
It's listed companies.
The listed companies.
Yep.
Because you've already got the protection of the ASX continuous disclosure regime.
So there's a degree of protection embedded in that 15.6 that you were referring to anyway.
Correct.
Yeah.
So to me, it's bizarre that the big end of town, David's area, can make that 15.6 billion.
Yep. And other people
And the little end of town
can't. Yep. Gotcha.
To me, that's grossly unfair.
Yep.
In the name of protecting them.
Exactly. That's right.
Which makes it even more illogical.
That's right. And they own shares, and the big end of town, which we're in that end.
Yep.
We take those placements
and
we sell them to the little end of town at a high price.
Yep.
So you can buy them immediately off us, but you can't participate.
You're wanting to do yourself out of a bit of business, Mr. Wilson.
Oh, we've got 130,000 little end of town people. So that's our lifeblood.
Yep.
I think you've got to see that there's been these issues are about a big journey that we've gone on with the Corporations Act and the Financial Services, particularly Chapter 7, since it was first conceived in the late 90s. At that time, the prevailing ideology was that if you informed people and they were fully informed, they could look after their own interests. Now, that's fine for people like me and you probably, we're fairly sophisticated in that way. But I think over the last 30 years, the community has probably shifted its thinking on that, and certainly ASIC seems to have shifted its thinking on that. and there's a great encroachment of consumer protection into many areas. And I think it's understanding that shift in community thinking, what the expectations are of the community around and what the demands are on a regulator or the government for that matter when something goes wrong, and the demands there that you've got to think about in that context. Because I think the way the law was written and conceived of 30 years ago, that fundamental, I can look after my own interests as I'm fully informed.
Yes, the
the
PBS.
asymmetry of information, all that Wallace Review
proliferation.
stuff. That's the thinking the community seems to have moved on. And that's the ideological sort of problem I think we're dealing with here.
That's a very helpful insight. I've got more questions, but I'll go to Senator Scarr for a line of questions now.
Thank you, Chair, and thank you to all the witnesses for appearing. I just want to put some, before I ask some questions, I just want to put some additional context around this inquiry, perhaps, Chair, insofar as the relevant minister was looking at changing the thresholds. There's been public debate. As I understand the government's position, I don't speak for the government, but it's not likely we'll see something this term, but the issue is still on the agenda, as it were, potentially, for change in the future. So, from my perspective as a member of the committee, one of the great things about the work of this committee through this hearing is to provide a forum for all the evidence to be obtained from different sections of the community. So if a decision is made in the future to progress this reform, this is all on the record. So is that a fair statement,
Yeah, I think
Chair?
there's been a bit of political argy-bargy about it throughout the year, that's for sure.
There has been political argy-bargy about it through the year, and I've been involved in some of that, I should have admit. So I think that just gives the witnesses some context as to why I believe this inquiry is very important to get all this evidence on the record. In that context, ASIC, in paragraph 102 of their submission, has actually proposed some changes in the threshold. So I think we need to keep in mind what ASIC has actually put down on paper and proposed as we're considering these issues, namely the product value threshold test increasing from $500,000 to approximately $922,000. The net asset threshold increasing from 2.5 million to approximately 4.61 million. And the gross income threshold from 250,000 Australian to approximately 461,000. So those are the magnitudes of the changes which ASIC has proposed in their submission to this inquiry. I'd like to deal with some of the specific issues first in my questions and then go to some of the general positions. So I'll start with you, Mr Wilson, in relation to this issue of capital raising by listed public companies and the inherent unfairness in the treatment of retail shareholders as opposed to sophisticated investors. So in the context of moving the thresholds to define who is a sophisticated investor or a retail investor, the concern you have is, before we go into the specifics of placements, is that would necessarily mean there's a cohort of investors who are currently defined as sophisticated investors who would move into that retail investor category and would therefore be subject to the inherent unfairness that you've spoken about in terms of capital raisings in the listed market. Is that correct?
100% correct.
Understood. What would be useful if you could take on notice, I think it would be useful if you could provide some case studies in terms of how the capital raisings currently occur on the Australian market and how, under our existing rules, and how they occur on the New Zealand market in the context of the reform you said they introduced to provide equality of opportunity to both the big end of town and the retail investors. So we can understand, we can work through a timeline, if you like, as to how the different mechanics of capital raisings work and at what points the retail shareholders are disadvantaged. I think that would help the committee to get its head around the point that you've made in that context. You could use live examples if you want, but
It might help dispel some sort of myths about the consequence of change as well.
Exactly.
Yeah.
So, and just taking on the Chair's point in that regard, I think those myths, and I think you've, as usual, used an apt word, around speed of capital raising. I've heard underwriters, etc., say, "Well, you're increasing risk. We've got to do it this way in terms of covering risk. Speed's essential. The market can move, etc., etc." I think it would be useful if you could draw out through live examples how that's mitigated through the New Zealand system, so we can come up with a deeper understanding as to comparing the two systems, the pluses and the minuses. Would that be possible?
Definitely.
Okay, thank you.
You too, Mr. Love? Is that possible for you too? You seem to have quite a depth of knowledge in your sector.
We'd have to do some research on the New Zealand market. So.
Yeah.
Could I go to Halo then? I just want to tease out this issue with respect to your particular fund and market. And I think one of the things we're learning through this inquiry is there are so many different idiosyncratic investment models and contexts in which these definitions are used, that there is great danger of unintended consequences impacting particular business models. I'm just trying to draw a connection between how your fund operates in the context of, and if you can just walk us through perhaps how the changes in those thresholds, which I outlined at the commencement of my questions, would impact, say, that pharmacist who's looking to buy in or taking over an existing pharmacy from a pharmacist, a baby boomer pharmacist who's looking to retire. At what points would the changes in the thresholds make it more difficult for that younger pharmacist to utilise the benefits of your fund to take over that pharmacy?
Yes, thank you for the question. In terms of the other witnesses on this call, I think it's fair to say, we happily represent only the smaller end of town. Ours is a very unique fund. It is a very specific fund for community pharmacy. I mentioned earlier the changes proposed and that you've outlined will be almost certainly catastrophic for our fund. We have 38 investors in our fund, only one of which is a corporate ASX-listed investor. The rest are primarily pharmacists or industry participants, majority of them being older pharmacists who have been very successful in their pharmacy ownership journey and perhaps have sold a pharmacy and have additional equity that they're looking to invest in an industry they know and trust.
Okay, can I? Sorry to interrupt you. Sorry to interrupt you there. I'm just trying to draw out how this all works in practice. So, those retiring pharmacists are looking to invest in your fund, which then provides assistance to younger pharmacists who are looking to take over those pharmacies. Is that correct?
That's absolutely correct. So for a young pharmacist or for a young person, I think, the prospect of home ownership is scary enough, but the prospect of owning a pharmacy is probably an even more distant dream. So what we've done is created a fund utilising investment from established and experienced pharmacists to be able to deploy to the next generation of pharmacy, to be able to support them into ownership. Without that, it makes it very hard or unobtainable for them to look at ownership as an option.
Okay, and in terms of that support in ownership, is the structure that the fund takes an equity position in those pharmacies, or do you provide debt finance to the young pharmacist who's looking to take over the pharmacy? Yeah,
good question. The very simple answer is no. We do not take an ownership position. Pharmacy, through all of the legislation, means that you have to be a pharmacist to own the pharmacy, and so the equity stake has to be by a pharmacist. So we loan money by a mezzanine debt structure to young pharmacists. Where we differ from the fund is, being a managed investment scheme, we have the ability to sort of not put the pharmacy into default while they're getting on their feet, if you like. Yeah. So it's a very considered and considerate loan option for young pharmacists looking to come into ownership, where the bank would typically ask for 20 to 25% of the value of the pharmacy. The average pharmacy is upwards of $2.6 million now.
So in a way, I think it's all dawning on me now, in a way, your investors are the most sophisticated investors you could have in terms of providing debt finance to a pharmacy, aren't they? Because they're in the pharmacy industry all their life.
That's right.
That's exactly right. Yeah. And we don't know the impact of these changes on our investor database, because we don't collect this information. You know, the privacy laws and restrictions means that we don't want to keep this information if we don't have to. But looking at our investor base and potential investor bases, and echoing some of the points made earlier, our ability to raise capital with these investors becomes, almost catastrophic for us. We estimate, based on these changes, that we would be with a situation where we have to wind up the fund.
Okay, excellent. No, understood.
It's a perfect example of where a micro-credential might not fit, and where a financial qualification is an unnecessary attribute for sophisticated understanding of the product, the uniqueness of the product that's being offered there, which is relative to the current market value of the pharmacy, rather than an arbitrary number adjusted or not adjusted for inflation.
It's a beautiful for industries.
Yeah.
To support your own industry with people that have the expertise in the industry.
Yeah.
So you have this arbitrary number
that is irrelevant and
which
will
destroys an industry.
It's interesting to get that.
Yeah, that's exactly correct.
Thank you.
Okay, thank you, Ms. Golden. That was perfect. That was just the evidence we're looking for. So we've got it now. Mr. Love, I'll just take you to your opening statement, and I quote: "We note there is a lack of demonstrated connection to specific consumer harm resulting from these thresholds," and I underline resulting from these thresholds, "which results in a lack of clarity as to where and how threshold increases across the test will materially uplift protection for customers," end quote. During the course of the evidence yesterday, a number of witnesses said, well, what's the connection between what's the mischief, what's the evil, what are the changes in the threshold seeking to address? And that then led to discussion with respect to some of the examples which AFCA and ASIC have given, where they believe justify some sort of policy change. And that's where we get into, okay, well, what policy change do they actually justify? Yeah. Is it the thresholds, or should it be something else? And some of the examples given were Mayfair, also Sterling, and I'll say something about Sterling in a moment. LM, I think it was, up in my home state of Queensland. Equity Trust, I think was another one, Chair. So they gave a few examples. In relation to Sterling, the Economics Committee of the Senate actually had a deep dive inquiry into Sterling, which I was part of. So Sterling was really at the retail end, catastrophic for the investors. They lost everything, their homes, catastrophic. So Mayfair is then one of the examples which is being put forward. Some of our witnesses yesterday said, well, the issue with Mayfair was misleading and deceptive conduct. in terms of advertising, etc. That's already covered by the law. On the other hand, ASIC would say, well, yeah, but there was an extra cohort of investors who were caught, whereas if you change the thresholds, they wouldn't have been caught. How do you comment in relation to a case like Mayfair potentially being used as justification to change the thresholds?
What was in mind when writing that and saying that is, if you go back to the Hayne Royal Commission, the issues that came out there about the markets and the issues at play there, and the consumer harms that were looked at, they really had nothing to do with the way wholesale markets operate and wholesale investors were operating. It was really all about, this was the sort of biggest review and committee review of all time on this thing. These issues that come up in AFCA and all the rest of it are really very, from a definitional point of view, I'm not talking about the harm to investors, but from a definitional point of view, are very marginal sort of edge issues, and you can debate endlessly. And you quoted before the what ASIC is seeking, sort of fairly straightforward raising of thresholds, which is basically consumer price indexation since the 2001 when these thresholds were set in place. I think that's a fundamentally different issue to what we're talking about and the points we're making. We're saying that the wholesale markets and the investors have actually not done any particular harm that ASIC is sort of seeking to deal with here. That's a different issue.
But they're seeking, well, in the wholesale market, but in terms of the the investors haven't done any harm. They're seeking to protect a particular cohort from investors from harm.
We've got no problems with that, as I'm sort of saying here. We're not really debating. One of the complexities we have is there's always going to be a debate over where the grey area is. We debate a lot with ASIC about the grey area and when we're talking about wholesale market regulation. And they always bring in sophisticated investor issues, consumer protection issues into that discussion. Where I'm pushing this discussion is I'm saying you really need to look at this more broadly, because at the moment we've got people like ASIC, and I'm sure you'll hear from AFCA and other people. They're talking about marginal adjustments to the present regime. I'm saying I think there needs to be a more fundamental review of the law, broader than just what your current review is involved with, to look at this from the perspective of what, in particular, the Australian Law Reform Commission was looking at, and saying there's a lot of broken parts with Chapter 7 Financial Services Law and the way the ASIC Act interacts with the ACCC Act and all those parts of it. That's where the real problems with the law are. And as an industry association, we would like to see a clear delineation between wholesale market issues, which we can deal with, and then there are the consumer detriment issues, such as with Mayfair and other things. But there is a gap there, and we see that it's a much wider gap than just merely moving a few thresholds along and ameliorating. Because as soon as you have higher thresholds that are being promoted there, there'll be someone who'll say, well, it should have been set at 1.5 million because there was a detriment there. And I accept that. I'm not debating that there'll be people facing problems there. But where we want to see it is we're saying that once you look at this, because if you're looking at it from the point of view of what AFCA can do and all the rest of it, the definitions of small business now are just as important to the boundary line of who gets, and when they're onboarded and get consumer protection. You look at the unfair contract terms reforms that just went through, and we have to deal with ASIC on those issues. They're equally important with this, where the boundaries are all set now. It's not just about definition of retail anymore. It's about a whole plethora of definitions. There's consumer definitions in the law and quite a number of others which we refer to in our formal submission. That's where we're coming from.
And Mr. Love, one of the issues you raise is the inconsistency in those definitions across different acts and in different contexts, which just give rise to a level of unnecessary complexity. Is that one of the issues?
Yeah, well, it makes it The firms can understand it. My members are sophisticated enough and have large legal teams and others who can, and legal advice, to be able to understand the law. So we're not saying we're confused about the law.
Yeah.
What we're saying, it is absolutely operationally difficult to administer this, and from a compliance perspective, it's very easy to get tripped up on these things, if anything's slightly out. And there is now zero tolerance for any deviations. So from an operational compliance point of view, of running a big business, and if you're a big bank or someone, these are extraordinarily difficult thresholds to all deal with, because they're not all aligned. And it's not just that, it's AUSTRAC and other things are all have their own definitions floating around here that you're trying to deal with.
Okay, understood. That was very helpful. Mr. Wilson, in terms of this concept of ASIC using, say, Mayfair as a justification to make those dramatic changes to the thresholds, do you have a view with respect to that?
Yeah, I don't have a view.
Okay.
Yeah,
right.
because I sort of observe what Mayfair did from an industry participant, but that's sort of we're listed equities.
Yeah. So it's a different market.
Yeah.
Yeah. One of the paragraphs you had in your submission was, I quote this on page 1, "We request more evidence is presented as to why these changes are being proposed, and that there is careful consideration into the potential unintended consequences the changes may have on Australian retail shareholders and businesses," end quote. And then you propose the 2 regulatory changes, and those relate to what we've talked about, the wholesale investor test, how it applies to investments in ASX-listed entities, and secondly, the financial literacy test, which I think the Chair drew out in the Chair's questions. What's the evidence that you would be looking for to be presented, as you refer to in your submission, as to why the changes are being proposed? What's the sort of evidence that...
Well, I know from the area we were talking about, listed equities, I don't think they can. I don't think they'll have any evidence
to justify why the situation is as it is.
Well, why they want to change.
Oh, okay.
Yeah.
From listed and equity position. Yeah. Okay.
So what is your best guess about why a CPI index has been proffered as the fix? Where do you suspect that thinking has come from?
Well, it's like in theory, it's quite easy, isn't it? What does something grow by? Like in theory, CPI. It's to me that's everyone sort of uses that. What should I get paid? Oh, well, wage growth, or should I get CPI as an increase? And so asset growth, like in theory, if they were a bit more scientific, it should be a combination of assets, shouldn't it? Like what the average person would have as assets. Would it be property, equities? If they wanted to be a sort of a fairer assessment. Okay. If you're looking at assets at this point in time and assets 20 years later, then shouldn't you look at the growth of the assets? Not just the CPI. Yeah.
Okay, Mr. Love.
One point that was made to us by our members on this is certainly the idea that the thresholds going back to 2001 in value terms are out of date. I think that's generally accepted. But with regard to indexation, people are very cautious about any mechanisms which might seem attractive on the surface because they try to keep the law in line with inflation. Through indexation or something, are extraordinarily hard to implement in practice, because it basically means that every year your thresholds are changing. You go through in review. You have to look at all your existing cohort of customers then and review whether or not they are still within or without there as a result of that sort of change coming through. So the advocacy is that whatever thresholds that do get changed is that they're at least stable for a reasonable period, that they might need to be moved in future in time. but they don't change just every year automatically as in an indexation sort of way, because that's just very operationally highly complex for any businesses, and whoever proposed that would get a lot of feedback on that point.
The evidence before us is that there was about 2% of the population that was captured at the moment that these thresholds were established. And now that it's estimated to be, well, I think we had 11.7 profit and also 16% in the evidence that we've received of the Australian population are now captured by the prevailing definition. And there is an embedded assumption in the responses and program of proposed change that is problematic. Do you have a view about whether that is an accurate representation of the people who are now currently captured or able to operate within the wholesale space? Is it a problem? Mr. Wilson?
Just my comment on that is, my understanding is, if you look at the growth in tertiary education as a percentage, it's exactly the same percentage, I think, in terms of 20 years ago compared to now. There's about 14% more of the Australian population have tertiary educations than they did 20 years ago. So you could argue,
that's the reason for
we should stay where we were.
Because we've just caught up.
Yeah, exactly.
Okay. And it was put to us yesterday that young people, through access to internet, have access to knowledge that previously they were excluded from, previous cohorts have been excluded from engaging with, and that there is a growing degree of financial literacy that is, in a rampant growth phase.
Yeah, to me, that's one of the things I've observed, being an older person, is just the financial literacy of young people in terms of understanding markets. Whether it's obviously crypto. As a good place for them to start and understand the volatility and the risks. Things go up, can also come down, but just to understand markets and their interest in markets. And we've seen that, with our shareholder base. As I mentioned earlier, there's been a skew to younger, definitely a skew to younger investors.
Thank you. Senator Scarr?
I'll act as the devil's advocate a bit, Mr. Wilson, for you, and see if I can give you a challenging line of questions. You've handled yourself very well this morning.
No, thanks. I'll take all those on notice.
You've been watching estimates. We received a submission from the, and I was just looking at it in the context of the points you're making, the valid points about the increase in tertiary education. We received a submission from the Alternative Investment Management Association yesterday and some evidence, and they spoke about similar points you've made. But one of the other points they made was this. And they referred to failures in the managed investment scheme space. I quote, "Notwithstanding that most of the schemes associated with the above failures are registered schemes and the significance and harm caused from such failures, the failures only represent 0.3% of the total funds on offer as at September 2021, right? And then they make this point with respect to the listed space. In respect of the societal impacts of such corporate or business failures, we look at three significant failures: HIH, ABC Learning, Babcock and Brown. In March 2021, HIH, the insurer, collapsed, resulting in losses of approximately $5.3 billion to shareholders, employees and investors. ABC had more than $1.6 billion in liabilities and close to $1.7 billion owing to creditors. Babcock and Brown also collapsed in 2008 after suffering a $2.1 billion loss," end quote. So the point they're making in their submission is, okay, well, there's been some disasters in the managed investment scheme space, but there's also been some catastrophes in the listed company space, and the magnitude of those catastrophes in a way dwarfs what's happened in the managed investment scheme case. What's your comment on that, on that observation in the context of your view around continuous disclosure in the listed company space?
Well, probably the first one isn't that capitalism?
Yeah. Yeah.
In terms of, when you invest, there's no free lunch.
Yeah.
Yeah. And you're taking risk. Like when you invest equity in a business, you take risk and over time the equity market gives you about 10% return over time, but there's enormous volatility.
Yeah.
And there's sort of standard deviation. There's always the outliers. And just I think as David was saying earlier, there's always the crooks.
Yeah.
But don't create your legislation to stop those one or two, because it'll end up effectively destroying
the market.
The market,
and the opportunity for people to invest in the market.
Yes.
So
and there's been in my time in the market, there's been a lot more companies that have gone under than those ones.
Absolutely.
Well, but there's been enormous wealth created as well.
No, exactly. Yeah. And I think that's the point, isn't it? So this is sort of the issue I was looking to tease out. You can focus on the disasters, but you can't do that in isolation. You need to actually look at the performance of the market overall over a period of time, especially in the context of someone with a diversified investment portfolio. Is that correct?
That's correct.
Yeah. Okay. And the concern with any regulation in this space is the regulatory pendulum swings too hard and too far in response to a singular disaster, and therefore imposes additional costs upon businesses that are doing the right thing, and potentially denies investors an opportunity to invest in businesses that are doing the right thing. Is that correct?
That's correct. And I mean, one of the bizarre thing, I know it's sort of not that relevant to here, but when APRA came out the other day and changing the legislation, effectively removing the hybrid market from retail investors because of what happened overseas in terms of removing risk from that group of investors. To me, it's like ASIC coming out and saying, well, you shouldn't invest. We won't let anyone invest in equities because you're taking risk.
And here are some examples, 3 examples,
exactly,
which they could quote.
Exactly, that's right. So we'll close the equity market down in Australia. You can only invest in debt, or you can only invest
in government bonds.
In government, that's right. To me, it's it's crazy.
So that's actually a few witnesses yesterday referred to the issue of hybrid securities, so these are securities which are issued by, say, the top 4 banks in Australia. They're hybrid, so they're part debt, part equity, and they rank potentially beneath other securities and other debt instruments. Is that correct?
Yes, correct. Yes.
So the argument APRA has is, well, they're more risky, therefore they shouldn't be open to retail investors. But the reality, if you were to look at a hybrid security issued by CBA, for example, would you say that's less risky than many of the opportunities on the ASX at the moment?
I would.
Yeah,
that's right.
And that's where.
Yeah. To me, it's disappointing. To me, what's happening with the hybrid market in Australia. Yeah. I mean, tens of billions of dollars of investors. That opportunity is being removed over the next few years for investors to invest in those type of products.
And what were the events overseas that drove that? You mentioned some of the events overseas.
One of the banks. That's right.
Okay. Is that Credit Suisse?
Yeah,
or?
Credit Suisse,
Yeah.
that's right.
Okay.
Because, effectively, I haven't gone into detail, but what I've read is that was the logic behind it. But to me, I just think it's illogical.
Because the same retail investor who's denied the opportunity of getting, say, a Commonwealth Bank hybrid security,
yes,
now has to look for another investment opportunity.
Correct.
To get a return.
Correct, and he could be taking more risk. He could be taking significantly more risk.
They could have invested, if those companies were still around, they could have invested in those companies and lost a lot.
In theory, yeah.
In theory,
yeah.
Yeah. Yeah. So there is some illogic there.
Can I just push another angle on it? We have a very unique situation here in Australia in terms of superannuation. And people who are not sophisticated, reaching retirement age now, we've had some considerable public commentary about insufficient vehicles for people to be able to manage into the future once they reach retirement age. But we do know that there is an increasing public discussion in a range of places, not necessarily accountants' offices and perhaps not in your offices, maybe down at the local pub or on the side of the footy field, about taking a lump of money and setting up a self-managed super fund, even if that amount of money might be less than $50,000. And then people there in that circumstance are certainly not sophisticated. They are ripe for the picking for a breed of crook, as I would call it, but potentially purporting to be a business and potentially some sort of, local advisor flying under the radar. It's because of this very innovative capacity of crooks to find their way to where the honey is that we have pressure on us as public figures to provide protection into that moment, right? We are at that moment. We've got nearly $4 trillion under management in a range of forms in superannuation. We are undergoing a transfer of intergenerational wealth. We've got scammers and all kinds of people out there coming to this financial spot. We've got domestic violence situations where we've got financial abuse. That is the context, I think, in which this discussion, that is the milieu in which we're struggling with what is an appropriate point for risk, no risk. I mean, entrepreneurial spirit, risk, reward, all of that sort of stuff that you've just described, Mr. Wilson, is absolutely a part of the success of the nation. But the cohort that I've just described to you, they are also very real. And the consequences and the flow-on to communities, the social despair, the health costs, the mental illness, the suicides, the loss that is generated from a failure to actually protect people who need protection, I think is at the heart of this discussion. So I kind of want to give you, that bit, because we see that, and I'll never forget door knocking on a Saturday morning of a man who lost everything from Trio. And I remember clearly him saying to me, all I wanted to do after my lifetime of work was to be able to take my family on a Friday night for a dinner at the Davistown RSL. Right? And all gone. So that's the context. So as we struggle with what we need to do without gumming up the system, ASIC and AFCA are getting cases that are materially representing assault of people. So how do we get to some sort of sweet spot here, taking on board all the knowledge that you're bringing to the committee?
Well, and when you're making those comments, what comes through my mind initially is just the importance of education, isn't it? You're giving those real life examples, and I know when people say to me, "Oh, look, hey, there's an opportunity to invest in this. I'm going to get a 15% return," then you immediately know, hey, there's something wrong. Because if it's too good to be true, it is too good to be true. And how do you help those people? To me, it isn't the answer education.
Yeah, but I was a teacher, and let me tell you, you can provide the education, but not everybody receives it, right?
Yeah, good
There's
point.
so much going on, right? There's so much going on in
probably
people's
one of your
lives.
students that didn't receive it.
You know, and people who could be profoundly skilled and very successful in their business, you know, running a particular kind of business that perhaps in the construction industry, that's not necessarily a transferable skill to financial.
Well, and it's like, you know, like with
It
Lisa's,
can be, but it might not be.
yeah, Lisa's area, pharmaceutical. That's why, to me, what an incredible model it is, where you've got experts in that industry helping other younger people in that industry.
So, in the absence of education having the impact that both you and I might desire, Mr. Wilson, this is the space, I think, into which we're peering.
Yes, and the tough thing is, I think, what David's point is, it's actually, to me, it's brilliant that we're having this discussion and this is on the table, because, you know, we've been sort of trying to make a noise for, since the legislation came in, about how unfair it is for, the small investor in the Australian market. But unfortunately, I think where David's point was, it is a bigger. To me, your question is significantly bigger than this. The inquiry, and I think, David, you put that point out too, haven't you?
Yes, you know, a lot of the submissions and that are just talking about moving the thresholds and fiddling really with the current system. I think the real question is, and again, it goes back to what the ALRC does, and I really do commend their work to the government in particular, to look at that and accept those recommendations to do a more thoroughgoing review of the particularly Chapter 7 laws there. Because one of the problems, once you start pulling one string on all this, and this divide line, it is like the Gordian knot. You start to, it has all sorts of ramifications throughout the system. And a lot of the reasons why we've got so much complexity now is that a well-motivated Parliament has sort of accreted laws one on top of the other to create this very complex situation. Now, the motivations are totally commendable when they're looked at in and of themselves, but once you put layer upon layer of this, it's making it very difficult for big banks and others to run their businesses efficiently and fairly. I think everyone totally agrees with the points you're making around, you know, what happens to people with superannuation who suddenly get $600,000 in their hands. I agree. You know, that's a public policy issue that has to be carefully looked at. I know the super funds in particular are doing a lot of work in this area.
Yes.
But it's never going to be perfect, and I'm afraid, yes, we might see unfortunate situations, and I know ASIC and AFCA are very concerned about these areas. But at the same time, we can't make the system so gummed up and so hard to work. But again, I go back to my more fundamental point. We would like to see the law, an overall review of the law in Chapter 7, and I think about how the components fit together. Because, as I say, Chapter 7 is built and was drafted on two fundamental pillars. One is retail investor protection. We use the word consumer now, but that's been brought in through Consumer Credit and the ASIC Act. But also market integrity. And market integrity is about what happens in markets in regard to wholesale sort of activities. And these are things like market manipulation, insider trading, all those sort of big picture sort of issues were absolutely fundamental there. That keeps the system as a whole healthy, and that applies to everybody. There's no question about that. But we've got this sphere, and we've got to work out how we can allow ASIC more flexibly to deal with consumer protection issues, I think more flexibly than what the current law actually allows for there. Because you've got these tensions that are coming out here. There's people, you know, as I say, with a sophisticated audience here, you know, we'd feel that we could look after ourselves and our economic interests. But I certainly agree that there are a lot of people, and the research keeps showing they do not have the understanding or the level of education that's there. And as I said before, often, even when people do have a level of good understanding, when they lose money, they look for all sorts of means to query why they were led into that investment there.
Yes.
You know, and
yes.
We won't question the motives of what they're doing there, but
yes.
you know, we see that too.
Yes, absolutely. And you know, Small businesses never fail because of the people who are running them. I mean, it's always something else. That's when we know the reality is much more complex than that. And investors never fail because of their bad decisions. It's always another reason, or and this is part of our human nature. We want to absolve ourselves of responsibility for the suffering we inflict on ourselves and others, right? So that's part of the human condition. Yesterday, we heard that the DDO is a game changer. Has that potentially taken some of the risk out of this sector? And given your comments about somebody getting $600,000 on, retirement, is it now a case that we should actually carve out a person's home from any consideration of sophistication, that just becomes their security blanket that's never calculated in any sort of estimation of wholesale?
As AFMA, we've got no view on that. We're leaving that to other people to make the advocacy around that. But
DDO?
It's legitimate, yeah. With DDO, it's very useful. It's a complex system to implement. I know from all the work that members do on that. I think we've got two sets of things, though, here. It's the quality of what products get actually put out, which is about having good quality products. It's like good quality cars, things that don't fall apart and all the rest of it, do what you expect them to do. That's what people expect of financial products. But on the other hand, the issues that you were touching on, Senator, about why people get into bad investments because basically they're pressure sold, is a financial advice issue. And that's been done with the quality of advice work, and I know very much the work that Treasury is currently doing for the government in that area. So that's the other part of the equation, regulating how people are, people tend not to buy bad things on their own account. It's often because there was hard selling in that state, and that's an advice issue as opposed to a product issue.
And it's got nothing to do with thresholds and limits on wholesale investors.
Well, it's quite, I mean, I think there's a whole area about where that is. As I said, I go back to, we would like to see at least a very clear delineation around sort of wholesale market or institutional market regulation as well.
Thank you.
And I'll take that on notice, but I know Jesse Hamilton, our CFO, who couldn't make it today, may have a strong view on that, but I'll take that on notice.
Thank you.
Thanks.
Senator Scarr.
Mr. Love, I just want to tease out this small business complexity, and I went back and reread your submission. It is quite extraordinary. I wasn't aware. You've got small business definition of small business under the AFCA rules. Yep. You've got a definition under the ASIC Act. You've got a different definition under the you've got a number of definitions under the ASIC Act. You've got a different definition under the Competition and Consumer Act, under the Corporations Act, the Australian Small Business and Family Enterprise Ombudsman Act, the Fair Work Act, which is totally different from the previous legislation I referred to, Payment Times Report Act, and then you've got the Banking Code of Practice. It's an absolute. I was thinking of an elegant term, and I only thought of dog's breakfast in terms of all the differences, isn't it?
Well, there's even more definitions coming about, because I was dealing with my colleague who deals with tax issues, and I'm not across the full details of it, but we were actually discussing which definition and to refer the the government to for the purposes of the ATO in connection with a very particular technical matter, but I'm not across that, so I won't speak to it.
Was that has the Australian Law Reform Commission, as part of its processes, looked at those discrepancies, in particular with respect to the definition of small business and the compliance burden it places on industries such as yours to apply different definitions in different contexts?
I certainly put in a submission to the several submissions I put into the ALRC when they were reviewing financial services law to alert them to the fact. Their job was not to look at substantive law. Their job was to look at the form of the law. I would like to see processes taken forward to actually look at the substance of the law as well, in any forward-going process that comes out of the ALRC. So that was a limitation on their work.
Yeah. And then there was one example you gave in your submission that stood out to me as falling within this realm of, in the spirit of trying to protect people, we're actually preventing them from availing of an opportunity to manage their own risk. And that was in the context of financial products such as derivatives. This is paragraph 9 on page 12 of your submission. Financial products such as derivatives are used to manage risk, FX, foreign exchange risk, interest rate risks, commodity price risks by small businesses, and are captured under the wholesale threshold tests. Existing product design may render small businesses unable to retain access to products, e.g. forward exchange contracts, to manage market risks and remain globally competitive. Product access also includes access to professional advice on risk management to support this, end quote. So if you're a small business and you're importing products and you're trying to manage your risk of fluctuations in global exchange rates, you can actually be positively disadvantaged under the existing regime from accessing products that will enable you to do that, to better mitigate risks of fluctuations in foreign exchange. Is that correct?
It's technically, I mean, these could be offered to clients, small business clients, but you have to understand the mindset now of financial institutions, major banks and everyone else, that anything that goes wrong is a huge reputational, not only a compliance risk for them, but it also is a huge reputational risk for them as well. So they are very, very conservative. They are, I can assure you that banks these days are basically very risk adverse for very logical reasons, because they get very, ASIC will come down on them very hard. And if it's in the retail small business case, AFCA invariably sides with any losses that occur there. So that makes them very, very conservative about to whom they offer more sophisticated services with regard to risk management. And I use the word risk management very advisedly, because that's what drives and is the logic behind here, because it's usually associated with trade finance. Then you do FX derivatives or something there to sort of manage the cross-currency risks that occur in those type of situations. So it tends to, as I said, there's something like a small business definition coming in where you've got AFCA and all that, able to review what's happening in that space, means that they've got to be there. I'm not saying they're just, you have to run your business on the basis of the level of risk it presents to your business for a range of reasons.
But I guess the point I'm making, the current regime, the current definition of small business can actually act as an impediment to those businesses which fall within that definition.
On the other hand,
either practically or legally, from accessing products and services that could actually be of assistance to them. Is that correct?
Yes, but I don't want to be inferring that I don't think small business should not have protection. It's again all about where the boundaries lie on this and the nature of the risks and that have been dealt with. Small business, quite rightly, people are thinking of it, but part of our difficulty with this, and I certainly encountered it earlier in the year with the unfair contract terms reviews, we found that that definition intruded very much into the wholesale market space. Because of the way the definitions sort of work there. There's a number of layers on it, but 100 employees and the turnover tests and that sort of thing. That meant it was affecting wholesale market activities of special purpose vehicles in the market, who might have one or no employees, they're just sort of shell companies and that sort of thing, who technically have no turnover because they're just machines. So these definitions intrude in different ways, and we had to get the law couldn't be amended, but ASIC was able to deal with the problem in a particular way through a no action position. But those are examples of complexity.
Why couldn't the law be amended?
Because it takes a long time to get anything through Parliament, I think, as you would very well know at the moment.
The senator's from Queensland. I mean, I think he's for unicameral situations.
True.
But that's not our reality.
I'm totally neutral on that, but parliamentary processes and the weight of stuff in the government is considerable.
True.
Yeah.
True. No, I understand that. And then in section E of your submission, you list a number of other matters, other concerns under that heading of any potential adjustments to proposals to change. The first one's a control test. So there's this quirk, if I can put it that way, that you can have an ancillary fund that's below the threshold, so it fails to meet the thresholds and fail the test because it has an independent director on the board, and therefore it's deemed it's not deemed wholesale, even though all the members involved may be individual wholesales themselves, which just seems again absurd. Is that?
Yes, I'm relying on...
That's the position under the existing law, is it?
Yeah, that's the
so
existing
it would
law.
be exacerbated if you moved the thresholds. There'd be a larger cohort of ancillary funds that would potentially fall under that concern, correct?
This is the sort of thing that comes out when you talk to members about doing a submission like this. You know, they give you a set of examples and you say, oh, that's interesting. I didn't know that. That's another thing that has to be teased out. But it just shows you the many layers of this, and as soon as you start moving things around, it takes quite a long time to work out what all the implications are.
No, that's very useful. Thank you. Chair, I'm happy to leave it there. We're due for a break, but I found the evidence in the submissions really useful, and I think, from my perspective, I think the witnesses for taking the questions I put on notice, taking them on notice, that's very helpful.
Thank you. I think we've got 1 minute, so I want to just ask a question about the international definitions, because you talk about international alignment. We've had a range of different proposals put to us. You put quite a detailed description of what's going on in each of the different jurisdictions. Yesterday we asked individuals, and we've asked you to think about the New Zealand model. So this is probably a question on notice. Yesterday we asked individuals who raised the international context and the competition across international boundaries for capital and capital raising for innovation and ideas here in Australia about why there seems to be quite a deal of activity with regard to wholesale investor test thresholds and responses to risk. It's happening in the EU, it's happening in England. Clearly, internationally, something's going on. And we were wondering I was wondering if you have any insights into why this is a topic of conversation, not just in Australia right now, but in other places. Got anything to offer us, Mr. Love?
Well, Chair, I think you already described it. You said it's a very complex, exactly the types of examples you pulled up of people with pensions, superannuation, savings, depending. Our system's more extreme because you can actually take out large amounts, but please don't change that because that would affect me.
This is what we face, Mr.
Love.
This is what we face.
But it's exactly...
$1 million of self-interest.
But it's exactly that sort. I think a lot of jurisdictions, they're all facing the same type of problems, and their legislatures are all grappling, and policymakers are all grappling with trying to find the sweet spot in there. And I think, unfortunately, there's no sweet spot. There's always, I'm sure ASIC will always come up, with examples of where things are not, that someone's losing out, or Africa someone's losing out. But it's, what works, for 99% is hopefully what we're getting to. We'll never get to, it's very hard to get to 100% on any solution here. But again, I just go back to the fact is that I think the number of different regimes and examples you've got there is why I think we need a more thoroughgoing review of this than rather than just fiddling around with thresholds and looking at it as a micro issue. I think it is about how Chapter 7 works, and that's you're the committee responsible for that, and that's why I commend to you.
Yeah, and Chair, happy to take it on notice. I think you've already articulated beautifully, what's happening in Australia and also, globally in terms of wealth transfer, literacy, et cetera, et cetera. So, to me, it's a combination of all those things.
Yes. Well, I wonder how they created the Gordian knot before somebody started to try and undo it. We're going to have to think about that. Thank you very much for your evidence today, and the committee will suspend and return at 10:15. We'll resume. I now welcome Mr. Chris Taylor from the Australian Banking Association. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Thank you, Chair. Chris Taylor, Chief of Policy of the Australian Banking Association.
Thank you. And thank you for providing us a written copy of your opening statement, but I'll give you the opportunity to put it on the record now.
Thank you. Well, thank you very much for the opportunity to appear today. The wholesale investor and wholesale client tests play an important role in regulating financial services. They mark the divide between wholesale and retail investors and the regulations and protections that apply to each. Given that more than 20 years has elapsed since the thresholds were first set, we believe some adjustments should be considered to reflect changes in underlying economic conditions. Our main goal in this is to ensure that people have fair access to financial services while keeping strong consumer protections in place. Firstly, we would suggest revisiting the net asset test. The current $2.5 million threshold, which was set in 2001, is outdated due to rising house prices. We recommend either keeping the threshold but potentially excluding the value of a primary residence, or raising it to $3.5 million to reflect these underlying increases. Secondly, the gross income test is still mostly in line with international standards, but we would encourage the committee to review it regularly to make sure it stays relevant to current economic conditions. We would also suggest that this review presents an opportunity to simplify and align tests across different products to make the process easier and more efficient for everyone to understand. Lastly, any changes to these tests should involve grandfathering provisions to avoid disruptions for current clients and financial institutions. And as suggested by your terms of reference, we would submit that any changes should be further considered as part of a formal Treasury consultation process to ensure it would operate as intended and without adverse consequences. And with that, I'm very happy to take your questions. Thank you.
Thank you very much, Mr. Taylor. I might go straight to you, Senator Scott.
Thank you, Chair. Can I ask, and this is a bit of a fundamental question, I guess, what is the interests of the Australian Banking Association with respect to these tests? So you provided the view, very helpfully summarised the view, but what are your interests or the interests of your members with respect to whether or not the threshold is, say, 3.5 million or 2.5 million, for example? Why do you care?
Sure. Thank you for the question, Senator. Several of our members do have private wealth businesses, so they do provide financial advice and enable clients of those businesses to access, in many cases, both retail and wholesale investment products. So that's the interest in the test. The size of those businesses is smaller now than it was 5 or 10 years ago, but still an important part of their business, and hence the interest in the submission today.
How many do you have that you represent that are in that position?
I could happily provide the further
On
details.
notice? Yeah, thank you.
Okay. So that's very helpful. So in that context, if you change the thresholds, you're changing potentially the cohort of individuals who would be classified as sophisticated investors or sophisticated clients or wholesale clients, wholesale investors, as opposed to retail. There will be less sophisticated investors, clients than there currently are. So what ramifications does that have for the private wealth business of your members?
Probably 2 points to make with that. Firstly, retail products can still be offered, so there would be no change to the availability of retail products under that business model. And secondly, we have suggested a change to one but not both of the tests. We would also suggest, as put in our submission, an appropriate grandfathering so that you weren't satisfying the test on one day and then not satisfying on another, or worse, having to sell your holdings to comply with the exemptions of the test. Since 2001, when the tests were first established, roughly, this was based on ANU research, which you've mentioned previously from another submission, but in 2002, 1.9% of the population would satisfy the net assets test. By 2021, roughly 16.2% of the population would satisfy that test. In comparison, the income test, which was set at 250,000 of gross income, roughly 1.88% of the population satisfied that in FY04, and 5.47 satisfy that in FY22. So that's a 3-time increase compared to a nearly 9 times increase in asset values for houses during that time period. So that's why we do think that there is a relevant question about the role that a primary residence plays in that net asset test, and that's why we've included that as one of the options in our submission.
Okay, so just working through those points, other submissions and other witnesses have referred to the fact that looking at those differences in the percentage of the population that meets the thresholds or when they were introduced as opposed to now, you need to also consider issues such as increase in wealth of the average family, average Australian, the fact that people are more financially literate, access to information's much easier today than it perhaps was over 20 years ago through the internet. Obligations with respect to the provision of information has changed. Access to information, access to sources to verify information, etc., has also changed. And also there's a material change in the number of Australians who have university degrees, so the basic education of your average Australian has changed. To what extent do those factors, should those factors be considered when just looking at that stark comparison of percentages?
Sure. Well, I think they are relevant factors to consider. When you go back to the original explanatory memorandum when the changes were introduced in 2001, the explanation provided was that wholesale clients do not require the same level of protection as they are better informed and better able to assess risk involved in financial transactions. Now, of course, the test to measure this is somewhat arbitrary. It's based on assets or income, not necessarily the financial sophistication.
In the case of assets, an embedded assumption that you've earned that asset yourself. It's not something you've inherited by chance or, good fortune.
And this is not included in the explanatory memorandum, but one could imagine that having a greater access to resources does mean if you don't have the same level of sophistication that you have either the income or the assets to get advice and make an informed decision for an investment. So it's not a perfect proxy, but it's the proxy that was included for purposes of the legislation and the reform in 2001.
It's interesting that the submission from the ABA says, okay, increase the threshold from 2.5 to 3.5, whilst still including the family home, but don't make any change to the gross income test. So leave the gross income test at 250,000 compared to, say, ASIC's submission, which is to increase it to 461,000 a year, which would be quite a substantial increase. So is the reason for that change mainly based on looking at the differentials in percentages as to the number of Australians who earn more than 250,000 a year, or are there any other indicators? If you're earning that amount of money, then there must be some sort of level of sophistication.
There's probably 3 reasons. The first is the 3 times greater increase in house values relative to incomes during that period, in terms of the coverage based on those tests. The second is international comparisons. So the current test is roughly in line with comparable jurisdictions like the US and the UK. And thirdly, the point which you make, Senator, which is that people on higher incomes do have the ability to get professional advice that might assist them in understanding or advising them for investments that would be wholesale client related.
Okay, so at 250, whether it's 250 in 2001 or 250 now, there's sufficient fat in the budget for advice-seeking behaviour and the cost associated.
So that's the submission. We have suggested that that should be reviewed on an ongoing basis to make sure it remains appropriate, but that's the submission.
Okay, thank you. Back to you, Senator.
To what extent, in considering these tests, has the ABA considered the international comparators? So to what extent does the ABA think that these thresholds need to be internationally comparable to, say, the United Kingdom, the United States, etc.? Is that something which policymakers need to take into deep consideration?
Short answer is yes and no. You should be considering the thresholds and approaches taken in international markets, but it's also important to understand the context and the legislative regime that those requirements apply within. There has been some significant reforms that have been included that apply to the financial services sector since the legislation was introduced in 2001, and they are relevant considerations in terms of financial services licensees and licensors, financial services licenses and the licensing regime that applies to advisors. They are relevant considerations in determining where those thresholds should be set.
Yeah. So you talk about the need for if change is made, it's going to be incredibly important that there's grandfathering, and that's a consistent theme across submissions the committee's received. You then recommend implementing recommendation 11 of the Quality of Advice Review. Is that as a supplement to the other thresholds? Is it something you're recommending be done to supplement the other tests, or is it something which could be done instead of doing something else? How do you envisage that recommendation of the Quality Advice Review fit within the framework?
Yes. So the reason that we included a reference to recommendation 11 of the Quality of Advice Review, and what that recommendation suggests is that if you satisfy the wholesale client test, that you're given some form of disclosure that acknowledges that you acknowledge you are being treated as a wholesale client, explains in simple terms what the implications of that are, and may encourage you to get your own sort of financial and legal advice to consider the investment that you're making. We think that that's a good recommendation. It doesn't impose an onerous obligation on advisors in relying on the exemption, and ensures that those who might have the ability and capacity to get further advice understand how they're being treated, and are reminded that they can get that advice if they so choose.
Can I just ask a question there? Is that a document for absolution for the financial service provider, the financial advisor, that actually doesn't allow or encourage sufficient agency by the person who might seek the service, right? Like, who benefits most from that documentation, as opposed to some active proof of engagement with an education process or some qualification, micro-credential seeking task for a potential investor, who at the end of it says, I have completed this unit, I understand these terms, this means I am now going to take myself out of the protections, and I declare I desire to become a wholesale investor. But it's not just sign the form here. I've told you that you're is there sufficient agency for the person taking the financial risk in that transaction, or is it just a nice tidy off for the financial service provider?
I think there is benefit for clients in that scenario. I mean, again, it's part of the difficulty here is that the legislation is so complex. The more you can make it simple and simply understood by clients on how they're being treated, and the opportunity they have for advice, I think that's only a good thing, and I think that's one of the reasons why it was a recommendation from the review.
Yeah, and a recommendation for advice that has a cost is often the thing that would be the barrier that people might not engage. Yes, I understand, but no, I'm not going to do it. We saw a lot of that in the franchising inquiry, that many of those documents described in some evidence that were received in that inquiry were replete with a unconscionable contract terms. So sending people for advice wasn't going to even do anything, really. So I guess that's my question about where does the agency lie? Where is the true risk? Well, the risk is a reputational risk to the provider, but it's also a very substantive material risk to the investor, who might have now 600,000, if we just use a figure from previous evidence this morning, on retirement, with no sophistication, ripe for the picking for a financial advisor who has filled in the form, but then can really play with that person's future with the 600,000, where there's an incredible knowledge asymmetry.
I mean, in the example that you gave then and the one that you gave in the previous session around scams, part of the difficulty is I don't know that this is a solution to situations involving fraud. In that case, if someone who holds a financial services licence is intent on committing fraudulent activity with their clients, disclosure or a certification is not going to address that. Similarly with scams, in fact, one of the real difficulties in addressing scams is that often clients think that they're actually engaging with someone who's a reputable advisor. They are often given a prospectus which looks on its face very legitimate, provides all the disclosure, but the critical details as in where the money's being sent is to an account of a scammer rather than to a legitimate institution.
And a lot of this has been transacted digitally too, which increases the level of risk. And that echoes evidence that we received yesterday. So it's a very helpful answer, Mr Taylor. Thank you. Senator Scarr.
And the last point, I know we're near the end of our period with you, you say, further, given that banks deal with wholesale customers on an ongoing basis, we recommend consideration be given to clarifying that a bank may rely on its testing for a longer period. For example, the individual wealth test, transaction threshold test, small business test, professional investor test could benefit by making it less time consuming and costly for customers rather than applying those tests at each dealing. I just wanted to explore that reference to at each dealing. Does the bank actually go through these processes at each dealing? What do you mean by that? Or if you get a quack,
Yes.
as we call it,
Yes.
certificate, then that's recognised in the system for the period of 2 years or whatever it is? Or do you actually have to get a certificate at each dealing as a matter of internal protocol?
That process may vary from bank to bank. I think this is a more general comment, particularly if there were a broader Treasury consultation process about ensuring that regulatory and compliance burdens in ensuring customers satisfy these tests are appropriate and don't result in paperwork for paperwork's sake. And if there are indeed more efficient ways of ensuring that a customer maintains that status, that should be considered in the legislation as well.
Okay, all right. Thank you. Thank you, Chair.
And we note the limitations of the QUAC being a moment-in-time declaration as well, with a 2-year currency that may not reflect the reality one day after it's acquired, and also an increase in the number of QUACs that are being used. So I'm sure that the banks will be interested in the veracity of those QUACs. So I just sort of want to raise that and seek any evidence and advice that you can provide the committee about how frequently they're being used and the type of cohort where QUACs are being used for wholesale investors. So we'll get a sense of trends if there's anybody entering into that space.
Certainly, Senator, happy to take that on notice.
Thank you very much. Mr Taylor, can I put one on notice? We've been talking about financial abuse in this committee and in another inquiry. In the context of this inquiry, can I ask you to give any thoughts to safety by design principles that might impact this ecosystem of wholesale offerings through those banks that you indicate provide that opportunity for individuals? What are they doing to ensure that the products that they're providing are also subject to those safety by design principles that I know are obviously occupying the minds of your banking colleagues at the moment?
Absolutely.
Thank you, Mr.
Happy to take
Taylor.
that on notice as well.
Thank you.
Thank you.
I now welcome representatives of the Financial Services Council. Good morning and welcome. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Sinead Torres, Executive Director of Policy at the Financial Services Council.
Jack Morgan, Policy Director, Investments and Funds Management.
Thank you very much, Mr Morgan. Mr Torres, do you have an opening statement for the committee today?
Yes, thank you, Chair. And thank you for the opportunity to appear before the committee today to discuss the Wholesale Investor Test. The Financial Services Council is a peak body with over 100 members. Our full members represent Australia's retail and wholesale funds management businesses, superannuation funds and financial advice licensees. The FSC's membership encompasses fund managers that offer products to retail, institutional and wholesale clients. As such, many of the FSC's funds management members have practical experience dealing with the Wholesale Investor Test. We note that the consideration of the Wholesale Investor Test has been undertaken in the context of the federal government's review into the Managed Investment Scheme regulatory framework, with which the FSC has been actively engaging. The FSC also supports undertaking this inquiry to ensure the test remains relevant in today's financial landscape. Some stakeholders to the Managed Investment Scheme review submitted that the existing criteria, primarily based on financial thresholds, may no longer adequately reflect an investor's sophistication or ability to understand complex financial products. We consider that the Wholesale Investor Test mostly remains fit for purpose, but in our submission, we do acknowledge that there is a case for updating the net asset test threshold. Our recommendations for updates to the Wholesale Investor Test are relatively modest and are as follows. With the net asset test, we recommend increasing it from $2.5 million to $5 million if that includes the family home, or maintaining it at $2.5 million but excluding the family home. For the income test, we recommend maintaining the current threshold of at least $250,000. For the product value test, we recommend maintaining that threshold of at least $500,000. And finally, for the sophisticated investor limb, we recommend making it more objective by including criteria such as previous investment experience, finance sector qualifications, or business experience. Our rationale for this recommendation is that the current net asset threshold, set in 2002, now covers 11.7% of households. When first introduced in 2002, it covered 1.5% of households. It is projected to reach a quarter of all households by 2043 if unchanged. Our proposed changes aim to reduce this to around 3 to 5% of households, aligning with the original intent of the test. We also recommend grandfathering any changes to the test to prevent disruption for existing wholesale investors. While we do not support automatic periodic indexation due to costs to industry, we are open to periodic legislative reviews. We consider the Wholesale Investor Test should as much as possible reflect the financial sophistication of investors or their ability to bear risk, support the growth of Australia's financial markets, and provide a source of venture capital and startup investment. The FSC believes that a well-calibrated Wholesale Investor Test is crucial for maintaining a balanced regulatory environment that protects investors while promoting market efficiency and innovation. We consider that instead of a more comprehensive overhaul, this is best achieved through modest updates. Thank you, and we are very happy to take any questions from the committee.
Thank you very much, Mr Torres. I've asked, I think, pretty well all witnesses to take a question on notice in light of the committee's inquiry into financial abuse. While we're talking about this in very specific and very technical terms, which is needed, the lens of where does financial abuse fit within the range of tools here and the current structures and what might happen needs, I think, some consideration. So can I just ask you to take that on notice? Where are the financial abuse risks embedded in perhaps even the current structures or any proposed changes?
Yeah, happy to take that on notice, Chair. I guess one thing that comes to mind, and we would need to do a bit more thinking on this, but I imagine that the illiquidity that comes with a lot of wholesale investments could be a factor if you had, an abusive relationship and potentially the victim wasn't able to take their money out because of the illiquidity of that investment. So that's something that immediately springs to mind, but happy to do a bit more thinking there.
Yes, and yesterday we did have some reference to housing, I think, from our representatives of the angel investor sector, sort of embedded assumptions that the woman will get the house in a separation. And if that were to be carved out, which is a proposal that you're proffering, either or, that would be a very bad thing for women who got an asset but then were unable to leverage that asset to be able to continue to invest in their personal wealth growth for themselves and their family post-separation. But is that actually the case? When banks get involved at a point of separation, we know that a whole lot of products are weaponised, but also that there is often a sale of the home, and then there's a whole different situation in terms of liquidity, perhaps a lot and perhaps zero, which is kind of the range of what we've received in that. So if you can think about, there's so many complex intersections with other financial parts of people's lives that are connected with this. Families stay together, they're jointly responsible, everything's perfect, the family home can be included. It just doesn't meet the reality, right? So design perhaps in 2002 and design for the current kinship family relationships of 2024 might need some further thinking in terms of abuse dimensions. So that's the rationale for asking that question on notice. Hopefully that helps with whatever you might undertake there. Okay.
Understood. Happy to do that.
So embedded in the recommendations that you've proffered here for net asset thresholds is the same assumption that seems to be embedded in the ASIC submission to this committee, that there needs to be some sort of CPI indexation, albeit with limits going forward, to have legislative review rather than ongoing annual indexation of some form. Is it really a problem that we have such an increase in the number of people who are considered wholesale investors? 3 to 5% originally the design of the original piece of ledge, now 11.7 based on that. We've heard also 2 to 16%. So it's in that ballpark. Is that a problem, and does it really need this kind of a resolution, and is that tool sufficient and satisfactory?
Yeah, it's a good question, Chair, and I guess our recommendation comes in the context of the wider review that was undertaken by the government into the managed investment scheme regime. And in that review, I guess the underlying purpose of it was to see whether the managed investment scheme regulatory regime remained fit for purpose, primarily for the purposes of consumer protection. Our, I guess, overarching contention in that review is that it does largely remain fit for purpose, particularly because of legislative reforms that occurred, after the introduction of the wholesale investor test, particularly things like the design and distribution obligations and ASIC's product intervention powers. But what we said was that we can see a case for a modest change to the wholesale investor test. We're not calling for a complete overhaul. I think our view is that if you were looking at making tweaks to update the regulatory regime as a whole, the asset test and the wholesale investor test could be a place you could look for the purposes of, I guess, regulatory hygiene. Just an updating of it, given the changes in economic circumstances and the number of consumers or households that now fall under the threshold. So we're not wedded to this number, to be clear, but it's something that we thought that there's a decent case to be made that that aspect of the test could be updated. But we've also said that the rest of the test actually remains pretty fit for purpose. And the other thing that I'd note in response to your question is that these defined thresholds are a blunt instrument in terms of designating financial sophistication and the ability to bear risk. It's important to recognise there probably is a correlation between wealth and financial sophistication, but that's not always neat. But there's also the ability to bear risk. So if you have greater assets, you're able to bear losses that are of higher risk when it comes to some wholesale investments. And you're also able to bear, I guess, the liquidity risks as well, because you've got enough, you don't need sort of quick cash flow. You're able to park your money there for a while. So those numeric thresholds, they are a blunt instrument, but they do serve a purpose. They're also being objective easier for financial services firms to apply. But it's important to note that the wholesale investor test does include this sophisticated investor limit as well, which is there to recognise that these numeric thresholds are a blunt instrument, and so you do need another threshold to recognise that financial sophistication or the ability to bear risk may not always, in all individual circumstances, be correlated to, say, your income or your assets.
So then we're in the realm of the subjective dimensions of that, with some technical support that seems to be the quack. So the qualified accounting certification, I think, is, we've been calling it the quack. Well, I certainly have been.
No, if it's caught, it's catching.
So do you have any insights, because this sophisticated investor test as a part of the wholesale investor moves us into a slightly different realm. So let's sort of dig in there. And have you got any data about the use by financial planners of these quacks? Is it on the increase?
Yeah, we don't have any empirical data on that, but what we've heard when speaking to our members is that when they're accepting wholesale investors into their wholesale investments, it's much easier for them to use the objective criteria that's in the test. So, very easy to get very easy to get an accountant to sign off.
Bright lines, isn't it?
Yeah.
Bright lines.
That's right. It's very easy to get an accountant to sign off that the client, has $2.5 million in assets or has earned $250,000 in the year. Where it is difficult to apply, and we've heard from a lot of our members that they're very hesitant to apply the sophisticated investor limb because it's so subjective. So the threshold with the sophisticated investor limb is that the entity, the licensee, has to be satisfied on reasonable grounds that the client has the requisite or previous experience to assess the merits and the risks of the wholesale investment. So because of the legal risk that bears, because it's so subjective, we've heard from members that they just don't use that. But our view is that if we want to encourage more venture capital and capital to startups, that's actually a good limb to explore, making more objective, because what we hear from at least our members is that if that was made clearer, then potentially you wouldn't need to rely on, I guess, the hard numeric thresholds. You could have more instances of people who may not meet those thresholds but can demonstrate objectively that they've got financial sophistication, whether through their education or their business experience.
Okay. And have you done any research into other jurisdictions where such, declared more objective criteria are operating, and effectively so?
We've noted in our submission that in the UK, with their equivalent of the wholesale investor test, they have this certification where that sort of objective criteria applies. So it's things like you have a degree in finance, or you've got previous business or finance experience, you've been the director of a big company, you've been a member of a network of angel investors. So I think that's a good model worthy of consideration. to have a look at and potentially adopt here, we think.
So education qualifications clearly would allow people who are in the financial service sector, who are already operating pretty much in this space anyway, but would exclude others who may be tertiary educated in psychology or, nuclear physics, with clear intellectual capacity, but not necessarily the knowledge set for being a wholesale investor or sophisticated investor. We heard yesterday that there's self-declaration in other countries. Clearly there's a lot of risk in that. We also sort of had a back and forth on what micro-credentialing for people might look like, and I noticed that you've just indicated that, angel investor participation over a period of time could be an education process, and that seems to be what's happening in that sector. Does there need to be some sort of verification of or certification of alternative paths of education that are not going to a university to get a finance degree before you can become a declared sophisticated investor?
Yeah, I think that's worthy of consideration, and I think that the underlying, policy objective would be to ensure that there's an objective way of measuring sophistication and understanding. You certainly don't want a situation where someone inherits a whole bunch of money and somehow they're induced to put their entire inheritance into a very risky scheme, and then that scheme, goes down to zero, or it experiences a few years of big losses when that investor actually needs the money. So you definitely want to ensure. And
that's going to be more possible to occur as the wealth transfer of assets is happening in the next 20 years.
Yeah, that's right. And so, I take your point that it's not just people, say, with a finance degree that can demonstrate sophistication. So it's certainly worthy of consideration to look at whether there are other objective means of demonstrating that sophistication, whether it's through micro-credentialing or experience.
And who would then be the arbiter of that, and where might such certification and attestation be held? Is that something that the Financial Services Council should be charged with, or should be another part of ASIC who will be going, we don't want to have anything to do with anything like this? Or is it, an educational entity such as ASCO who have very particular responsibilities for overseeing qualifications? Does there need to be an extension into that space? Where would this sit in the ecosystem most appropriately in your view?
Yeah, we wouldn't want to add more onerous requirements onto licensees or fund managers. And so, I suppose we'd need more detail around what exactly this regime would look like, what exactly the objective criteria would be. But, I imagine that if there were education requirements, given that provided that they were objective enough, then it would be a simple matter of just providing a copy of that credential and being satisfied that credential meant that you had a level of sophistication. But in that situation, that would certainly be more objective than what we've currently got in the law.
And I would add to that as well, Senator. I believe the committee heard yesterday that there are some existing ASIC accredited courses in other areas which are quite expensive at present. So we would be wanting to ensure accessibility to the course.
If such a system were to be established, which is currently not the case.
And ultimately, all entities need to take their own legal risk-based approach. And so at the moment, going back to the point we made before, their risk appetite is very comfortable with an objective numerical test, uncomfortable with the current sophisticated investor subjective test. But if there were more objective criteria, then potentially their risk appetite would be more favourable towards applying that test. They may choose a third party to verify it. They may themselves verify it. Just depends on their risk appetite.
Okay. The use of the quacks, which we've had by report, is increasing. could simply be a response to the risk management by financial planners to ascertain some verification of declared capacity to the current existing thresholds of the 2.5 billion or the income 250. That could be the explanation, that these are being used more frequently as financial planners are taking the responsibility to do that more seriously. The problem with quacks, though, is they are a moment in time verification that could exist on day one of an interaction. Day two, go to the financial planner, eligible. Day five, the whole financial situation could be changed, but the eligibility of the quack is for 2 years. That would give you access to products that you might be engaged with then for 5 years. So it has some significant role in this ecosystem. Do you have any concerns about the way in which the quack is being used? Or any risks with it?
It's not something that we've looked into detail, Senator. I guess when we've looked at this, we've looked at it from the perspective of fund managers who are the product issuers of wholesale investment products. And I guess from their perspective, when they are onboarding members or investors into their funds, they will seek third-party attestation that those thresholds are met. So they will seek confirmation from an accountant, get an accountant certificate that the requisite thresholds have been met.
And the requisite thresholds being met more frequently by lump sum withdrawals of superannuation is perhaps another explanation for why there could be the increase in use of quacks, but that doesn't necessarily prove that there's sufficient real knowledge of the person who now becomes eligible, but not necessarily able.
Yes, I think that's potentially true.
Okay, so could I ask you to do, provide us on notice any further insights you can into the quack and the profile of people for whom the quack is now being applied, and any intersection that has with self-managed super funds, which are a really amazing instrument for people to use to grow their wealth. But concerns from my part, from community matters, community interactions I've had, is that people with as little as 50,000 are being encouraged to put. So if you've got 400,000, 500,000, you could actually be a fantastic person to have somebody decide, well, I'll get you into a self-managed super fund. I think there's potential risk for financial abuse there, the acquisition of a partner's superannuation by somebody who can see a whole lot of benefit for them much more clearly than the person they're advising. So this asymmetry of knowledge in that space gives me great concern, and I don't think these thresholds actually deal with that problem, which again is malign intent, even if it is within the law and not fraud and not deception. So.
Yeah, that's right, Senator. And I think also when thinking about those issues of vulnerability, it's important to remember the entire financial regulatory ecosystem and all of it working together. To some extent, the wholesale investor test can't be the only solution to those issues. We're currently considering reforms to the financial advice framework, for instance, to make it more accessible. So that's an important piece in ensuring that people that have a lump sum of money and are looking to invest it actually can afford to get financial advice on complex products. We also know that there's the retirement income covenant, which requires trustees to have a strategy for their members' retirement and retirement income. And so, all the regulatory framework as a whole should hopefully be working to address those vulnerabilities.
Thank you. Senator Scarr.
Thank you.
A bit enthusiastic there, Senator Scarr.
Okay. What process did you go through in terms of coming up with your policy positions regarding changing the threshold? So In particular, I'm interested to know whether or not there was any survey done or consultation done with the millions of your members' customers and clients with respect to whether or not they wanted to see the thresholds changed. Because the consequence of changing those thresholds will be to deny hundreds of thousands of your customers opportunities they would currently have as sophisticated investors, which they will not have as retail clients. So my question to you is, what consultation or surveys did you undertake to actually obtain the views of your customers and clients with respect to any changes?
Yeah, we surveyed our funds management members, so the companies, not necessarily their members. And again, I go back to the original sort of interest that we had in this issue was in the context of the managed investment scheme review. And so there were a whole bunch of changes that were being contemplated in the managed investment scheme review. And one of them was the wholesale investor test. And so because that was in the terms of reference, we needed to have a look at the wholesale investor test and whether it continued to be fit for purpose. And so to that end, we consulted with members. And our recommendations, I think, and certainly our membership was of the view that they were fairly modest, that they would help to update the test, but our view was that, and their view was that it wouldn't overly adversely impact a lot of their investors, given that the other thresholds weren't being recommended for change. So it was really just as I sort of said before, a regulatory hygiene exercise of updating the net asset threshold, but keeping the other thresholds the same and recommending that the sophisticated investor limb be made more objective. And importantly, grandfathering existing wholesale investors as well.
But Mr. Torres, I come back to my initial question. There would be, if you change these, if the government were to change these thresholds, there will be hundreds of thousands of Australians, you've given the percentages, which is helpful, who would be impacted by the change to those thresholds. Hundreds of thousands of those Australians are customers of your members. Why wouldn't you seek their views, the people who are actually going to be impacted in terms of being denied investment opportunities, before putting forward a proposition that you should change the thresholds?
Well, ultimately, we do represent our members, and obviously our members service their clients. So, you know, we were doing our job in terms of seeking our membership's view. Okay. But I'll just make the point, I guess, that it is ultimately a policy question that government and this committee has to grapple with, which is, does it remain appropriate for someone who has assets of $2.5 million to be able to access highly risky investments?
I've got limited time, so I understand that point. But maybe I can close out this line of questioning with the question of, are you aware of any surveys, and feel free to take this on notice, are you aware of any surveys which have been done by any of your members, of their customers, of their clients, with respect to the proposed changes to the thresholds contained in your submission, or the proposals which have been mooted by ASIC, which you know includes quite a dramatic change to the gross income threshold to $461,000 a year, and to the product test to over $900,000 a year. Has there been any consultation or surveys done by your members of their clients and customers that you're aware of?
Happy to take that on notice, Senator.
Okay. Mr. Torres, you refer to this as a matter of regulatory hygiene. Now, that is the perspective of the Financial Services Council. I want to quote to you from a submission from a venture capital fund called 1013, and I've actually quoted from this fund to a number of witnesses. I quote, "A recent survey among 1013 investors indicated that should increased thresholds for net assets and net income as noted above be implemented, then 42.4% of their investors would no longer qualify as sophisticated investors, with an additional 12.1% uncertain about their future eligibility, end quote. So if you add those two numbers together, you get to 54.5% of that venture capital's funds, sophisticated investors would cease, current sophisticated investors would cease to be eligible. And the witness representing 1013 talked about the dramatic impact that would have on the viability of their business. Do you recognise, does FSC recognise that one person's regulatory hygiene could be another business's catastrophic change to its customer base and its operations?
Well, I go back to the underlying purpose of the wholesale investor test thresholds, which is to ensure that people who are able to bear the financial risk have access to those products, and people that aren't able to bear the financial risk don't have access to those products. So it's a question of...
Sorry to interrupt.
Yeah.
Understand the theory. I've got limited time and I've got a number of questions to put to you. I understand the theory, but what I'm seeking from you is a recognition that potentially it's going to be certain types of businesses that will be more dramatically impacted by such a change than other businesses. And some of those changes could be hugely dramatic, and in fact catastrophic was one of the words a previous witness who gave testimony here today referred to, could be extraordinarily dramatic and deleterious to those businesses. Does the Financial Services Council recognise that?
Senator, with respect, I think that the question is really around, it's not so much what's in the interest of the businesses we represent or those businesses that you've quoted, it's what's in the interest of the consumer. And so I don't know what the risk...
consumers your members haven't surveyed.
And so I don't know what the risk profile of that venture capital fund you've quoted is. But, you know, I do know that a lot of these investments, they're important. We want to see more capital in them, but they are risky. They are risky. Some of them have the risk of going down to zero, and we don't want to inappropriately, or we don't want to see people who can't bear that risk going into those investments.
So you're interested in terms of protecting the best interests of those investors, but the evidence you're given, though you've taken on notice, is you're not aware of any surveys having been conducted of those investors with respect to whether or not they're in favour or not in favour of these changes to the thresholds. Is that correct?
Well, ultimately, we actually do agree with the policy aim of having more capital flowing into venture capital and private equity and finding ways to make that easier. I'm not sure whether the best way to do that is to have low wholesale investor thresholds. As we've said in our submission, there are other ways of actually achieving that policy aim, which we completely agree with. You know, making the sophisticated investor limb more objective, and potentially a lot of those investors that you quoted that may be affected under a more objective, sophisticated investor limb would still be eligible to invest.
Does that cause you concern, those figures, that here's a venture capital fund that's provided support to, in the tech space, a space where, and you acknowledge the importance of accessibility to capital in relation to these sectors, and we need to be internationally competitive. But here we have a real-life example of a venture capital fund in one of those spaces that's telling us, and that I should say, and you can see their submission, it's 103, they've collectively invested approximately $98 million into 49 technology companies, right, up to today's date. And they're telling us that 42.4% of their investors would no longer qualify under the thresholds being mooted by ASIC. Should that be a cause of concern?
Can I jump in there, Senator, and just reiterate Mr Torres's point from earlier that under the FSC's proposal, grandfathering of existing wholesale investors is strongly recommended. I'd also note that according to ABS figures, recent ABS figures, 35.9% of all businesses which existed in June 2020 closed by June 2024. So that's over 1 in 3 businesses closing over a 4-year period. So this is not an area without risk.
So sorry, just to, I'll give you an opportunity to add, just what's the relevance in terms of the number of businesses that have closed to this debate?
I'm making the point that investing in businesses is potentially a high-risk proposition.
Sure, and presumably that's one of the reasons why this venture capital fund, 1013, has invested in 49 technology companies, because any venture capital fund worth its salt will apply diversification, and there's a risk-reward dynamic. Isn't that correct?
That is correct.
Yep.
And Senator, I'd just say again, we support the aim of more capital going into venture capital and private equity. And I believe you've said before, we don't want to miss out on the next Canva. We completely agree with that, but we're not sure that more capital flowing, that the aim of achieving more capital flowing to venture capital should be at the cost of investors who can't bear that risk. And so we think there are other ways to achieve that, making the sophisticated investor limb more objective. We've also said, and this is somewhat outside the terms of reference of this inquiry, but I just want to note that we've been actively advocating for the National Investment Visa Scheme and an investment component of that, because we want to see more venture capital and private equity capital flowing into the economy. So it's an area we support, and we're doing active advocacy in that space. We just don't think that the wholesale investor test is necessarily the best mechanism to encourage more capital to flow.
So if I'm a startup company and I'm at the start of my journey, do you think there's a risk if there's a misalignment between our thresholds and that of our international competitors, that I simply decide to go to the UK, the United States, because it's all come too hard in Australia? It's going to be hard to access international capital coming into Australia, because those investors are going to say it's all too hard. I don't have to invest my capital in Australia, I can invest it here, big market here. And people who are looking to invest capital in Australia, they can likewise send their capital overseas. But the entrepreneurs themselves, if we put up too many hurdles and barriers, can actually decide to leave this country and go to the UK, go to the United States, go to Singapore, and that's a real risk if we don't get this calibration correct. Do you admit that?
We don't want to see capital flight, Senator, but I think that the proposals that we've put forward are fairly modest. I don't think that they would lead to that sort of capital flight.
Well,
yet.
Let's talk about the UK. So the UK started a consultation process on this in 2021, and I've read the papers they released as part of that consultation process. They did it over a number of years. They decided to change the thresholds, and in fact, in the research paper which you've attached to your submission, you refer to those change in thresholds. The reform will change the thresholds to income of at least 170,000, Australian 310,000, net assets of at least £430,000, Australian 780,000, excluding the principal place of residence and pensions throughout the last financial year. What happened in the UK when they introduced those changes to the thresholds?
Yeah, it's an interesting point, because they did look at those thresholds, and I think they decided not to make any further changes. That's something we need to consider it in our own context.
Okay, so sorry, Mr. Torres, I need to correct the record. Yeah. They in fact did make those changes, and maybe you can read some of the other submissions, come up to speed on this. They did make the changes, and then they received an open letter from people representing, in particular, angel investors in the venture capital space, who talked to a catastrophic decline in accessing venture capital, and the government made the extraordinary, almost unprecedented, it's quite unprecedented, to reverse those changes in the next available budget, in the 2024 spring budget. So they went through a 2.5 year consultation process, decided to increase those thresholds, and then, because of the catastrophic impacts of having done that, they used the next available budget to reverse it. Shouldn't that be cause of concern for Australia, even with the most noble of intentions? And I understand the good intentions of the Financial Services Council in this regard, etc. But even with the most noble of intentions, doesn't that raise an extraordinarily large red flag that we need to be very, very, very careful before we change these thresholds, because it could have a devastating impact on businesses, start-ups seeking to raise capital in the environment where already it's difficult in Australia compared to the United Kingdom, compared to the United States and Singapore to raise capital.
Look, we think that's actually an important point, Senator. And in the analysis that we've done, it was a fairly basic analysis on looking at the threshold and the proportion of the population that it applied to. But what we have said in our submission is that a government looking at this should consider a more holistic cost-benefit analysis. Now, in the time that was given for the Managed Investment Scheme review, there wasn't enough time for us and other stakeholders potentially to do a more holistic cost-benefit analysis. But going to what you've been saying, Senator, we do think that there is merit in doing that sort of more holistic cost-benefit analysis, where you would look at the effects that it would have on wholesale investors and potential wholesale investors, where you would look at the potential costs or potential losses that could be incurred in investing in wholesale versus retail products, or the potential changes in behaviour if you were to raise the thresholds. Would that lead to investors then moving to either retail products or more risky products, even beyond venture capital? So, that more holistic economic cost-benefit analysis, we agree, should be done, which I think is getting to a lot of the underlying points of the questions that you're raising, Senator. So actually support a lot of what you've said there, and we acknowledge that what we've put forward was looking at it with a sort of very simple threshold and proportion of the population analysis, but we recognise that there's a lot of merit in doing something a bit more holistic.
Okay, so in terms of the analysis that you've undertaken, which was very useful, I found it useful, you didn't really delve into the, if I can call it, the behavioural aspects of how changing these thresholds, what it could lead to in terms of the behaviour of potential investors and how that could impact on things, for example, like the startup tech industry, which is what the Venture Capital Fund 1013 invests in. You didn't go to that extent of analysis.
That's right, and we've noted that in our submission, that's something that a government considering this, should do as a next step. As I said before, we put this in the context of the Managed Investment Scheme review, where among many potential regulatory changes, this was one of them that was being considered. But we think that there is a lot of merit in doing a cost-benefit analysis.
Mr. Torres, I take that point you make about the Managed Investment Scheme review. I've read it. This was one of the paragraphs of many paragraphs, which was one of the reasons I think it's a good thing this committee's looking at this as a bespoke issue. I also think it's a good thing we're looking at this as a bespoke issue because some of the submissions to that Managed Investment Scheme review then sought to widen the argument to looking at the thresholds that apply with respect to investing in shares in a company as opposed to investing in a managed investment scheme. So I agree with those points. Just on that point, you do make the distinction in your submission between the application of thresholds in different contexts. Can I just give you an opportunity to explain why that's important?
Yeah, that's right. I mean, the managed investment scheme review, the terms of reference only included the wholesale investor test under Chapter 7 of the Corps Act, and didn't include that other threshold you referred to, the sophisticated investor test under Chapter 6D, which is around the issue of shares. But I think it just makes sense to us that if you were considering if anything needed to be done to the wholesale investor test, that you would consider whether anything needed to be done to that other test.
But if you're going to do that, presumably the consultation process needs to make that clear up front, as opposed to people making submissions calling for that through a consultation process which was just dedicated to managed investment schemes. Is that a fair comment?
No, I think so.
Okay.
Yeah.
And to the extent that there is further analysis, and you've talked about the need for further analysis, which I agree with. I think it's very sensible in terms of the behavioural response to any change in the thresholds. Do you also think there needs to be a process of actually trying as best as you can, and maybe your members could be part of this, ascertaining the views of people who currently fall within the category of sophisticated investors, but would fail to have that status in the event that the thresholds were changed? Do you think that needs to be an important part of the consultation process?
Yeah, good policy requires good consultation, Senator, so I certainly wouldn't be opposed to that.
Could your members actually assist potentially in that regard?
Yeah, I think so.
Okay, thank you. I'd like to ask a question, and there's been, we've gotten different views on many different things, right? So one of the things we've gotten different views on is in relation to this consent form under the quality of advice recommendation 11. So some people say, yes, this is a very good mechanism to make sure the investor acknowledges if their status is as a wholesale investor, it's a wholesale investment, that they won't have the benefit of certain protections. You get them to acknowledge that. I know FSC considers that would, and just to quote, extra consent requirements would create additional administrative burdens for responsible entities in the establishment of new internal processes and training of staff for minimal investor benefit, end quote. Can you just extrapolate on that concern?
Yeah, we didn't support extra consent requirements. Firstly, with the quality of advice review, which we do support, that recommendation was in the context of advisors, financial advisors. It was an obligation of financial advisors advising wholesale clients that they didn't have, or particular duties that applied to them advising retail clients didn't apply to them advising wholesale clients. So in the context of wholesale clients investing in a managed investment scheme, the reason that we were hesitant to provide support for consent requirements is that there need to be quite a few issues that need to be worked through. So, for instance, where's the consent required? Is it, at point of sale? Do you have to do consent with every new investment or reinvestment? There'd be a question around the consent. Is there a consent renewal period? If you miss that period, does the investor then have to withdraw their money? And so there's a whole bunch of potential compliance costs and issues that would need to be worked through there. And then the other issue we had is that if you have an intermediated distribution channel, so for fund managers, you distributed your managed investment scheme through a platform, or you distributed it through a financial advisor, where would the responsibility lie for collecting that consent? So a whole bunch of, I think, issues that would need to be worked through.
Okay. My last question, and that's very useful information. We've received submissions from a number of witnesses in relation to the impact of a change in thresholds, in particular on women, and that women would be disproportionately impacted compared to men if there was an uplift in the thresholds, more so under the uplift in the thresholds proposed by ASIC, which includes the gross income test. And I note that the Financial Services Council is not proposing a change in that regard. But some of the concerns raised are a woman may go on paid parental leave, they might be an outstanding professional who was earning high income, and then if you just use these blunt tools, as you refer to them, and I agree with that, they are blunt, then that person who was operating at a high level, sophisticated level, they might, as the Chair alluded to, they might be someone who was running their own family small business. It's myriad, their experiences. They then have a particular period in their life when they're not earning that level of income. So they might have earned $300,000 a year for 5 continuous years, and then they're exactly in the position where it might be a perfect opportunity for them to become an angel investor or make other investment decisions. They've got the bandwidth to be able to think about their family's financial future because they're not looking after other people in a professional context or a business context. Yet they're then deprived the opportunity because they fall under the gross income test for that period. Has the Financial Services Council, I know a lot of your members are passionate about providing increased opportunity to women, etc. Has the Financial Services Council looked at that dynamic in terms of the changes into these thresholds and how we could potentially amend these thresholds to make them more applicable to the lived experience of women, to make sure that they don't lose opportunities or they're not disproportionately impacted by changing the thresholds?
Yeah, it's a very good question, Senator, and I think it goes back to our recommendation around making the sophisticated investor limb more objective, because you're right, if you're a successful professional woman and you've had a lot of experience
or you've run
in
a business, a
or
small
you've run
business,
or you've run a business, you've got the requisite educational requirements, but then you take time off to care for a child. Arguably you've still got a sophisticated understanding, and so you should be able to continue to invest in wholesale investments and have those opportunities that you had before taking time off work. So I think exploring how that sophisticated investor limb can be made more objective to allow for those situations, I think is definitely worthy of consideration, whether it's an education requirement or work experience requirement. I think those sorts of aspects should definitely be considered.
Okay.
And can I just say, after the work and care inquiry, that taking time off formal work to undertake unpaid work and care is probably how we want to think about it. So it's unpaid work with an opportunity for other work that requires you to be less in attendance at a workplace, but you're still doing work.
Yes, good clarification.
And you're caring as well. So it's just these language practices that are embedded that I wanted to just take the opportunity to put that on the record, because I know that would be exactly what you think, Mr. Torres, but we use the code all the time, the old words.
No, well, we do, and
we
people,
carve out a whole lot of people.
And people take out leave paid employment or have less paid employment for a number of reasons, and taking care of parents, taking care of siblings, taking care of children, taking care of partners.
Or taking care of an episode of mental ill health.
Yep.
Well, absolutely. I mean, my wife and I are just about to have a baby, and I have no doubt that she'll be working much harder than I am.
Those cold cups of tea that you never get to finish are a lasting memory for me from that period.
We'll see what the thresholds are when your baby's 18. No, that's one of those you put a bottle in the. I don't know, but that would be an interesting test. But I'm done.
Thank you. I just want to make a couple of observations, ask a couple of questions. One is the dual submission here. There's the part that's of your hand, Mr. Torres, but there's an attachment which is also quite helpful and detailed, and it's presented in as the Financial Services Council. It's also got PwC branding. Can you explain to me the provenance of that particular document?
Yeah, that's right. During the Managed Investment Scheme review, we wanted to have a better empirical base for our recommendations around the wholesale investor test, or just providing, I guess, an empirical base for policymakers like yourself to consider when thinking about changes to the wholesale investor test. So we commissioned that research with the view of providing a bit more of an empirical base for those for those considerations. But I note, as I said before, we're not strongly wedded to these numbers. It's just they're things we've put forward for consideration in light of, I guess, bigger changes that were being considered to the regime.
So, and the timing of that, it's dated the December 2023, so you've explained the context. With regard to the changes that Senator Scarr mentioned in Britain, that happened in February, so it would be post-arrival, so this is why this might be incomplete. And your submission came in on the 17th of May and dealt with those broader issues in the Australian context, but that I think might explain that. But there's one thing that concerns me that isn't explained in the PwC created document, which is a statement with regard to 4.2 implications for fund managers, financial advisors and accountants. And it says, the impact on stakeholders in the industry is summarised below. And the first dot point is, qualified accountants are required to issue certificates stating the prospective wholesale investor meets the threshold set out in the individual wealth test. If the thresholds are changed, accountants will incur costs in implementing the threshold changes. Well, that's one way of looking at it, but accountants are required to issue certificates stating. I would absolutely question that, and I would draw your attention to the submission from the accounting bodies, CANS, CPA and IPA. Their first recommendation is to eliminate accountants' certificates, and their rationale is that the current requirements of these certificates, the quacks as I've been calling them, to verify individual compliance with wealth tests, are viewed as outdated by the accountants themselves. Perhaps that's something to do with the fact that they're a moment in time assessment with 2 years currency, which has some considerable risk embedded in that. This practice, they assert, has led to an over-reliance on these certificates, shifting the risk to accountants rather than ensuring the appropriate investor safeguards. Joint associations argued that the responsibility for determining suitability of somebody to be a wholesale investor should lie with the financial advisor and the product issuer. And this reliance on quacks, which you've described in earlier evidence and is used in the sector as an objective measure, is actually a risky objective measure, and clearly the accounting bodies are saying that they're not happy to continue in that way.
Well, legally, and correct me if I'm wrong, Jack, but I think legally, ultimately, the obligation would always lie with the AFS licensee.
Yeah.
That's right.
Yeah.
And so when they're seeking these external certificates, it's both a way of managing their risk. They're not trying to. You can't shift the legal risk, but it's just a way for them to satisfy themselves. But also so that they're not having to set up an entire front office of people, having to do these checks. They can focus on what they do, which is to manage money. And so I think it's both a regulatory compliance streamlining. It's got a regulatory compliance streamlining purpose, and also, I guess, to help them be satisfied that they're meeting their obligations.
Yeah. And another way of saying that is it's a cost shift to the accountant to do the work rather than for the financial provider who has the AFSL at risk.
I would have thought the accountants would be happy for the extra business.
It seems not. And I think it's probably to do with, I didn't know about a quack, but I think it's because it has a moment in time status with a 2-year length that might bring accountants into the purview of any oversight of where there is a collapse, right? Where, as we've heard in evidence this morning, everybody's happy when we're all making money. As soon as it hits the point where there's a failure, it's like, well, it wasn't my fault. Who do I look to? Well, I look to the product provider, the AFSL, which is why we're having this whole conversation. Where does the proper boundary protection lie in this ever-changing world that we're a part of? And can I go after my accountant because they should have known better? And I can imagine these conversations actually happening. And I'm thinking, somewhere out like Mudgee, for example, where there's limited access to a whole range of professional advice, and there could be risk for people there. there might be also embedded in that agreement by coercion of partners based on the evidence we saw in the financial abuse inquiry. So the complexity of what's going on with this, what's declared for our purposes and discussion, an objective test, I think we need to raise a few questions about how objective, how effective, and how willing the providers of that objective test are to continue the practice. So you might want to just reflect on that and give us a response with a bit of time to think. But it's an area I think that I certainly was not aware of that's come to my attention in the course of the inquiry. So thank you very much for your evidence today. And we'll welcome our next set of witnesses. Thank you, Mr. Torres. Thank you, Mr. Morgan. Yeah, I think there's a lot of quacking going on. I don't think we're at all. Do you want to hold everything else off to Thursday other than the con on the matter that you want to have attended to so that we can get the other colleagues on board, or did we just go straight away?
With the quorum. I think it'd be nice to get an answer just to that quorum before
I'm happy to go
next week. Yeah.
And then on Thursday we'll let everybody else have a look and then we will press the button. Maybe Wednesday is just have a look. Tickety-boo. Thank you.
I'll give you a sack, not a whack. Senator.
We're on again? Thank you very much.
Goodness, that table's just big enough.
And I think the reservists are in the back there as well. You never know who might be called upon. It's getting us back into that feeling for, that exciting week we called estimates. Yeah. So I welcome representatives from the Australian Information Industry, from the Tech Council, the Australian Investment Council, and from the Medical Technology Association of Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your name and the full capacity in which you appear today? We might start with you.
Praveen Siriwarden, Policy Manager, MTAA.
Thank
Matthew
you, Mr.
Versey,
Siriwarden.
Director of External Affairs and Communications at the Medical Technology Association of Australia.
Stuart Anderson, Clinical Trials and Commercialisation, MedTech Program Manager.
Thank you.
And Industry Development.
Sue Lee Sell, General Manager of Policy and Media at the Australian Information Industry Association.
And how do I address you appropriately?
First name is Sue Lee.
Yes, but so Miss Sal?
Sue Lee.
Sue Lee will do. It's like Siri, Sue Lee.
Yeah, I just tried to use your surnames, but that's okay.
Yeah.
Sue Lee, thank you.
Hello, my name is Madeline Houghton. I'm the Acting Head of Policy at the Tech Council of Australia.
Thank you.
My name's James Cameron. I'm an investment partner at Airtree Ventures, a venture capital fund and a member of the Australian Investment Council.
Hello, my name is Navleen Prasad. I'm the CEO of the Australian Investment Council.
Thank you very much. Now, I'm sure you all have an opening statement, in groups. Who's going to present? Can I just get a show of hands? So, Mr. Versey, Ms. Lee, Ms. Horton, and Ms. Prasad, and we'll go in that order. Mr. Versey first.
Well, good morning, Chair and Senator Scarr. Thank you for the opportunity to appear before you here today at this committee. My name's Matthew Versey, and I'm joined here by my colleagues Stuart and Praveen, who've already introduced themselves. And we represent the Medical Technology Association of Australia, MTAA, who itself represents more than 120 manufacturers, suppliers of medical technologies which play a vital role in diagnosing, treating, and managing disease across Australia. And we're very proud to work in such an exciting industry that each and every day changes the lives of Australians. From life-saving medical devices to the tools that enable routine diagnostics and treatment, medtech is essential to improving the health and quality of Australians. The work we do in medtech has a real impact on patient outcomes and healthcare delivery, and it's essential that we continue to foster innovation for our industry here, locally in Australia. And we appreciate the opportunity to provide evidence today in this hearing regarding the proposed changes to the wholesale investor test and its implications for the medtech industry. MTAA also recognises the importance of striking a balance between consumer protections and facilitating investment in privately held high-growth sectors such as medtech. However, we are concerned the current proposal to raise the threshold for wholesale investors will have unintended consequences that could significantly hamper investment in the medtech ecosystem, ultimately reducing Australia's capacity to commercialise world-class medical innovations. Currently, the threshold for defining the wholesale investor under the Corporations Act, as we know, has not been adjusted for over 20 years, meaning more Australians now qualify as wholesale investors. While this may raise concerns about investor protections, MTAA contends that wealth alone is an inadequate indicator of an investor's capacity to assess and manage the risks associated with private investments, especially in sectors like ours, medtech. In fact, raising the threshold would shrink the pool of active investors, limiting by as much as half the capital for early-stage medtech companies which already face challenges in accessing sufficient venture funding. As detailed in our submission, Australian venture capital investment in medtech is disproportionately skewed toward later-stage companies, leaving substantial gaps in seed and early-stage funding. The committee may find it of interest to know that of the $1.7 billion of institutional venture capital invested in health and medical technologies over the past 5 years, only 4% has gone to medtech seed stage ventures. Additionally, a significant portion of venture capital is flowing offshore, further reducing the local investment available to our Aussie innovators. It is the angel investors that help bridge the gap to later stage venture capital funding, with our analysis showing that these angel investors account for approximately $25 million worth of investment into early stage medtech ventures in Australia each year. Now, our key concern is that raising the wholesale investor thresholds will reduce access to capital at precisely the time that is needed most. Early-stage medtech ventures often require substantial upfront investment to validate their products, protect intellectual property, and conduct clinical trials. Angel investors, who are often experienced professionals in the medical technology sector, currently play a vital role in also helping bridge this funding gap. By increasing the threshold, we risk eliminating many of these investors, stifling innovation and forcing more of our companies to seek capital abroad. Committee members, in our submission, MTAA made 4 key recommendations. The first, which is to maintain the current threshold levels for wholesale investors to ensure continued access to capital for early-stage medtech companies. The second, introduce education standards for investors and certification for angel investor groups to ensure that wholesale investors are well equipped to understand and manage the risks associated with medtech investment without unnecessarily raising financial barriers to entry. Third, encourage the development of syndication networks, allowing angel investors to pool their resources and share knowledge, which supports the responsible funding of high-risk ventures such as medtech. And finally, withdraw the proposal to tax unrealised capital gains over $3 million, which could further disincentivise investment in early-stage, high-risk ventures such as medtech. We believe that wealth should not be the sole criterion for determining who qualifies as a wholesale investor. Instead, an education and syndication approach will better ensure investor protections while still allowing our Australians to invest in and benefit from the incredible potential that our medtech industry has to offer. So we urge the committee, through its deliberations, to carefully consider the broader economic impacts of revising the wholesale investor test, as I've just outlined. And MTAA and its members stand ready to work with this committee and the government to ensure a policy framework that supports rather than hinders the growth of our vital industry while still protecting investors. So thank you again for the opportunity to appear before you here today, and our team looks forward to taking your questions.
Thank you, Mr. Versey, and thank you for your submission. Ms. Sue Lee.
Thank you. Good morning as well, members of the committee. On behalf of the AIIA, I thank you for the opportunity to provide evidence on this important issue. As the peak body representing Australia's technology and innovation sector, we speak for a broad spectrum of members, including a significant cohort of small and medium-sized enterprises that are critical to our technology community. Our mission is to support a thriving digital ecosystem and create a favorable environment for Australian tech businesses. We understand the need for investor and consumer protection, but we are concerned that the proposed changes on the wholesale investor and client tests may unintentionally restrict investment opportunities for SMEs, thereby limiting the growth of the tech sector, a powerful but arguably neglected engine of growth for the Australian economy. Our key concerns lie in the proposed reform to raise the individual wealth threshold in net asset or annual income. While this may aim to adjust for inflation and rising property values, it misses a critical opportunity to assess true financial literacy and investment capability. Instead, it risks creating barriers for individuals who may be knowledgeable and sophisticated investors but do not or have not inherited wealth, business connections, or high-value properties. Our concerns can be summarized as follows. 1, the lack of rigor in the proposed reform. The proposed reform relies solely on the Consumer Price Index to adjust asset thresholds. It did not consider why these assets should be included in the first place. It did not make an argument or any further financial modeling against how this would impact our economy and competitiveness. So this approach risks excluding capable individuals who may not have access to generational health and is counterintuitive in creating equitable outcomes for Australians. 2, reduced international competitiveness. Raising the investor threshold without proper measures to access financial literacy could reduce availability of private funding for startups. This will make it harder for Australian tech companies to secure the capital they need to grow and compete globally, potentially forcing them to seek funding offshore. And then 3, increased reliance on government funding. A reduction in private sources of capital will inevitably lead to a greater reliance on government programs such as the new Industry Growth Program to fill the funding gaps. This risks distorting the market and increasing the burden on public resources. We propose 1, implement a best practice sophisticated investor test. Rather than simply raising the threshold, we urge the government to implement a sophisticated investor test that would evaluate financial literacy, such as the knowledge of risk diversification, asset classes, and interpreting financial statements. This approach is already used in the United States of America and Singapore and ensures investors qualify based on their skills and knowledge. 2, exclude the family home from assets calculation. Property values have increased significantly in recent decades, and including the family home in the asset calculation disproportionately affect those whose wealth is tied to property. Excluding the home from test would better reflect an individual's true investment capacity. And then 3, and this is very critical, this reform must be considered alongside other ongoing changes affecting the Australian tech sector. For example, the August Treasury Law Amendment Bill 2024 proposes a mandatory merger regime that could slow funding access to SMEs to scale up or simply survive. The promised $1 billion National Reconstruction Fund has yet to allocate funding to tech-enabling projects, and the May federal budget did not adequately fund critical technology such as artificial intelligence. Together, these changes create a challenging landscape for our SMEs. Taken individually, they may seem minor, but for SMEs, they represent a cumulative impact that can be described as death by 1,000 cuts. Increasing regulatory burdens, reducing access to private capital, and insufficient and delayed public support are combining to create a very challenging environment for our tech startups to grow and succeed. We urge the committee to consider these recommendations to strike a balance between investor protection and supporting the growth of the Australian tech sector. A balanced approach will foster an environment in which our SMEs can thrive, driving economic growth and creating meaningful future jobs. We are committed to working with the government to ensure that Australia remains a place where innovative tech businesses can flourish. Thank you for your time and consideration.
Thank you for your submission, Ms. Suley, and for that opening statement. Ms. Horton.
Excellent. Good morning, and thank you very much for the opportunity to provide evidence to the committee's inquiry today. The Tech Council represents over 150 tech companies across Australia's tech ecosystem and is a strong advocate of growing Australia's tech sector. Our organisation has set clear goals to reach 1.2 million tech jobs by 2030, create a $250 billion sector by 2030, and make Australia the best place in the world to start and scale a tech company. Achieving these goals will require reforms across a range of areas, with some of the most important being to unlock the private investment environment, grow the tech workforce pipeline, and ensure that regulation in Australia is fit for purpose for the digital age. Australia's tech sector has matured significantly over the last decade, which has been supported by a relatively strong economy and favourable government policy settings, which has encouraged investment into early-stage tech companies. Between 2014 and 2022, we saw an 18-fold increase in VC investment in Australia's tech sector, which has enabled more tech companies in Australia to grow and thrive. The growth of venture capital has been assisted by policy settings such as the early stage venture capital limited partnerships and early stage innovation company tax incentives, which rely on wholesale investor definitions. As a result, we have seen an acceleration in the number of startups in Australia and have demonstrated Australia's ability to scale many of these startups into globally competitive medium and larger sized firms. However, notwithstanding our successes, Australia's direct tech sector is still relatively small as a share of our economy compared to other markets such as the US, the UK and Canada. Australia is still a difficult place to start and scale a tech company. We often hear from our membership that where tech companies succeed in Australia, this is often in spite of coming from Australia and not because of it. Australia lags behind other countries in early stage funding, with less invested per capita in Australia compared to the US, Singapore, Israel, the UK and Canada. While Australia is on track to catch up to the US in early stage funding, by 2030 there will still be a significant gap in later stage funding. If Australia wants to position itself as a digital economy leader, including in emerging technologies like AI, cyber and quantum, then we need to continue improving the investment environment to drive further private investment and growth to Australia's tech ecosystem. Investment by wholesale investors into the tech ecosystem, particularly into tech startups, is vital. Without wholesale investors, or with fewer eligible investors, there would be a material impact on the Australian tech investment landscape, which in turn would have a significant impact on the number and diversity of startups that are founded in Australia. Raising the thresholds for the wholesale investor test without providing opportunities for qualification via educational or experience-based pathways means that investors are more likely to invest into liquid stock instead of R&D and early stage investment activity, which relies on this kind of early stage investment. This has significant consequences for Australia's startup ecosystem. Investment into tech offers the opportunity for significant returns for investors. Our research shows that the Australian VC and private equity over 5 years, 10 years and 20 years was higher than the ASX 300 and the ASX Small Ords over the same periods. These are investment opportunities that should be inclusive and available to a greater diversity of Australians that have the appropriate experience and capability to make these investment decisions. We now have a significant opportunity before us to not only prevent damaging changes to the wholesale investor test flowing from a blunt increase in the thresholds, but to ensure that the wholesale investor test is fit for purpose in the modern age and protects investors while encouraging investment into early stage startups. And in our submission, we make several recommendations for how this could be done, such as through an education or experience-based pathway to qualification, and making sure that there is an objective test for AFSL holders for determining who is an experienced investor. We look forward to your questions and are looking forward to answering them.
Thank you very much, Ms Horton. And Ms Broussard.
Thank you, Chair. Thank you, Senator Scarr, for the opportunity to appear before the committee and support your work. I'm the CEO of the Australian Investment Council, which is the national peak body for private capital investment. We represent investors in early stage, scale-up and growth businesses referred to as venture capital and private equity funds. These funds collectively back more than 850 businesses, mainly small and medium-sized, and are responsible for more than 600,000 full-time jobs. Appearing alongside me is James Cameron, a partner at Airtree Ventures, one of Australia's largest venture capital funds. Airtree would not be the Australian success story it is today had it not had the early support of sophisticated investors. We understand that periodic reviews are important to ensuring that regulatory settings remain fit for purpose. Our role in this policy work is to highlight the consequences of changing the settings on fund managers, startups and growth businesses who rely on the capital provided by wholesale investors. It's not possible to overemphasise the importance of wholesale investors as a source of equity capital for startups and growth businesses. In 2023, more than 10% of investors in Australian private capital funds were high net worth investors, and we expect this to increase. Businesses backed by venture capital and private equity contribute more than 3% to Australia's GDP, providing a valuable productivity boost to the economy. We are seeing an intergenerational trend of small to medium-sized business entrepreneurs who need to sell their businesses to investors as their succession plan. And successive governments have determined that Australia needs to build more and make more onshore. All of these priorities require capital, and based on current trends, institutions such as superannuation funds are becoming a smaller part of the investment mix for startups and growth businesses. This is forcing the funds that invest in these businesses to look elsewhere. International markets are only viable for a handful of very large funds. For other funds, including those started by next-generational professionals and women, sophisticated investors are the answer to this capital conundrum. However, and based on a sample test, index changes to the current test thresholds would curb access to sophisticated investors in the vicinity of 10 to 50%. Smaller and newer funds that invest in startups and early-stage businesses would be the most impacted. This means that world-class funds such as Airtree, were they to start out today, would have little to no chance of growing into one of Australia's leading backers of startups. It means that were the wealth threshold increased to $4.5 million, as has been suggested, it would wipe out half of the investor base for one of our members and almost 100% for another one of our members. It means that companies such as Atlassian, Canva, Employment Hero and Airwallex, were they to start out today, would unlikely grow into the local technology success stories that they have become. For some investors, investing in venture capital and private equity funds delivers superior returns as part of an overall investment portfolio. As an asset class, there are complexities to understand. However, understanding an asset class is a function of financial literacy and access to appropriate advice, not a scale of one's wealth or asset holdings. If the policy concern is that there is now a number of investors who do not have the financial literacy to understand more complex investments, assessing their literacy or adding education and skills requirements would be the obvious response, rather than adjusting the thresholds. Moving the thresholds would only seek to exclude a cohort of people who have the capability to make more complex risk-return decisions, including young people and women, two groups whose ability to generate wealth through property is in decline. Thank you again for this opportunity, and we're here to answer your questions.
Thank you very much, Ms Prasad. Most of you, I believe, were here for the previous session, and you would have noticed my questions around financial abuse, and we know that that has a profound impact on women. I'm very keen for all of you to receive a question on notice from the Secretariat to think about financial abuse in whatever it is that you're proposing that we undertake, to run that lens over your suggestions, and that might need to require you to refine them just a little more, but you'll get communications from the Secretariat about that. Can I go straight to your final comment there, Ms Prasad, about access to wealth generation for women in particular, being hampered by reliance on property and the value of such an asset class to do some recalibration perhaps of opportunities for women. And if I can put it in this way, and I'll come to each of you for a comment, there seems to be the naturally arising out of the 2002 determination, one model with adjustments. At this point of time, I'd say in fierce competition with another model, which is, let's just keep an eye on that, see what's going on internationally, maintain our competition, but let's deal with the education piece. And not in a PDS disclosure way, but in an active learner agency way. I think that's where I'm landing based on what we've heard and on the submission. So I'm interested to kick off with you in response to that observation, with you, Ms Prasad.
Thank you very much for the question, Chair. Look, I think what you're saying is broadly correct. We are seeing, obviously, that the proportion of women and younger people who have access to property as a means of generating wealth is in decline, as I said in my opening statement. There are limited opportunities for women in particular to generate wealth, and having access to investment opportunities that provide a higher rate of return is certainly one way of opening the pipeline of opportunity for women. But there are probably three ways in which women with this particular set of policy, I guess, proposed changes may be impacted. There's women as investors, and I've outlined, I guess, some of the consequences that may flow on for them in that regard. There's women as the next generation of fund managers. For women are relatively new to fund management and starting their own funds in our industry. They don't have their funds don't necessarily have the maturity to attract capital from superannuation funds or large institutions, so they rely almost exclusively on sophisticated and wholesale investors in order to be able to invest, set up their fund and actually build the track record so that they can grow in much the same way that Airtree has, and I'm sure James may have some comments on that should you wish to hear them. The third area is women as female founders. We know that access to capital for female founders is challenging, but I think reducing the amount of capital that's available for investment into startups and into growth businesses is only going to compound the problem, not address it.
Okay. Mr. Cameron, did you want to add anything there?
The only thing I think I would add is that, as we know, the impact on angel investors that these potential increases in the thresholds might have would disproportionately impact women as a group. And removing a larger number of women from the potential pool of angel investors into startup companies would likely have a knock-on effect into the number of women founders and entrepreneurs that get founded. There's very good research to suggest that there is a very large funding gap between the number of women founders and entrepreneurs getting funded and the number of men. This is something that occurs worldwide, and Australia is no different. But there's also research to suggest that the more women investors there are writing those seed checks, angel and ADIP PC funds, increases the likelihood that women founders will get funded.
Very interesting. One of the pieces of evidence we received yesterday was that angel investors, the profile, doesn't fit with the, I think, historical descriptors of people who are likely to be considered eligible for wholesale or sophisticated investor status, namely people who have a finance degree. That these innovators and disruptors who are seeking angel support and investment come from a vastly wider range of intellectual endeavours that are moving into new parts of the economy, certainly have the intellectual capacity to undertake necessary learning to acquire the sophistication to make choices around financing in addition to whatever intellectual journey that they're on for another purpose. So that brings us to the sort of qualifications that would be necessary. And amongst you, there are some profferings there. So I might just jump along to you, Ms. Horton, because there's quite a detail there in your submission.
Yeah, absolutely. I think in response to your question, I'd sort of say the first observation is that sort of existing fairly blunt thresholds do tend to have a disproportionate impact on women who, sort of as you've covered previously, are more likely to take time out of the workforce and therefore have sort of the skills and experience that you would want in an investor, but don't necessarily meet sort of a very blunt requirement. Raising the threshold is likely to make that worse. And so in that context, we have proposed sort of a couple options for recognising educational pathways or sort of skills and experience of investors to be part of the test.
Do you want to take to us some of the details on that?
Absolutely.
Because we haven't had much on the record other than my proposals around, sort of RPL and micro-credentialing, but you've got a more sophisticated representation of offerings already existing. So let's hear that.
And I think sort of in, obviously this is sort of not required at the moment, but in response to sort of a real desire for angel investors to really want to educate themselves, there are sort of industry-run courses that exist already. One of them
Mr. Cameron
by
has
Airtree.
yes, you're mentioned in here. Yeah.
Yes, we're mentioned. We are mentioned in dispatches. Yes.
Such the sort of Airtree Explorers course, the StartMate First Believers. And UNSW also runs a course for angel investors designed to sort of equip potential angel investors with the necessary skills that they need to make these sort of financial decisions. So we think that there is an opportunity that exists at the moment to use sort of existing programs to ensure that sort of potential wholesale investors have the practical experience to understand the risks of the potential asset class and give them the necessary knowledge necessary to invest. And that there are sort of mechanisms by which, if government wanted to, these courses could be recognised by sort of independent institutions or somehow sort of assessing these courses against certain criteria to ensure that these courses do.
They're not shonky certification by an RTO that's out to make some money.
Precisely.
With a 12-minute presentation.
Yeah. And there are ways of doing this and using sort of the existence of these courses already in which to do that. I think then the second part too is, and I suspect this has already too been discussed as well, is just better recognising the professional training or experience of an investor that they have already. This would be consistent with the approach taken in the UK. Which looks to sort of a range of criteria to determine whether someone objectively does have the necessary skills and experience to be able to make these sorts of decisions. So things about sort of their university degree, whether they've been a member of a network or a syndicate of business angels for a period of time, their professional experience, such as whether they've been a director of a company, etc., or whether they've worked in private equity or finance. These are the sorts of skills that you would expect would make an investor well equipped to make the necessary decisions here, but aren't recognised in our existing wholesale investor test.
What about self-verification? Attesting yourself on a document?
Yeah, look, this is something that I could...
Because that's going to freak a lot of people out. Of course I'm a sophisticated investor. What do you mean? I read that book yesterday.
I think we are in favour of sort of clear and objective criteria that don't sort of rely on someone sort of signing saying, yep, sure, I think that I am sophisticated, and that there needs to be sort of processes in place to recognise qualification, that they are objective measures and not a subjective measure of even an investor's self-assessed subjective measurement of whether they feel that
that's a bridge too far. It needs to be something else.
I think, and we can take this on notice and come back, but we're really, when we've gone out to our members, objective criteria have been sort of the key calling out for here, and I think that's what we would want to see.
Given your experience, Mr. Cameron, in this sector, can you give the committee any insights into, what an appropriate kind of qualifying level of entry into the wholesale investor, if education were to become the determinant? What would it look like, and how could we preserve its integrity?
I can certainly talk to aspects of that. The program that Ms Horton refers to is our Airtree Explorer program. And it is a program that we run twice a year, 12-week program, to encourage between 40 and 50 people at a time to take up the necessary skills and network to become angel investors.
And roughly gender balance?
50-50.
Okay.
We always make sure of it, and we have a equal representation across ethnic backgrounds as well. It's something that we find very important. Diversity is one of the key reasons we do this, to make sure that there are a diverse group of angels actively investing in Australian companies. And I think the reason for that is we're a big fund. We're one of the biggest in the country. We have 110 companies in the portfolio. Some of the companies we've invested in over the years, almost 10% of them are now billion-dollar-plus companies and household names, companies like Canva and Employment Hero and Go1 and Linktree. But we know that we can't do this alone. We need a very, very thriving ecosystem of other venture capital funds, and we need a thriving ecosystem of angel investors to help us fund more and more of these technology startups. And so the rationale behind us starting the Explorer program was exactly to do that, was to help encourage a larger number and a more diverse group of active angel investors in this country to help write those seed checks alongside us, in some cases before us, into brand new technology startups that could one day become successful as companies like Canva.
And is there a cost attached to this product?
It's absolutely free cost. So we do that.
Because it's seen as an investment in the sector.
It's seen as an investment in the sector, exactly right. And I think it's a necessary investment in the sector. And we're not the only ones. There are multiple courses like this across Australia, and there's also some that are run by the universities as well. UNSW has a program training up angels. The Wade Institute down at Melbourne University has one similar, and I'm sure there's an assortment of others out there as well. So it's a well-trodden path, and I think it's an important path. And we'll continue to do this regardless of the outcome of this inquiry, because it's an important part. And we have no commercial benefit from that program. As I said, we don't charge anything for that for the angels.
You were in the room when I described the problem with a quack and asked the Financial Services Committee to Financial Services Council to take on notice a consideration of the fact that the accountants are saying they're not comfortable with doing it. They don't want to bear the risk of a moment in time snapshot of somebody's financial situation being abused and putting them at risk. Why is what you're offering superior to a quack and that sort of model of what a bright line looks like?
I don't have a particular view on whether or not that would be a replacement to a quack. I think it's something that you could potentially incorporate into a quack, and you would obviously have to have some sort of guidelines around what those courses would require as part of the curriculum to make sure that they were sufficiently covered so that the accountants could sign off on them as qualification routes. But I don't think it would be a replacement for it.
Okay, thank you. And Ms. Sue Lee, you made it very clear that you wanted this sort of a change, the financial literacy, and you referred to jurisdictions such as the US and Singapore, and we've heard from other witnesses that Singapore has a good model. You also indicated in your commentary, in your opening statement, that the government should implement this. Why the government? You know, accountants might have a view about Mr. Cameron saying, well, we don't want to be the qualifying identifier. Like, what is it worth the government investing in this? Should it be the AFSL holders who provide, you know, the wherewithal to have this checking, or does it need to be part of some existing regulatory structure and responsibility if such a scheme were to be advanced?
I'm sorry, I think the clear thing there is that we would like an objective test, and government is the natural place that we think would be able to provide that objectivity, whether it's accountants or whether it's the AFSL, as long as that objectivity and transparency is there, we're happy to support. One would know that with what's going on now with the use of artificial intelligence and automated decision making and ticking whether this person meets certain tests, you know, the laws are getting updated to ensure that there's transparency in those decision making tools to make sure that we are testing them properly. So that's a short answer. If I may kind of add to some of the comments just now. I would like to also appeal to the committee that it's not just about helping female investors, it's also about helping minority investors as well. I would love to see a First Nation investor because we need them. If we're going back to that issue of AI, for example, one of the biggest challenges, who's going to own the AI-generated art based on Aboriginal art? If we have investors in that area, we have greater state certainty that they would protect their own art, for example, their cultural artifacts. So I would like to make that point, not to forget this really important group of people as well.
And young people have also been mentioned, so let's put that there very clearly on the record as well.
Yeah.
Yes.
And on that point, that's exactly my next point. My past life, I was head of policy at the Australian Payments Network. And we saw a greater trend of younger people becoming scammed in investment because they have higher risk appetite and they think that they know the digital environment, and they're starting to get themselves into cryptocurrency. We see even younger people kind of, you know, riding on the coattails with their parents and say, oh, can you help me set up something? And we had to do a lot more engagement and education to stop them from jumping onto the bandwagon without real education as well. So I think the self-assessment, it makes me a bit nervous only because we are seeing a trend in young people self-assessing themselves and taking on higher risk and becoming targets for scammers in investment fraud, investment scams.
And when you're saying young people, what age are you talking about?
They can be quite young, but I've heard of anecdotal examples of like 16, 17 years old. It's not just an Australian problem. One of our counterparts in the Scandinavian countries already launched a whole anti-scam campaign targeting only on young people. So it can be ranging 20, 30 years old who would pass the 18-year-old threshold if I don't know exactly the law on what age one have to meet to be a sophisticated investor, but you know, younger people are starting to jump onto the online.
Could I come back to you, Mr. Cameron, and have you got expressions of interest of young people who are part of your cohort?
Yes, we do. And beyond that, we also we aim every cohort to make sure it's a really diverse group of young Australians, and including in that, we've over the last 3 cohorts have made a real effort to make sure that that extends into the regions as well. So we now have explorers that join us every week when we do these sessions via Zoom from as far away as up in Cairns, over in regional areas, Western Australia, and everywhere in between. It's been a real focus of us.
Thank you very much. Mr. Anderson, did you want to add anything?
I might.
Mr. Versey? Yeah.
Sorry, Senator. Chair, thank you very much. I might just give some context and pass to my colleague Stuart to the original premise of your question. We're very pleased that of the 17,000 direct jobs and the 34,000 indirect jobs, that 51% of our industry in medtech is women, which is above the national average. One of the concerns that we have with raising the wholesale investor test is that a lot of these startups, the investors that do sign up to invest in them, bring with them not just financial capacity but the experience. They're usually executive level medtech people who've worked in the industry, who understand. They're also clinicians who understand what's the purpose is, and part of that experience that they bring is also when you have a diverse range of people, whether that be women or minority groups who come into medtech and are addressing the challenges that are specific to them, particularly around femtech, as some people are calling it. And so that's one area that we do see a concern of as being impacted by these changes is not having those types of investors being able to get into the market and address the challenges that we as the medtech industry find as one of our core issues, is making sure we're addressing women's health. But I might pass to my colleague Stuart, who could probably speak more specifically around the data points to the impacts on women in these changes.
Just before you just hand off, Mr. Versey, can I just ask, for the MedTech Association, how many women do you have at senior executive levels in your organisation?
I'll have to take that on notice in our organisation ourselves, but Stuart may have them across the
Thank you.
board.
Mr. Anderson.
I would suggest that, Senator, Chair, in terms of the board level at the MTAA, it's roughly 50-50.
Which is very different from the ASX
It
200
is.
or 300.
And I do appreciate the irony of 3 men talking to women's health.
Well, I just wanted to check because the visual isn't quite what I was hearing there. So.
Look, in the spirit of sort of diversity and inclusion, that even though we may not experience the issues of women's health, we can actually contribute to the conversation.
Of course.
And we are very keen in supporting some initiatives with the University of New South Wales and bringing to bear some women's health initiatives, particularly in support of the Medical Research Future Fund and bids for incubator funding to progress some great research through to market. We talk to examples such as Bamatop that are doing some pregnancy detection tests. That is a women-founded business, is a women's funded business, and it's a women's operated business, primarily through angel investors. But those angel investors are bringing to what we call a regulated environment to bring a concept to market. There's a period of asset build time before it goes through its clinical trials, through its regulatory approval, through its reimbursement approval. That space is filled primarily by angel investors and by high net worth investors who typically have an issue or a concern in family care that want to support an initiative. With respect to our friends at the Australian Investment Council, for their fund return profile, they come in at our projects at a much later stage because it's de-risked. There's some uniqueness to our particular profile in terms of that asset build or that option build that needs that capability whether it be for women's health or youth health or for other areas, that we need that capability that comes to our projects that then attracts the further financial investments as those projects are stabilised, to then attract the further institutional venture funds that accelerates these things.
Did you have anything to say, Mr. Siriwadena?
Just to embellish that case study that Stuart talked about with Baymatov, I think one thing I've thought about as well as our position in this discussion is we're looking at it from an investor perspective, but in our sector, they're also patients. Investors are also patients. And I think the beauty of the Baymatov example is that the person who developed that was a biomedical engineer who went through lived experience, had postpartum hemorrhage, and realized, I don't want any other women to go through that. And, through her own personal journey, was able to create something that provides a solution to mitigate that for other women. So I think the lived experience component in healthcare is integral in all of this as well.
Yeah.
And the
there
innovation,
are assets other than financial ones
intangible
that
assets
have value.
that, absolutely. And the social and health dimensions should not be looked at independently in this discussion. So that's basically what I wanted to flag.
Thank you.
Well. Yeah.
You make a very, very significant statement, I think, relevant to this inquiry. Wealth is a poor proxy for the ability to assess private investment risk. I think that's a nice shorthand for some of the challenges that we're trying to wrestle with today. My last question is to you from the medtech sector, although there were some references in other evidence as well. The reduced number of feasible projects suitable for funding by the National Reconstruction Fund and an over-reliance on grant programs to commercialise Australia's world-class medical device technologies, Australia's world-class innovation, whatever. The National Reconstruction Fund is a critical part of the government's plans for our future. Can you just quickly put on the record the intersection between what we're considering here and why it's important to that part of our potential drive for the economy?
Certainly, Chair, and I'll pass to my colleague Stuart, who's our CTM manager.
Thank you. Thank you, Chair, for this question around the impact. In terms of what we've been able to observe from PitchBook data and other sources, particularly our experience in supporting a lot of these growth stage projects with companies through grants projects, we would see a roughly halving of the number of early companies that are funded by sort of seed, so down from 50 to 20, 25 or less. That flows through by the time you're actually reaching later stage funding that's more suitable for the venture capital funds, a shortfall of down from 5-6 projects down to 1 or less. That means that there's a falling of the quality of concepts that come through that are matured by those angel investors that add that capability that serves to stabilise a lot of the research that comes out. In our sector, medical devices accounts for close to 4,000 patents, according to IP Australia. The challenge we have is we're not getting those businesses coming through the other end. We look at Cochlear and ResMed, that respectively are 50-year-old companies. We're needing to see more of the Saluda Medicals stay in Australia. We're needing to see other members such as Evolution Surgical focused on spinal implants. That does affect women of more maturing years in terms of the spinal implants for osteoporosis and the like. We need to be able to find ways to support these companies and others that come through those growth projects.
Thank you very much. Senator Scarr.
Thank you, Chair, and thank you to all the witnesses for appearing today and everything you do in this space. It's quite inspiring, actually. It's uplifting to see everything that you're doing in this space. I've got 4 questions, and I want to give everyone an opportunity on the panel to answer the 4 questions.
Senator,
so we'll try and move.
If we need to shorten the lunch break, I'm okay with that if you are.
I'll put my order in now. Okay, so the first question I have is, and this is in the context where ASIC, in its submission to this inquiry, has proposed an increase in the net asset test from 2.5 million to 4.61 million, and an increase in the gross income threshold test from 250,000 to 461,000. So those are quite dramatic changes. In section D of their submission, ASIC says, "We do not consider such increases would have a material impact on the fundraising community." End quote. I want to give each of the witnesses an opportunity to respond to ASIC's statement in that regard. So if I can start with you, Mr. Versey.
Thank you, Senator, and I'll pass to my colleague Stuart in a moment, but we would disagree with that assertion there. It takes a significant amount of investment to get a medtech company from start all the way up to commercialisation. $61 million actually to become a potential acquisition target there to get to that point. But I'll pass to Stuart, who can elaborate a little bit further.
Thank you, Matt. Thank you, Senator, for the question in terms of ASIC's perspectives. One point that I'd also like to make in terms of the Corporations Act is that the indexing to inflation doesn't apply to other areas as well. I'm looking here at Section 708, where you have constrictions on the ability to raise $2 million funding over a 12-month period from 20 investors. So if it were to be indexed, how about we index for the broad base? As you'd appreciate from Matt's statistics, or Matt's number of $61 million to get a company to be ready for global markets, primarily through acquisition, there's lots of funding that is needed at that earlier stage. We look at tranches of $500,000 to 2.5 to up to $5 million in terms of those early, I want to call it angel, seed and Series A rounds. That we would see the funding available, the number of investors available, as we look at anecdotes from other groups such as Sydney Angels, Brisbane Angels, Southern Angels in South Australia. You would remove angels between 50 to, the number of angels would be down to about 50 to 90% reduction in angel investors available. Southern Angels is a classic example, from 40 to 4.
Okay, thank you. Ms. Sue Lee.
Thank you. I did read the ASIC submission, and quite frankly, I found it a bit troubling, and that's why I mentioned it in my opening statement. I found that they didn't have a lot of strong arguments for making statements like that. I don't know whether it's because a lot of this financial modelling was kind of, redacted or something, but to make a statement like we do not predict material impact, I would just love to see some data behind that to understand how they came to that conclusion. But
you should join a Senate committee.
I love data, so I constantly go, where is the data on this? If it's kind of hidden because there's some sensitive information, I get it. So I think that's where I give them the benefit.
I'm not sure it is hidden.
Yeah, I know. But that's why I give them the benefit of the doubt, just in case.
You're a kind person.
Yeah, but sorry, for that submission, that proposed reform on increased net asset and gross income. But for the CPI, there wasn't any mentioning of other factors they consider in making that increment as well, which, that's why I said I was a bit troubling, because it didn't consider other impacts like economic impact on, on the investor community, etc. So I would just love to see a bit more data.
Okay, thank you. Ms. Houghton?
So obviously, in response to your question, Senator, different funds and different syndicates will have sort of slightly different makeups of investors. But from the people that we spoke to, so StartMate, for example, is a startup accelerator. They estimate that over 95% of their investors qualify as wholesale investors based on the current income or net asset test. And over 300 investors across their funds would be ineligible under ASIC's proposed new definition of a wholesale investor. They're suggesting to lift the threshold. So that would represent about 80% of all investors in their funds and approximately 25% of their committed capital. Another major venture capital fund within our membership estimates that about 60% of their limited partner investors would become ineligible under ASIC's proposed changes, with these investors having committed around $84 million worth of capital and representing approximately 3% of total committed capital in those funds. Aussie Angels, who I understand you spoke with yesterday, estimates that approximately 7 out of 10 investors in their funds who qualify do so based on income and not assets, and that an income threshold of $450,000 would impact a significant proportion of these investors, with recent research indicating that more than half of angel investors in Australia earn less than $400,000 per year. And the data from the recent State of Australian Startup Funding report from this past year indicates that only about 14% of angel investors in Australia make more than $400,000 in annual income.
Okay, thank you. Ms Prasad?
Thank you, Senator. We're not sure where the evidence actually bears out the claim. And as I said in my opening statement, I'm very happy to repeat it. Thank you for the opportunity. Is 10% of investors across private capital funds are wholesale or sophisticated investors. We did a sampling of some of our members, and as I said, it would range from anywhere to 10 to 50% of a reduction in the number of investors. And at that 50% end, that's particularly for smaller funds and newer funds. I think you've heard from the angels already that it would decimate angel investing. Certainly for as I mentioned, for one of our fund members, it would wipe out their entire investor base. Which is, utterly, that's beyond devastating. So I'm not sure that the evidence is borne out. If the point that ASIC's making is that there are other sources of capital that would step in to fill the void, I'm not entirely sure that the evidence bears that out either. As I mentioned, superannuation funds are allocating less and less, particularly to the early stage part of our economy. As I mentioned, foreign institutions are only going to be viable for our largest funds, funds like Airtree, which are only where they are today because in their first fund, 100% of their investor base was sophisticated investors. Even in their last fund, I think 25% of your investor base are sophisticated investors. And then I think ASIC made some suggestions about other ways in which startups could raise capital.
I'm going to get to that.
Okay.
You're anticipating my second question.
Just before we go to that, can I ask if any of you were consulted by ASIC at any point of time?
No.
Okay. For the record, everybody's shaking their heads and saying no. Thank you.
Okay. So I'll hold that thought. And Mr Cameron, just to give you an opportunity to comment.
Just from an anecdotal perspective, I think as Ms Prasad mentioned, we wouldn't be where we are today but for the support of our high net worth wholesale investors. Our first fund was 100% made up of them. We're in a very fortunate position now. We've been doing this for 10 years. We have a very diverse LP base made up of some of the largest super funds and some of the international funds, but it still makes up 25% or so of our investor base today.
Okay, excellent. I'll move on to my second question, which was very insightfully anticipated by Ms Prasad. Well done. So in paragraph 125 of ASIC's submission, they've got a solution. Let me quote. There is a range of existing avenues available in the Corporations Act for those seeking to raise capital for limited offerings to clients with reduced compliance obligations. These avenues would not be impacted by our recommended reforms to the wholesale tests and would remain available for fundraising as explained below. And then they provide the two examples which they think startups, etc., could have recourse to. The first is the CSF framework. In Part 6D.3a may be available to companies seeking to raise and contribute capital. And the second they refer to is the 2012 rule, which Mr Anderson referred to, the $2 million cap. So I just wanted to give you each an opportunity to respond to the argument which ASIC is making in its submission, that if you did change the thresholds, all is not lost. You can simply have recourse to the CSF framework or take advantage of the 2012 rule, and that should address your concerns. So, Mr Versey.
I'll pass to my colleague Stuart, Senator.
Thank you, Senator. In terms of the impact on the angels in that early stage investment, we often see those form as syndicates outside the, I think it's Chapter 6C of the Corporations Act, where you're actually using 708. That limitation that is in place of Section 708, where the 2 and 20 rule, does stifle the ability for these growth companies to raise funding in the first instance. That's
what are the reasons for that? What are the reasons that the fund, which provides no prospectus or PDS, is required to be given for fundraisings up to Australian $2 million, where offers of securities or financial products are made to up to 20 retail investors over a rolling 12-month period? What are the limitations of that rule for startups in the space
looking
you're
at,
interested in?
Looking at Section 708.10, where you're relying on the holder of a financial services licence to be able to provide that clearance. It adds a significant burden, both administrative and cost, to those early stage companies that are more focused on bringing the concept to market, understanding market opportunity, rather than actually investor compliance.
Okay, understood. Ms Sue Lee?
I would think logically a startup's viability is really cash flow. So if you have to wait till you get a decision using the framework, etc., to have a recourse in order to secure funding from your investor, that would have quite a detrimental impact on their ability to survive and ride out certain months, for example. So I think that alone, saying that, well, if you don't get approval, just wait. There's some other ways for you to get the money. I think that the logical answer would be quite detrimental to startups.
Okay. Ms. Houghton?
Look, I think in short, we haven't surveyed the other options that ASIC has done in detail, but we do know that investors depend on this existing test, and that there have been concerns raised with options where AFSL holders certify whether an investor is sufficiently experienced in order to qualify, because the test is so subjective and places the risk on AFSL holders.
Can I ask you, and all of you, if you want to take the opportunity to take on notice those two particular capital raising options which ASIC has referred to in its submission, and even after you have the benefit of consultation with some of your members, come back with any detailed commentary with respect to the benefits or disadvantages of going down those paths for the investors and startups who you're involved with. But thank you for that. Ms. Prasad?
What I would say is that they are at best a tiny portion of the overall capital conundrum that I mentioned in my opening statement. I would also say, particularly on crowdsourced funding, whether that really is an appropriate way of securing funding for a startup where there is no guarantee of a return on investment and a single startup, at least when you
just follow the crowd, don't you?
Well, I guess so. But then what happens when something goes wrong? And that would be my question. And are we really just transferring a perceived problem somewhere else? And then certainly on the second suggestion, I think the point that ASIC is perhaps missing is that whether it's angel investors or venture capital funds, it's not just writing a cheque. It's actually the investment of intellectual capital that goes into the startup. Everything from mentoring, working with the management team, providing access to networks, helping them build, new markets, help them with product development. You're not going to get any of that from a crowdsourced funding campaign or from the other option that was mentioned.
Okay, Mr. Cameron.
The only thing I would have to add is just some numbers around the crowdsourcing part of this as well. It is an important and valuable part of the funding landscape, but as Ms. Prasad said, it is a very tiny proportion of the overall VC landscape. Just to put some numbers on that, the Virtual, which is a crowdfunding platform based in Melbourne, they do an annual report for the FY24. There was $64.5 million in crowdsourced funding across the crowdfunding platforms that have been in existence since the 2018 law changes that made it available. And that's compared to the $3.35 billion in total venture capital funding in Australia, according to PitchBook data for the same period, which puts it at just under 2% of the total funding available. So a tiny fraction of what's actually required.
Okay, well, those are very dramatic figures. Now, Mr. Anderson, we're used to estimates processes where we're watching public servants behind the panel of lead witnesses potentially bring up pieces of paper and post-it notes, and we latch onto that with great alacrity. So I saw you had a pink post-it note brought up to you. Is there anything else you want to add to your previous answer?
Look, thank you, Senator, for the opportunity for my colleagues behind me to further contribute to this conversation. The key points were made with crowdsourced funding, which I think has already been raised by Mr. Cameron, and thank you for that. We're also looking at here the drivers towards listing too early, which is already a function of the Australian Stock Exchange and Australian markets. Several points come into conversation around that. Is firstly that listing too early, creating that liquidity for investors, often creates undue pressure on a company that is focused on cash flow and performance in terms of its growth against key milestones in our stage, against key regulatory and reimbursement approvals that have their own unique challenges, a conversation for another day. What we're also seeing is that public markets are falling away in terms of their ability to attract funding, and there's moving towards more of the private markets. Several articles in today's Financial Review, as well as yesterday's Financial Review, are talking to this particular topic at the moment. The third point that I'd like to raise with my colleague's sort of suggestion is that the $2 million raise of the 2 and 20 rule under 708 can only last, in our sector, lasts between 6 to 12 months. Because we have a very capital-intensive nature, you'd appreciate that validating a medical device through its engineering, through its animal models, is a fairly expensive exercise. That's where we do avail ourselves of grants programs. In terms of the work we're doing in the grants programs, 140 unique applications, down to 10, 11 recipients. All came through because of that angel and high net worth co-funding on their grant program. So if we look at an 80-20 rule, there are substantially more concepts that could come to Australian healthcare if we actually find ways to actually unlock some of the funding.
Okay, excellent. Thank you. My next question is, we've talked about, and I think this is important for us to reflect upon, we've talked about having more objective financial literacy tests whereby the qualifications or the competence of an investor can be considered. I don't understand what you're proposing is that those tests would then enable us to dramatically increase the thresholds necessarily, but I just want to tease that out because I don't want to be in a position where what you're saying is interpreted as, oh, provided you add some sort of additional limb, providing for an objective financial literacy test, then that's going to solve the problem, just change the thresholds to whatever you want. So that's the first point. The second point is we all live busy lives. So if you're a professional who's earning, or small business owner or whatever, who's earning a gross income, especially women, as a cohort who may be disproportionately impacted by changing these thresholds, is there a risk that if you, instead of leaving the thresholds where they are and imposing this sort of process whereby you can objectively demonstrate your financial literacy, for a particular cohort of angel investors, it just all becomes too hard? I haven't got time to do that. I just don't have time, so I'll stop investing. So I wanted to give you an opportunity to address those two questions I have as to where does the potential refining of financial literacy and competency test sit in the regime? Is it to supplement or replace or as an alternative, firstly? And secondly, as witnesses who are closer to this pool of sophisticated investors we're talking about, what are your views with respect to their appetite or capacity or bandwidth to have to go through an additional hurdle in addition to the net, say the gross income or net assets test? And are you going to lose a particular cohort of those existing sophisticated investors if you require them to jump through additional hoops? Mr. Versey.
Thank you, Senator. We recommended in our submission that education, certification were good solutions to be able to address the challenges of investor protections, but we don't believe that doing those and then increasing the wholesale investor test is ideal. It'll still function, it'll still offer the same challenges that we have highlighted, which would rule out a significant number of people that could invest in mid-tech companies. I'll pass to my colleague.
So just to, sorry, before you pass to your colleague, so you're saying this should be an additional limb. It shouldn't operate as a reason to increase the thresholds?
Correct.
Right. Mr. Anderson.
Thank you, Senator. To reinforce Mr. Versey's observation, if we see it as a complement.
An additional limb.
A complement, an additional limb.
Yep.
Another aspect that we would also encourage exploring is investor syndication, primarily through angel groups from our space, that encourages a level of peer review of a project through pooled due diligence, but also encourages, through the nature which a lot of these syndicates operate, the ability to actually have on-the-job apprenticeship kind of constructions.
So that might be, so Mr. Anderson, that, and I really like that concept, and I think in the UK they might have something similar in that regard, but that potentially opens up this avenue of investing to people who might be on an income of 120,000, 150,000, or they might be on care leave, or trying to adapt your language, right? So it provides an extra opportunity for them to actually, in a much safer environment, if I can use it in that way, where they're getting the benefit of all that collective wisdom through their angel syndicate to actually build the skills and resources and to do it at a moderate level, and as through time, they're the potential leaders of those syndicates in the future. Is that correct?
Very much so.
Yeah, that's the easiest question you're ever going to get from the Senator.
Thank you, Senator.
Okay, all right. Ms Sue Lee?
So to answer the first question is additional limb. I would be in support of that. So the second question is, I think in our submission we did also say that there needs to be a bit more consideration about protections. So if those who are just so that they don't lose their whole life saving in bankruptcy, are there ways we can improve protections even if they do?
We'll increase the threshold.
No, not by disqualifying them, but if they are qualified, how do we protect them? But I think the third point, and forgive me because I didn't grow up here, I didn't go to the schools here. I always think that all education, it goes to the education point. If I have my way, all children should learn matters of law and matters of tax and accountancy and financial literacy. And I think if you could kind of build into the system, for the next generation, this process would be a lot more easier for them. I mean, for the adults, we're just kind of, I think the question would be, there's the Singapore model and the US model. I think the US model is a bit more aggressive, wanting a whole accreditation system. I think Singapore might be a bit more gentler. So I think the comparison of how that will work for Australia might be good enough to look at how that will work for the Aussie adults.
Okay, Ms Houghton?
I think in short, for us, we see these sort of additional this sort of experience or education-based pathways as an alternative to the threshold, sort of as a separate limb here. I think that sort of for us, that is the most important thing, is having an alternative way of having sort of investors qualify as being a wholesale investor. In terms of thinking about then the sort of thresholds themselves and whether you raise them or not, we think that there's probably a range of other sort of levers that can be pulled that aren't quite what ASIC is suggesting, whether it's as in other countries excluding the family home from the calculation of sort of the net assets calculation, but also that if there were any change to the threshold, that we think it is essential that any change would have to be grandfathered, just to ensure that you sort of don't completely disrupt what the existing system is, and that if you were to adopt recognising experience as a pathway similar to the UK model, many of the existing angel investors would sort of qualify under that, having already invested for a period of time in an angel fund, shown that they have that experience. That would be a way of making sure that sort of existing sort of angel investors are not disrupted by the introduction of sort of this alternative pathway, and that sort of this would apply to sort of new angel investors coming in.
Okay. Ms Prasad.
Yes, we would, in agreement that we'd see this as an additional limb. I go back to first principles. What is the problem that we're trying to solve here? And as I said in my opening statement, if the problem that we're worried about is an increase in the number of people that may, because of their wealth or their income, make more sort of uninformed or less informed investment decisions, then that's not a function of how much money you have or how much, the value of your home. That's a function of your knowledge and your ability. So that's why we think that an education or a skills and competency type test, not dissimilar to the elective professional test in the UK, which is an additional limb and is a model that's worth looking at. I think that would strike the balance between protecting investors, but also making sure that we don't, detrimentally impact the economy and the economic contribution that investment makes to the country. In our submission, we also strongly recommended that if the thresholds are to be moved, that there is a grandfathering. We do strongly believe that there should be further consultation on the thresholds, and also recommend a referral to the Productivity Commission.
Okay. Last question, which is between us and lunch, Chair, is...
I think we're hungry for knowledge.
Well, I'm hungry for both. In terms of This is the last question. In paragraph 105 of ASIC's submission, they say, quote, other jurisdictions generally impose higher financial thresholds or exclude certain assets when determining whether an individual meets the relevant wealth tests, end quote. And so I'd like your reaction to that statement. Again, feel free to take this on notice. I know it is covered in some of your submissions as well, but very interested in your answer, considering the context in which I would have thought a focus of policymakers should be to have an environment which keeps capital in Australia, which is invested into your industries and others, also is conducive to attracting capital from overseas to be invested in your industries and others, and also, and maybe fundamentally, is conducive to keeping those young start-up entrepreneurs or older start-up, whoever they are, the start-up entrepreneurs within this country, and making it as easy as possible for them to grow the next Canva, the next whatever it is, in this country and provide that employment and prosperity to the Australian people. So if I can first go to you, Mr. Versey.
Thank you, Senator. I'll ask my colleague Stuart to add to my answer here, but just as your question there at the end there, yes, we would agree. We want to see, particularly when it comes to medtech, Australia become a hub for new medtech companies. We would like to see more cochlears and more Australian-based companies that grow here and export their technologies. We have some of the best and smartest people around the world, and we would definitely oppose any rules or regulations that would make it harder for us to be able to get that investment here, whether that's local investment or drawing in investment from overseas. So,
Understood. Mr. Anderson?
Well, thank you, Senator Scarr, for that query around global experience. I think we've heard earlier evidence today and elsewhere where attempts to raise the threshold have substantially destroyed early-stage angel investors, and I point towards the English experience here, the UK experience. Yep. I also point towards other jurisdictions such as Europe that have both quantitative and qualitative tests. And we're looking here at capability. Capability is not necessarily a measure of wealth.
Yep, thank you. Ms. Sue Lee?
I go back to my opening statement, which is the point about the rigour of some of these statements, or what is based on. When you say higher, and I need to go back to paragraph 105 again. You know, is it an absolute figure? Is it both US and Singapore exchange rate, the currency are stronger than ours? Easily already Singapore is 15% higher than Australia. So what do you really mean by higher? The other point is, what about based on other things which I mentioned in my opening statement, what about their industry policy? Do they have a strong public support that we don't have? Do they have a great tax incentive that we don't have? Mm-hmm. So if you balance every factor together, maybe that's not a bad thing. Mm-hmm. So I think that's what I mean by that's the lack of rigour. It's just a lot of simplistic statements out there. Again, I give them benefit of the doubt.
Well, Ms. Sue Lee, if I've got a vacancy in my office, I'm going to give you a call. Ms. Houghton?
I think she needs to get a job bigger than your or my office.
That's
I think she's got one.
Exactly. Yeah.
Look, I would agree with the previous comments about sort of the debatability of that claim in our sixth submission. Perhaps if I could be a little bit cheeky, what I would point out is if you want to look to international experience, actually the UK is a great one in that in 2023 they attempted to raise the thresholds. Yeah. For high net worth individuals quite significantly. That came into effect on the 31st of January of this year. And by the 27th of March this year, those changes had been wound back by the government in the UK, and so those changes lasted for sort of less than 2 months.
But the impact will still continue because there would be collapse of certain projects in that period of time.
Absolutely, and that sort of disruption is catastrophic, has significant impacts, and that is precisely the sort of outcome we should be trying to avoid in this. And if I can then go, Senator, to your sort of broader point, is I think Australia struggles. We're not short on bright people and bright ideas, but we struggle to keep them in Australia. And if we can't attract local investment into our startups and into our entrepreneurs, they will and do go overseas. And if we can't attract local investment, it is very difficult to attract international investment as well. And it goes to a much broader ecosystem point.
We might
Excellent.
need to figure out the bright lines for the bright minds rather than just...
Bright lines for the bright minds. That's right.
I-
Ms. Prasad.
Thank you, Senator. I too will cite the UK and say I think all has been said on that topic, so I'll add no more. The two other points I'd make is we do need to think about how we compete on the global stage. And this type of capital is actually really important. There's an ecosystem here, so we go everything from angel investing right through to more institutional type investing. If we undermine any one of those pieces of the ecosystem, the rest of it falls apart. And that's not a great sign. It's not a great signpost of confidence. And if we're trying to attract international capital to Australia to bolster the amount of capital we have to meet areas of unmet need, we need to absolutely instill confidence in our own ecosystem before we can even go out to the world for capital.
Excellent. Mr. Cameron?
I'll just probably put one anecdote around that. The globally competitive nature of technology is clear for us all to see. These companies are competing with the best globally, and they're punching well above their weight. The vast majority of our 110 companies are focused on global technology markets. They're selling to, most of their revenues are coming from overseas. And they're competing with the best of the global software companies out there. And I think that's an important point to make, because if you look down the list of the top 20 companies that have ever come out of the Australian economy, most of those companies have been there for 30, 40, 50 years or more. They're mining companies, they're financial services companies, and they rightly deserve their place in the best companies and largest companies ever come out of Australia. But you will also see two companies that didn't exist 20 years ago, Atlassian and Canva. In Canva's case, it was almost only 10 years old. Both of those companies are selling the vast majority of their revenues to international customers and are punching well above their weight on the global sphere. That gives us a blueprint on how to scale these sort of companies, but they need that early stage capital coming from both angel investors and venture capital funds, which are in turn dependent on wholesale investors.
Excellent. Thank you. Well, thanks, everyone. I thought that was a terrific
Absolutely.
session.
Absolutely.
You made outstanding submissions, and thank you for answering our questions. Thank you for facilitating those answering our questions. And that was very
We'll have
useful.
quants, and if you have any appetite to help us understand why our
now
$4
teasing me
trillion
about lunch.
under supervision, the superannuation sector seems to be a place in which there must be some capacity that minimises risk. So let's not open a conversation there, but if you have some insights into why the shape of the market is as it is and how it interacts with superannuation from a historical perspective and perhaps a forward-casting perspective for risk management, I think that would be certainly of interest to me and perhaps to the
That would
committee.
be.
Yeah,
Yeah.
okay.
We can definitely help you with that.
Thank you.
Excellent.
Thank you very much.
Thank you.
The committee will suspend for lunch now and return at, what do we say, 1:45 or 1:50?
1:40.
1:45.
Yeah.
Thank you very much. Thank you. The committee will resume, and I now welcome representatives of Property Funds Australia, Mr Campbell Newman from Arcana Capital, and representatives from the Property Council of Australia. I understand information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today? We might start with you, Mr Healy.
Well, good afternoon. My name's Paul Healy, and I'm the Chief Executive Officer of the Property Funds Association of Australia.
Thank you, Mr Healy.
Greg Preston. I'm the Vice President of the Property Funds Association of Australia.
Thank you.
Kane Barnett. I'm a partner at Kane Gates, and I'm here representing the Property Council.
Anthony Knapp. I'm the Executive Director of Capital Markets at the Property Council of Australia.
Campbell Newman, Chairman and Managing Director of Arcana Capital Funds Management.
Thank you very much. I'll now invite you to make an opening statement. Mr Preston, is it you or Mr Healy?
Mr Healy was going to make a very short introduction, and I've got our opening statement, if that's okay, Senator.
Fantastic. So, Mr Healy, over to you, to be followed by Mr Preston with the opening statement. Thank you.
Good afternoon, everybody. On behalf of the Property Funds Association, thank you for inviting us to present today. I do apologise for not appearing in person, and I'd like to now hand over to Greg Preston to present our opening statements.
Thank you, Paul. Thank you for the opportunity, Senators, to appear before the hearing today. Our submission addresses the topics that we felt were required to be put to the committee, and we pretty much remain of the view that it remains unchanged. The submissions we've made cover the issues that we see as fairly important in this review. It's our belief that the system is working well at the moment and doesn't warrant change, certainly not in the context of raising thresholds and without considering the rigour of the Australian Financial Services licensing regime. There are some potential change, however, that could deliver improvements, and some of those might include conducting meaningful periodic reviews of this process, establishing an opt-in financial literacy education and assessment regime, enhancing the usability of the sophisticated investor test, establishing a mechanism to allow for extended periods of reduced income as a test, and by way of example, maternity and paternity leave for people when they're not working, as they would normally do when raising children. What our submission didn't cover was the wariness and unease that we've witnessed since this process started amongst the market and in particular our members. And by way of example, there's not a great understanding of the real rationale for change around this whole process in the marketplace and amongst the members of the PFA. There's a perception that it's been a fait accompli, and there are concerns that are getting involved from some of our members in an opposing view might raise the interest of them as an entity in front of regulators. So in closing, I'd just like to say that regulatory change shouldn't just be for the sake of change. It should really improve the environment or ecosystem it regulates. And from our viewpoint, it must really consider the impact and effect on all of the stakeholders that it affects. So we really thank you for the opportunity to participate today, and I'm happy to answer any questions. Thank you.
Thank you. Thank you for the statement there, Mr Preston. That claim of concerned members not wanting to kind of, if I can put it this way, put their head above the parapet because they don't want to become of interest to regulators. I just want to read into the record the protections that you have and to seek to reassure others who can engage with our political processes that there are indeed very significant protections for anyone. And I'm just going to read this now because I said it this morning and you haven't heard it, and I do want your members to know this. I remind all witnesses that in giving evidence to the committee, they're protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee. Such action may be treated by the Senate as a contempt. It's also contempt to give false or misleading evidence. Witnesses also have a right to be heard in camera. So it's important information, I think, to ensure the proper functioning of democracy, that your members know that they can, in fact, reach us at any point of time And if they seek to have a confidential conversation with their elected representatives, that is their right. They should not be intimidated by anyone, least of all regulators. So I just want to make that point because I think it's important.
Thank you, Senator. I think we'll relay that to our membership.
Can I echo the Chair's comments and echo them forcefully? It actually causes me grave concern that you were...
I've never heard it before.
That your members or market participants were moved to want you to make that statement. That actually in itself causes me grave concern that there's that fear. But I echo the concern of the statement of the Chair that you'll find some very fierce protectors of parliamentary privilege in terms of the members of this committee in that respect.
Thank you. Is it Mr Knapp who's giving the statement?
Thank you,
Thank
Chair.
you.
May I recognise we're on the lands of the Gadigal people, and I pay my respects to the elders past and present. Good afternoon, and thank you to the committee for the invitation to today's hearing. My name is Anthony Knapp. I'm the Executive Director of Capital Markets at the Property Council of Australia. Today I'm joined by Mr Kane Barnett, partner at K&L Gates, a valued member of the Property Council. And Mr Barnett is joining me here today as a subject matter expert and experienced legal professional with regard to wholesale investor test. The Property Council is the peak body for owners and investors in Australia's $670 billion property industry. We represent fund managers, superannuation funds, developers and investors across all spectrums of investment from debt, equity, public and private. Our interest in this inquiry can be explained simply as encouraging the Parliament and Government in the strongest terms to consider the unintended consequences of any short-term changes to the wholesale investor test, in particular as they apply to investments in the Australian property industry, which is a very illiquid industry. The committee will have heard evidence from a range of organisations regarding the key questions posed by this inquiry, which have been the focus on many government and parliamentary consultations or inquiry in the past. That is the appropriateness of having a net assets test at 2.5 million, which allows an investor to be classified as a wholesale investor. Our submission to this inquiry makes 4 recommendations, 2 of which is central to this debate. Firstly, what would be the unintended consequences of changing the test and increasing the threshold? Questions need to be answered about how an increase to the threshold would affect existing funds and their investors, considering that some investors may overnight no longer be classified as wholesale and funds may not be compliant as they contain investors who can only be classified as retail. Forcing the redemption of these investors would have serious consequences from a capital perspective and also from a taxation perspective, particularly in the economic climate that we are in at the moment. If existing funds are grandfathered, then there is still a risk of stifling new competition in the market. Reducing competitive tension leads to poorer outcomes for investors. The Property Council has not been presented with the evidence which suggests that access to wholesale investments through existing thresholds are negatively impacting consumers as a cohort. Why then would we seek to restrict access to wholesale investments to existing asset-wealthy investors and reduce the choice for consumers who consent to engaging with these higher risk, higher return adjusted funds? The response by government is simple: make a meaningful reform to the sophisticated investor test. If government is concerned that the individual wealth test does not sufficiently reveal the sophistication of an investor, then it should make the sophisticated investor test useful. In closing, as of now, members report that the test is underutilised by the industry because it is subjective and not objective, like the individual wealth test or the product value test. The government should investigate reforming the sophisticated investor test to create new objective assessments such as training, education and best practice framework. Without this suitable alternative test, the government risks removing potentially millions of investors from engaging with the wholesale investment market overnight, which will damage investors and the business community as a whole. Mr. Barnett and I can answer your questions, and I thank you for your time.
Thank you, Mr. Knapp. Over to you, Mr. Newman.
Chair, members of the committee, thank you for the opportunity to say a few words today and give evidence. My name is Campbell Newman. I'm the Managing Director and Chair of Arcana Capital Funds Management, an entity that holds a wholesale AFSL in our own right, providing opportunities for wholesale investors to participate in investments in the commercial property market. Since inception in late 2015, we've acquired around $280 million in property assets around Australia: offices, industrial buildings, car showrooms, childcare, fuel stations and shopping centres. And our operations extend from Tully in far north Queensland to Launceston in Tasmania and west to Kalgoorlie and Perth. We're a small team of 8, but we're supported by a finance broker, the major banks, very effectively, accountants, separate auditors and indeed 2 different legal firms. We're proud in a higher interest rate environment to be delivering a weighted average net cash return this financial year to our investors of 7.5%. This is due to our relatively low overheads. Additionally, we provide capital growth and, as an example, most recently paid our investors back $1.95 for every $1 they had put into an investment in Mackay back in 2016. We always invest serious hurt money alongside our investors. We are not unregulated. We don't operate in some Wild West framework. I say that because a lot of the coverage in the media and commentary in the past few months has implied that wholesale is unregulated. This, Senators, is our compliance manual. We pay one of the sets of lawyers I mentioned before $20,000 a year on retainer to make sure that we comply with our obligations under the law. Our position appearing before you today is to say that the law is working well and things do not need to change. I point out that the August 2023 Treasury paper that set this wholesale investor review in motion refers to the Sterling Property Group collapse around 15 times. Sterling, Senators, was a retail fund with a retail AFSL and with mum and dad clients. A higher wholesale investor bar would not have made any difference to the outcome in this debacle, and yet it seems to be front and centre in Treasury's mind in proposing changes. Now, there are voices supporting change. We heard from one of those strong voices this morning, the Financial Services Council, with member firms who have fallen for charging fees from dead people, overcharging and greenwashing, have recommended a significant increase to the wholesale investor thresholds, and yet that was characterised to this committee this morning as modest changes. Well, Senators, rubbish, I say. That's because if their recommendations are accepted, most Australians will be recategorised as retail, and that drives money to the FSC members. Their game, make no mistake about it, is to drive out the competition. Before I close, I add that my wife and I are also members of the Brisbane Angels Investor Group. In fact, to be more precise, my wife is the member, I'm the social member. This is her thing. Such groups provide vital early-stage seed investment to start-up firms. The threshold to the levels being proposed by the FSC would decimate the angel groups around Australia and deny these important early-stage funds to entrepreneurs. Both the US and UK authorities have recognised the significant unintended consequences of changes to their thresholds on the start-up sector and have decided to leave change alone. Now, it's admirable to seek to protect investors from shonky operators, but Arcana submits that there is no evidence of widespread problems with the operations of wholesale fund managers and licensees across this country. We look forward to taking the committee's questions.
Thank you very much. I do have a range of questions, but I might go to you in the first instance, Senator Scarr.
Sure.
I've got a feeling that there'll be some interrogation of the ASIC.
Yeah, no, we might start off with some interrogation of the ASIC submission. Have you had an opportunity to review the ASIC submission to this inquiry? Okay, I'll help you. I'll give you some quotes. So I am keen to get on the record your response to some of the statements which are made in that submission. So and I should say in this context, in the submission, ASIC is proposing or recommending that the net asset test be increased from 2.5 million to 4.61 million. And they're also proposing the gross income threshold be increased from 250,000 to 461,000, and also that the product test be increased from 500,000 to somewhere north of 900,000. In section D of their submission, they say, and I quote, "We do not consider such increases would have a material impact on the fundraising community," end quote. How do you respond to that statement, Mr. Preston?
I would like to see the evidence that they have that supports that notion, because there are unintended consequences of raising the thresholds that affect both fund managers but also affect the investors significantly as well. So I would like to see the information that supports the thresholds that are being proposed and the research behind it as to why those thresholds are what they are.
Okay, Mr. Knepp.
Yeah, I would concur with those comments, Senator. I think that obviously more research and market evidence needs to be done, and we would certainly recommend that. I understand that research conducted by ANU estimated that there would be a significant reduction in the amount of Australians that would be characterised as wholesale investors if there were increases in thresholds. And I would basically encourage an economic analysis be done on the implications of that and reducing investor ability to have choice. And this is going to reduce that.
Mr. Newman.
At the time the current thresholds were put in place, we're told that about 2%, maybe a bit lower in terms of Australians qualified. Today we're told it's about 16%. Back around the year 2000, 15.7% of people in this country had tertiary qualifications. Today I'm told it's 30%, on the way through. In every age bracket demographic from 70 down, more women have tertiary qualifications than men now, by the way, and that might plug into other things we'll talk about.
Sure.
So my point is, why is 16% so alarming? Like, what problem are we trying to solve, particularly when it's a far more educated country today?
Yeah.
I echo both the responses we just heard. And one other point, though, I totally concur, but I'll say this, and can I respectfully, and this was in our submission, I respectfully suggest to the members of the committee that when they're talking to ASIC, they ask them about this factor, and that is that Section 1, Objects 2A of the ASIC Act requires ASIC to consider the effects that the performance of its functions and the exercise of its powers will have on competition in the financial system. And I have yet to see any evidence that they understand at all what this will do. And I'll close by saying this will drive out small firms, and the offering we create cannot survive that sort of change.
Okay, thank you. And just pursuing Mr. Newman's point, was there have any of the organisations represented here today, have you been consulted by ASIC? Has ASIC sought your views with respect to the impact of changing these thresholds?
The Property Fund Association meets with ASIC twice yearly, or sometimes a bit more frequently. Right. But there hasn't been any direct consultation as I'm aware of, but we've raised our concerns with ASIC.
Okay. Mr. Knepp?
Senator, thank you. The answer is no. Okay. We would welcome an engagement by ASIC so that we can work with them to obviously help understand the impacts that this will have on the market.
Okay. Mr. Newman?
I've got to say that I only found out by accident in sort of mid to late last year that there was any sort of review going on, and yet we hold and have held since 2020 our own wholesale AFSL. So no, I'll make a point, I am aggrieved as a key stakeholder, as a holder of an AFSL. It took a lot of time It took a lot of money. They don't hand them out in cornflakes packets, and yet they engaged in this supposed consultation process, and we didn't even get a letter saying, "Dear AFSL holder, we'd like you to respond to this sort of review into the things that affect you and your clients." Yeah.
Because there are a number of, just to elaborate on that point, there are a number of statements made in the ASIC submission around, and I'll quote an example to you, which was just triggered in my mind by your comment about the implications for, say, a business like yours, and presumably, I don't know how many other, maybe you can take it on notice, how many holders of a wholesale AFSL in the property space there are. There's a statement at paragraph 129. Further, we consider that any increased compliance costs that would apply should the wholesale test be revised are outweighed by the resulting consumer protection benefits. So there's basically a assertion that you could, if you wanted, expand your AFSL licence so you could provide an offering to that cohort of your existing investors who are reclassified as retail if the thresholds were increased in the magnitude proposed or recommended by ASIC. How do you respond to that in terms of what it would mean to your business?
Senator, it's totally spurious.
And why do you say that?
Well, because the retail AFSL regime requires significant resources to administer it. As a wholesale provider of product, at the moment we don't have to do DDOs and target market determinations. We produce a disclosure, a set of scheme documents. There's a disclosure document, which is an information memorandum on a usual property transaction. It will be about 35 pages. It's a plain English document that, by the way, retail investors would probably better understand than a full-blown PDS, you see. And a PDS from a similar transaction is going to be 80 pages or something like that, and requires legal support to make sure that you dot the I's and cross the T's. Not saying that we don't take the same care. So there are significant increased costs, and our model, by the way, if you'll allow me, Chair, just for a moment to be a bit long-winded on this answer, what we do is fairly unique in that we don't provide a pooled fund with multiple property assets. What we offer our customers is an opportunity to invest in that office transaction or that fuel station, or perhaps two or three. And because it's a small transaction, it can't stand the cost of gearing up just to do, the documents for that sort of thing. There's also, of course, the requirement to participate in AFCA as well. Look, I'm going to have to say it.
If you're a retailer.
If you're retail. Well, that's what they're essentially saying. Yep. What they're saying, that's code for saying, well, they can go become retail. And, I don't dispute that we have consumer protections in the retail regime. What I do dispute is any assertion by ASIC that there is less risk on a financial product administered under the retail regime.
Well,
Does that make sense?
As you said, Sterling was under the retail regime.
Well, I'll give you, there's an example of our submission.
But it was prior to DDO and product intervention powers.
That's correct.
Yeah. Well, as an example, RCR Tomlinson was a listed ASX company, had been going for 100 years. This is back in about 2017, had some cash flow issues on some large renewable energy projects, raised $100 million on the ASX, and 90 days later they were in administration, never to arise from the ashes. So there's risk in highly regulated, retail and stock exchange type products. There's also risk in wholesale products. Yes, there are better consumer protections because of AFCA, for example, but I dispute that risk is lower. And going back to the question, ASIC are wrong, the compliance costs are a lot more, and they actually don't serve the interests of investors.
So, from your perspective in relation to your business, it isn't a question of there's simply an increase in costs. It becomes an insurmountable barrier to continue to provide that particular investment opportunity to those investors if you had to...
Unequivocally, Senator,
Yep.
we don't get to do what we do now. Yes, I acknowledge we could try and go to a retail licence, but it will be a completely different ball game. We will not provide the same product that our investors, and here's the point I want to really echo today, really again and again. This is about Australians. It's about investors. It's about their choices. It's about competition. And undoubtedly, this reduces competition.
Yep. So just on that point, in terms of consultation, we talked about consultation with your members and you as Arcana Capital as a participant in this space. But the next level of consultation would actually be with the investors who make investments in the opportunities which you or your members provide and what their view is, in particular that cohort of investors who are currently sophisticated investors who would be reclassified as retail investors in the event that the net asset threshold was increased to 4.6 million and the gross income test was increased to $461,000 a year. What level of consultation should there be with the actual investors themselves who would be deprived of investment opportunities before such a change was made? Mr. Preston?
It's been something that's concerning me right from the get-go once I started to read into this matter, Senator. The investors need to be part of the process, and they have been investing in funds for a number of years and through the economic cycles that we've had, but they are not expressing any interest, to my knowledge, to our members, that they have concerns about thresholds and whether... Yeah, but I'm certain that if all of a sudden they were reclassified as retail from being wholesale, they would be concerned. So I think they should be consulted. There should be some, at least, evidence sought from them to inform this process, I think.
Yep. Yep. Mr. Knapp?
Yes, thank you, Senator. I think that absolutely there needs to be an independent survey that will provide us with the level of intelligence that we need to how this will impact and how the market feels it'll impact their investments and current future opportunity to participate in the investment environment. If we're trying to protect investors' choice and investments in this country, I think we need to be exceptionally clear. Currently, anyone can invest in the stock market, which will either result in a positive or negative outcome depending on their investment. There's nothing restricting that. What we would certainly encourage is that any changes to the current regime does not trigger a marketable impact, which will be extremely negative to investor returns, because what we all know in this current economic cycle, which is very long, there is a huge disconnect between the valuation of unlisted funds and listed funds globally and in Australia. And what we don't want to do is trigger an event which creates significant losses to the current market and forces investors into a new regime that may alter that equation.
So you're saying pushing them to an unlisted market without any of the scrutiny?
I'm saying that we need a long time frame to be able to make a change that is appropriate so we can move through the proper economic cycle.
So I think, Mr. Knapp, what you're referring to is the inherent nature of a lot of property investments is that they're illiquid. You can't just crystallise the value, and you've got to make sure you don't crystallise the value potentially at the bottom of the market.
Correct.
There are also tax consequences that need to be taken into account. So there needs to be great care if these changes were implemented in terms of understanding the investment cycle, grandfathering, transition. Is that correct?
That is,
or is it more than that?
No, that is exactly the point.
Yeah.
And if we don't necessarily, we haven't made in our submission reference to grandfathering, but I'm sure we'll discuss that in this hearing. But essentially, if you do have a proposal, it needs to take into consideration the full economic cycle, so that investors have the time and the appropriateness to exit the market where there is not a significant loss.
Well, I think we had evidence, I think, Chair, from Ms Medley, from Herbert Smith Freehills, who talked about the danger potentially of a wholesale investor being recategorised as a retail investor overnight and leading to and acting as, in her words, a poison pill in terms of a managed investment scheme requiring it to be the assets to be liquidated and a threat that poses. So that would apply in a property market context, presumably?
Yes, we are highly susceptible in this market to any changes that require a sale of assets at the wrong time of the market.
Yeah, okay. Mr Newman?
Look, I totally agree and echo that has been said. Probably just another bit of context, though, around your question. What does this entail? How many Australians will be impacted? So we've got the ASIC recommendations, which are a bit lower than the FSC, say, $5 billion recommendation. But, just do the math. If, we were told it was 2% back in 2002 that qualified. Now it's about 16%, and these proposals are supposed to take it back to sort of where it started. So we're talking about hundreds of thousands of people. We might be talking over 1 million Australians.
Yeah.
Okay, so they have to be consulted, absolutely too right, and they haven't been, and they don't know at all. I suppose my final point is our investors, I would, from my discussions with them, be prepared to say to you that they'd all be very unhappy if they couldn't do this, because they don't want to invest in REITs. They come to us because they like, say, buying a fuel station or a childcare centre, but they don't want a big industrial shed, or vice versa. So they want to be able to pick and choose rather than just have someone serve up what's best for them.
Correct.
So
yeah.
Again, it's this choice thing as well.
Yeah.
So they would be against it from that point of view.
And just to move on to another topic, the other question is, so there's the numbers, the absolute numbers of Australians who would be, if there's a recalibration of these tests, would move from being classified as a sophisticated investor to becoming a retail investor. So there's the numbers. There's also the proportion that are women, or proportion that come from other, from say culturally and linguistically diverse groups, right? So it's not just the numbers, it's also whether or not there's any disproportionate impact on women, for example. And we've had previous discussions in relation to the gross income test. And if you increase that from 250,000 to 461,000, how many women would that impact? And also, if a woman has left the full-time workforce or a small business or whatever to provide care, in whatever context, they could be disproportionately impacted by this recalibration. So keen to hear your views in that regard.
I'll be quick. I said before, the stats show that women are better educated in terms of tertiary qualifications than men in this country today. But the stats also show that women's net income and net assets statistically are lower than men. Okay, so there's no doubt in my mind that women who, arguably, there are more women who have the smarts to make investments, but it's clear to me that that's a fact, but it's clear to me that they're the ones who bear the brunt, particularly of any sort of poorly thought through changes to these criteria. And probably just to tackle one thing while we're on this subject, this issue about netting out the family home. Well, I just had lunch today with a dear friend who lives here in Sydney, in Manly. He and his wife are well-to-do, but they rent because they deploy their money in all sorts of investments. So, if the family home is to be netted out, then, say, someone of equal wealth and standing might not be able to invest. Other friends of this particular gentleman and his wife, they might not be able to invest, but this couple will be able to because they're renters. And so, I just say to the committee today, Senator O'Neill particularly, a net assets test is a net assets test. If you've got a $4 million house and $3 million worth of debt, you've only got $1 million. I mean, I'm not meaning to sound condescending or patronising here. That's the fact. But a lot of the submissions have gone, oh dear, there are these people who've got a lot of money in houses. So if we go back to this hypothetical lady who's been in a divorce settlement, you're referring this to this morning, Senator, yes, she's got the house, but that's not allowed in terms of assessment for wholesale criteria. So she's out of the game.
I'm going to put on the record my concern is she might not have the house. That seems to be a bit of a myth. It closes off the story.
Well, I hope she does.
Well, we all hope that, but I don't know that the facts bear that out, which is also of concern.
Mr. Knapp? Oh, sorry. Oh, we'll go this way.
Okay.
Mr.
Sorry.
Knapp?
Thank you, Senator. Thank you, Chair. Just to expand on Mr. Newman's point there, what if you're a farmer who has a dual-use residential commercial asset and that is excluded? That will very much limit significant amount of Australian population from actually having access to investments that are appropriate for them. And in answer to your question, Senator, the Property Council is very strong on diversity and inclusion. It's a major part of our mandate. Anything that disproportionately affects women, we would not support.
Okay. Mr. Preston.
Thank you, Senator. As part of our submissions, we've suggested that a regular review process would be beneficial. I think the starting point for that review process is obviously considering the consequential impacts on all stakeholders. And they're sort of classified as investors on the one hand, but there are a lot of subgroups of investors that can be impacted. And I think if a process were to be developed that were, say, a regular 5-year review, if it had some guidance to consider all stakeholders and the impacts on them, I concur with the comments that obviously happened yesterday in one of the sessions that if there is sudden change, it will bring market impact and across the board type of thing at a capital raising level, at a seeking new capital and new entrance to the market, and then ultimately the investors, I think, as was said earlier, Senator, should be part of the process in terms of understanding what they feel about being reclassified. So there's a few things in that. Sorry.
I want to move on to this area of what is trying to be addressed with these changes. What's the mischief? What's the evil? What's the ill that these changes are trying to address? And if you go through the ASIC submission, I think they raise the Mayfair 101 case as a case where investors who may have been wholesale investors were, under current classifications, were specifically targeted, and therefore, I guess the argument is, and this is where I'm seeking your response to the argument, that one way to protect people is to simply change the threshold. So if you didn't meet the threshold, you wouldn't have been exposed to Mayfair. Put it as simple as I can. I'd like your response to that. Does it flow that people lost money in Mayfair 101, therefore we need to increase the thresholds to 4.6 million and 461,000 a year?
Senator, to the extent that that involved misleading and deceptive conduct and all sorts of other things, the breaches of the law, in other words, which I understand from some of the circumstances of that matter, why should the whole of the market change because of that when there's other legal avenues for protection through that process? So it's a small portion of the entire market of investment. So I think with the law and the regulation through ASIC and breaches and the powers of ASIC has to deal with these things, I don't see it as a pathway to just changing thresholds.
Yep. Mr. Knapp?
Yeah, thank you, Senator. I agree with that. Changing thresholds doesn't make you a better investor. What makes you a better investor is if you're more informed. So education and understanding and developing a platform which allows individuals to understand what they're actually getting involved in would be more appropriate than actually raising the thresholds. So an education process where we can work with ASIC and do the analysis that's required to provide people with the power to understand investments is where I would recommend we go.
Okay. Mr. Newman?
Look, I think, I put it like this, that dishonesty is dishonesty wherever it is. You know, if there are people who are shonky and are going to break the law, they will be there wherever they can get their hands on the funds. And just having a retail licence or having investors reclassified as being retail doesn't protect them against crooks. A strong cop on the beat does. So I want to be very clear today. I don't have a problem with, ASIC in a sort of a forward-leaning way being a proactive financial cop on the beat, scrutinising not just the big end of the town, but the Arcana capitals of this world. We've got a licence. We've got significant obligations, which we believe we comply with. But I get that if they knock on the door and want to audit us, that's appropriate, and that's what should be happening. One final point is that, it sort of pains me to see time and time again stories in the media, and also see it, in social media and being advertised online, things that are clearly scams. Okay. So that's out there, it's happening. I have reported to ASIC in the last 18 months on behalf of my firm, an organisation who is essentially spruiking property schemes, clearly didn't have an AFSL. So they're out there, and they were probably doing it in ignorance of the law, probably providing something that might have been a good product, but they didn't have a licence. But there are also these people, outright bandits out there, really just trying to sort of extract people's money from them, and that needs to be the subject of significant attention right now. I think that's, this is about regulatory priorities and resourcing to go after the baddies.
Yep.
Two questions, if I can. There.
Yep, sure.
Clearly, one in terms of scams, we are actually starting to have some impact, and certainly the community is much more aware, and there's more resources being thrown at that. But arising from your commentary there, I don't know what ASIC's appetite would be to do more policing, and what the cost of that would be, and where they would stop doing something else to take up that role. That's the first thing. I expect that's a response we'll get from them, saying, no, well, that's why we have to have this change, because we can't be out there chasing down Arcana. We can't be down there chasing down these small things. We need to set up a system that's going to prevent the harm, and that's the first part of the rationale for doing something, I expect. The second thing is, when you made that report of your concerns, did you get any feedback from ASIC?
I'll deal with your latter question first, Senator. That's a really interesting question, because no, I found it a really challenging experience, because if you go onto the ASIC website, and maybe I didn't know, even though I'm in the sector, didn't know exactly where to go to, but I said, right, I've got a problem. I see someone doing the wrong thing. I want to report something that's clearly, in my view, outside the law. And it was quite hard to find out where to go, because when I went in to lodge a complaint, it was all structured towards me as an investor, or being fleeced by someone. That's how it was set up. It wasn't set up for me to be able to report.
It was no
firm.
Crime Stoppers.
It wasn't set up as for a firm in the industry, in the financial services sector, to go, here I'm reporting some organisation who's doing the wrong thing. It wasn't set up. Maybe it is now. My apologies to ASIC if I've got that wrong at the moment. But to the first thing you're saying, look, leading with my chin perhaps, the paper chase that is now in the retail space, DDOs and TMDs and that sort of stuff, I personally do not believe that is the way to actually best utilise the time and effort of ASIC in that sort of system, because it is a paper chase. It is well, let me give you an example, Senator. A product disclosure statement is a very long, complex document, as I said before.
We're familiar with those,
Yeah,
and the whole psychology behind them, and the failure of that psychology.
Yeah, and so, but the people who have to get a PDS are the least likely to actually understand the PDS or read it.
Mm.
So the paperwork approach of ASIC is incorrect in my humble opinion. They would be better. They would, if if it was all done the same way, wholesale or retail, but their resources were, instead of those resources to the box ticking and the checking, were directed to, look, we're going to walk into this financial services firm and we're going to do an audit. That's, in my humble opinion, how you weed out bad behaviour in financial services.
The PCAOB in the US is declared sometimes as the peekaboo regulator, because you never know when they're going to come in and want to have a look at what's going on. And clearly that has some impact, even as far as to outreach here to PwC in Australia and
it would focus
KPMG.
the mind, Senator. It would focus the mind like nothing else.
Your mum's going to come in and bust you. You know, I mean, that's sort of the attitude, isn't it? You want to finish off a line of questioning, and then I've got a couple.
Yeah, sure. And just in relation to that, Mr. Newman, it's important to note, and I think this came through all the submissions, that as you said in your opening statement, just because you're in the wholesale client sphere doesn't mean it's the Wild West. You still have to comply with a whole range of obligations. And using Mayfair as an example, misleading and deceptive conduct applies. It doesn't matter whether or not you're selling products to wholesale investors or retail clients. You still have those fundamental obligations, don't you?
Oh, absolutely. We have to do a quarterly compliance report, which is submitted to our lawyers in Sydney. We maintain a gifts register, a conflicts of interest register, a training register, a breach register. They have to be updated. They have to be scrutinised by the lawyers. We actually have to maintain surplus liquid funds in the bank account, which is checked. We have to provide cash flow projections. It's all there. It's quite onerous, and I mean we take it extremely seriously because of my former role. I'm sure I've got to get it right with my team. I hope that all firms would take it that seriously. And at the end of the day, what our focus is about making sure our investors get the best possible result. So that's what we're about. We're for them. And I did mention how we always invest alongside them. So that's we won't do things that we wouldn't be prepared to put our own money into.
And I think just before I open it up to others to give a response to this will be my final question, Chair, to give you an opportunity. We looked at some of the case studies AFCA provides in terms of their submission, and they contain things like people being incorrectly classified as wholesale investors, or they don't know they've been classified as a wholesale investor. So there's, just fraud, dishonest behaviour, etc., etc. None of that, it seems to me, is addressed by simply moving the thresholds. If someone's going to onboard someone as a wholesale investor when they're not under the existing thresholds, moving the thresholds doesn't change that situation. They're simply going to do the same thing until they're caught, right? So I think, again, it comes down to this issue of what are we trying to achieve here? What's the specific conduct that we're trying to address here? So, Mr. Newman, you referred to your views in terms of what the focus of the regulator should be on, rather than looking at these thresholds. Do our other witnesses have views in terms of where should the focus of the regulator be in terms of trying to address the miscreants, if I can call them that? It's probably more than they deserve, such as Mayfair 101 and some of the others that are referred to in the AFCA case. What should the regulator be focused on in terms of getting better results for the Australian investing public?
Maybe Mr. Vine.
Yeah, so I think so most of the AFCA cases, and even as some of the submissions have identified, a lot of the managed investment scheme issues have actually been more in the retail and often involved fraud, which is not really an issue that's going to be identified more readily because a fund is wholesale as opposed to retail, or changing the threshold so there's more retail clients or funds. And if the issue that as identified by AFCA is the misclassification of investors, then at least in relation to wholesale, if there's concern with that in the wholesale sector, presumably checking that that people have the relevant programs and compliance for ensuring that that's being satisfied, as opposed, because we're not talking about changing, the proposal isn't about changing drastically how the tests apply, it's about just the thresholds.
Correct.
It's not really it's more sort of whether the appropriate numbers of people are caught.
So if someone's procuring a fraudulently completed certificate under threshold A, it doesn't matter if you double the size of threshold A, they just procure a fraudulent certificate. Is that correct?
Correct.
Yeah. Mr. Preston?
Thank you, Senator. Is it not the case, Senator, that there's not a link between misdemeanor or fraudulent behaviour and the thresholds themselves? They're two separable things, but I mean the powers of ASIC with the corpse law and also regulatory guides. I know that a lot of those were amended post-GFC in another decade for other reasons. There are other measures to bring governance and compliance to... But the other thing that...
But again, if someone's a crook, they're a crook.
That's my
right?
point. There's a disconnect.
You increase the regulation on a crook. Okay, well, you've put another security door I've got to get through in order to get the prize, whatever I'm seeking. It just seems... It doesn't seem to be necessarily the right approach to try and eliminate the crooks from to the extent we can from the investment market.
To my mind, Senator, that's the disconnect. Like the majority of people aren't crooks in the industry,
Correct.
In the profession. So why should they be affected by governance that is seeking to deal with the few that are exercising in misleading and deceptive conduct and so forth?
And that has, it's not just in terms of the costs they incur, but those costs have to be passed on to the extent they can. And Mr. Newman's given evidence with respect to the fact that investment opportunities might be lost altogether, but those costs are passed on to the investor.
Yes.
Yeah. Mr. Knapp.
Yeah, look, I think I sort of agree with ASIC's position on this, and there needs to be, penalties for misuse. And ASIC supports the introduction of penalties and sanctions into the legislation. I think anything that can improve the system and the process whereby we can weed out operators who are non-compliant and who are obviously looking to bypass the law, we would clearly support that.
Yeah.
And I think that's the better way of solving it as opposed to reducing people's choice.
Okay, thank you. Chair?
Thank you very much, Senator. I just wanted to clean up a little on this arbitrary tests that are for wholesale, classification for wholesale investor status and then sophisticated investor status. In your submission to us today, Mr. Newman, I'll just put my hand on that immediately. You indicated that you have accountants amongst your staff.
Yes.
So I want to ask you, do your accountants provide a service of verification of people's financial eligibility for wholesale?
No, not at all, Senator. What happens is, we are merely a product issuer, a creator and an issuer.
Yep.
We provide general product advice, so we advertise in a way that says this is only for wholesale investors. We try to be scrupulous about following the ASIC guidelines about making sure our promotional materials stress that, website, etc.
Yeah, but in terms of your accountants, can they look at somebody's books and state, their gross income test is met, the assets test is met? Will they?
No, not at all. So what happens is when an application is made, we say, let us see your wholesale investor certificate, and we make sure we've got that, and that is saved and stored, and we then review at the 2-year mark and get another one. So I think that's really important, because I think...
But your accountant doesn't provide that service internally, so there's a separation.
Absolutely. I think that would be an unacceptable conflict of interest.
I agree.
Yeah.
But nonetheless, these things called quacks are a really important tool.
Absolutely.
And there is some discussion about them. If I can read you the statement from the accounting bodies, there's a joint submission from CANS, CPA and IPA, and their suggestion to the committee is to eliminate accountants' certificates, which is, you know, one of the things that's celebrated by the wholesale investor group, to say this is a, you know, an arbitrary and clear, bright line that tells us this person is satisfactory. Yeah. But there are some limitations on it, Mr. Newman, because it's a moment in time.
Yep.
Monday, day 1 of a 2-year period. By Friday, day 5 of a 2-year period, that asset declaration could be completely out of date. And then you seek a 2-year renewal, right? So this is the way it's being used in the sector. You're not extraordinary. This is the way it is used. So what do you say to the accountants who say, you know, this is putting risk on our accountants rather than ensuring that people like yourself should be carrying the risk for operating your business?
Well, I note, for example, the Society of CPAs have had that position. My sort of response or understanding of what they're doing there is it's probably to do with professional indemnity, and they don't wish to wear that. Having said that, my own CFO and business partner, Christina, who might be listening today, she is a member of that society, and she can't believe that they put that submission in and she didn't get consulted, she claims. So she believes there was no flyer that went out saying this is going to be our position, do you agree? And indeed, other accountants that we deal with are quite happy to issue these certificates. I note that
how much does it cost to get a quack?
Oh, that's a really good point. I don't know, Senator, but I can tell. But I only found out recently that a particular accounting firm that had clients that came to us was charging, and quite significant dollars, as I understand it. It wasn't cheap. It was over $1,000, but I don't have a precise figure. And they were taking it very seriously. I suppose to their credit, they would get the client in, had to come in for an interview, and go through a real process. But I'd make the point that generally any accountant who's working for a client should know the financial circumstances if they're doing their job properly, and you know, I believe they should be prepared to make a call, but that's up to them. We do on occasions have accountants who have refused to give clients certificates, and we haven't been able to take the investment dollars. So we've had people say, look, I wanted to invest, but my accountant wouldn't sign off. So that's the way you roll.
Mm-hmm.
So the idea, though, that we would assess it, I think is a completely unacceptable conflict of interest. The product issuer cannot be, you know, sort of signing off on the wealth of the client like that. I think that's really problematic.
Okay, yeah. That's helpful. Then there is this potential educative piece, which has been quite a degree more substantial than I thought it would be when I read the preparatory documents. There's been quite a discussion about what an appropriate education might look like, from micro-credentials for particular asset classes and products to, RPL for existing knowledges, access with high level of knowledge with a small transition, becoming part of a angel investor group, having finished a period of time there. Further information this afternoon about courses that people can do. To avoid any conflict of interest, so that you didn't farm your own students for funds, where might an appropriate body to verify education sit in the ecosystem in a way that you could access it and that you would trust it?
Senator, if I may, the PFA is supportive of an education process as a fundamental principle. We haven't gone to the point of thinking about the how or who might be the appropriate body to do it, but I would like to take that on notice, if I may.
If you could.
And come back in writing.
Because Mr. Newman's example, who was unable to get his quack,
yep.
Even though he might have had the $1,000 or more to pay for it, may have had the opportunity through another means, through education, to actually prove his suitability if that was an option.
Yes.
And this is an additional limb, I think it's been described by others, as a way to deal with the fact that we have an increasingly educated population, and that the arbitrary determination that a person's salary or their assets is an indication of capacity to determine good product choices for investment is an embedded historical assumption that has not been proven by fact yet, and is exclusionary. So this is a moment, I guess, for us to think about what an anti-exclusionary option might be that minimises risk, maximises opportunity, and deals with the real problems, which is access to capital that seem to be plaguing parts of our economy at the moment. Do you have a response to that, Mr. Newman? And I'll come to you, Mr. Mayor. Newman first.
Oh yeah, okay. Thanks, Senator. Look, I think it is a great idea as an extra limb. I would still be looking for some other pathways as well. In terms of addressing the specifics of your question, giving you an example back, I have two young guys who work for myself and my business partners in our business. One's got a master's in business, the other one's got a first-class honours degree in finance. He, for example, has worked in Arcana for 5 years now. He's out there working side by side with me to create these financial products. On the wholesale investor test, he can't invest. Now, on the sophisticated test, he can invest if we make that judgment. Now, I'm prepared to acknowledge today that we have used that test in his case and his colleagues' case because of their activities in the firm, but they're only in their 20s. Now, our lawyers have said, the compliance lawyers I'm referring to, who are just down the road here in Sydney, they have said, don't use the sophisticated investor test. It's too much risk.
Yeah.
So, yes, Senator, I'd love to see this other limb.
And that's a very, very helpful example because it is young people who are increasingly literate, who seem to be knocking on the door trying to get into something to grow their wealth in a way that investing in property was perhaps an opportunity for another generation. Yeah.
Or investing in a principal place of residence.
Absolutely.
Opposed to property investment.
There's the other extreme too, where young people may have done a commerce degree and a master's degree in applied finance that are very well educated in this whole arena. So would they be exempt from such a test if they've studied it and they might be 28 years old, not have any money or not have saved significant savings, yet they're highly experienced working for Macquarie Bank or another major fund. So I like all these things, just need to think through the consequences and how it might apply in practice.
Yeah. Or if you've got a nuclear physics degree.
Correct.
It doesn't mean that you can't transfer the capacity to think from one particular knowledge domain into another.
Yes.
Okay. The other thing from Arcana, opting out of the retail investor framework after an appropriate declaration by an independent accountant or advisor. This is one of the more innovative things that we've come across, Mr. Newman. There is some risk, considerable risk in that. Why did you proffer that as a recommendation?
Well, Senator, I'm no longer a member of the Liberal National Party. As Senator Scarr knows, I'm actually a libertarian, and that's important because I have a particular philosophical attitude to this whole question, and I should declare it up front. So I would prefer an investment and financial services regime in Australia that allows people greater freedom to make their own decisions. Okay, so I do need to say that up front in answering this question. But what I believe, and what Arcana believes, is that people should have the opportunity with a financial advisor, independent of any product issuer, to sit down and say, well, why can't I invest in these things over here the financial advisor should have a proper process, protections under the law, where they can take them through that process and say, well, you can invest with an Arcana or some other fund, but this is what you've got to understand. You've got to go through. You've got to understand these are the consumer protections. No access to AFCA, etc. And these sorts of, it's all spelled out, and they're taken through it, and then it's a sign off, and then they can come forward with this sort of certificate to say, well, I can invest. But it's got to be independent of the product issuer. So, that's what we were sort of simply proposing. I have a real problem.
There'd be a nice business for a shonk in doing that, Mr. Newman.
Well, Senator, I've got to agree. You're probably right.
Yeah.
But again,
and it approximates the PDS problem that we see all of the time. Give everybody the information. That is counterweighted in terms of public policy in a much safer way by the arguments for an education process, which could happen across a range of ways, not just read the information like a university qualification and do the exam at the end, but through a partnership with angel investors, learning alongside, experiencing the learning and talking about it through a discursive practice, which is probably particularly important for particular kinds of learners and people with English as a second language from culturally and linguistically diverse backgrounds, that it's not just read the book, do the test, because that is actually quite discriminatory for some very sophisticated, high-level thinkers who would be absolutely able to manage themselves well in a wholesale investor context. So I'm glad I asked you the question. So it's a philosophical argument, not a practical one.
And in a slight response, I think we've said this a few times this afternoon, there are crooks who will always be crooks, and that's why we need the cop on the beat actually conducting this active surveillance and enforcement, and that's where the efforts of our regulator or regulators should go.
We all like the cop on the beat. I just don't want to provide a house for the villains to live in accidentally.
Very good.
Okay. All right.
Senator, can I just throw one thing in that's a bit random? Probably should have said it earlier. How many Australians know, as a proportion of the population, that they should only go and buy a financial product if it's from someone with an AFSL? And I would just assert that that is something that requires education. There should be a campaign that says, if you are looking to invest, make sure that these people do have an AFSL. I don't think Australians know that.
I'm pretty sure you're right. Yeah. Can I put on notice for all of you a question that the Secretary will send with, in light of our inquiry into financial abuse? Catherine Fitzpatrick is working with a large number of senior leaders in the financial services area to help with the concept of creating product that is safe by design. And the application of a lens of safety by design for the products that are currently in the market is something that I'm encouraging all of the submitters to think about in the context of the product that you're particularly interested in offering, because we know that on domestic violence translates in a very different form post-separation from intimate partners to using every other avenue, and products in the financial services space are absolutely being weaponised against intimate partners at that moment. And we need to think about this as a system, I think, across the nation, because, sadly, Hannah Clark's demise, and I know, with my colleague from Queensland and with your former role, Mr. Newman, the Queenslanders' incredible loss, the loss of that beautiful family. That was the first moment of domestic violence, physical, that led to her death. All of the assault on her was through coercive means, including financial coercive control. So I just want to raise that with you and ask you to think about that and perhaps give us some feedback in addition to what you've given with that lens.
And I think, Chair, it'd probably be of benefit to the witnesses for them to know that this committee's conducting an inquiry into that issue around financial abuse. So that's the context, I think, in which the Chair's seeking.
And there's a lot of evidence already on the record there, and there'll be a report soon.
Is there a discussion paper or
something
that we could have a look
and
at?
We'll get that to you from our Secretariat. Yeah, wonderful. Thank you very much. And I now call our next witnesses. from Chartered Accountants Australia and New Zealand, the CPA and the IPA. We sure have. I'll be back in about 5 minutes. Okay. Thank you.
Okay. You're right. Thank you, Kane. Okay. I now welcome Mr. Tony Negline. Is that how I pronounce it?
Negline's fine, but it's actually Negline. But
Negline.
I'm used to lots of different
pronunciations. No, we'll get it right on this committee. Mr. Negline from Chartered Accountants Australia and New Zealand, Mr. Richard Webb from CPA Australia, and Ms. Vicky Stylianow from the Institute of Public Accountants. I understand that information on parliamentary privilege and the protection of witnesses giving evidence Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today? Mr. Negline.
Tony Negline. I am Superannuation and Financial Services Leader at Chartered Accountants Australia and New Zealand.
Thank you. Mr. Webb.
I'm Richard Webb. I'm the Superannuation Lead at CPA Australia.
And Ms. Stylianow.
Yep, Vicky Stylianow. That's fine. Group Executive Advocacy and Professional Standards at the Institute of Public Accountants.
Okay, so I will now invite each of you to make an opening statement if you would like to. Mr. Negline?
I think actually Mr. Webb will lead us off, if that's okay.
Oh, okay. So, Mr. Webb, this opening statement's on behalf of all three organisations?
That is correct, Senator.
Okay. Sorry, I just want to get that for the
I'll
record.
Start and we'll take turns. So, if that's
okay.
Yep.
Excellent.
So, we wish to express our gratitude for the opportunity to address the committee today. It is much appreciated to be able to present our views on the current regulatory framework governing wholesale and sophisticated investor client tests. The members of our association support a strong regulatory framework that seeks to improve investor outcomes, promote investor confidence, and maintain financial stability while supporting choice, competition, and innovation in the market. Our general view is that wherever possible, protections that are available to one group rightly identified as needing them shouldn't necessarily cease to apply upon the application of tenuous criteria such as the quantum of investment monies. However, we are also aware that there are arrangements necessary to enable the fast movement of funds, and we would agree that this should continue to be enabled for investors who are less in need of retail protections. As part of a strong regulatory framework, we believe much needed updates are necessary to the current wholesale and sophisticated investor client tests, particularly the thresholds for each of the tests, which have not been amended since being implemented over 2 decades ago. These thresholds are crucial in ensuring that the regulatory framework remains robust and reflective of the current economic environment.
In our submission, we recommended the provision of so-called accountant certificates be removed as a requirement because it is outdated and shifts responsibility for financial advice or consumer obligations away from financial advisors or product issuers. Accountants in public practice are normally unable to provide financial advice, and the risk associated with providing these certificates does not vest with the entities who should carry these responsibilities. We also recommended that the product value test be increased to $1 million and indexed. The product value test threshold has remained static for too long, and increasing it to $1 million and indexing it annually will ensure that it remains relevant and reflective of economic changes. The net asset test of the individual wealth test should also be similarly raised to $4 million in net assets, and the gross income test threshold should be increased to $350,000. These should be also be regularly indexed. We arrived at these increased values taking into account the growth in assets over the last 20 years, such as residential property and the Australian share market, and also the growth in average earnings and so on. The family home should be excluded from the net assets test. Including the primary residence in the net assets test can be misleading since it does not normally form part of one's investable assets. Excluding it provides a clearer picture of an individual's financial situation, as does removing money preserved in superannuation, since these benefits are unable to be accessed until a condition of release is met.
We believe that the gross income financial threshold should exclude capital gains, employment termination payments and franking credits. These components can distort an individual's normal income, which is what we believe the gross income test is intended to capture. The exemptions provided under Chapter 7 of the Corporations Act are considerable when providing products to wholesale and sophisticated investors. As a result, we have also recommended the introduction of a requirement for individual consent to be treated as a wholesale investor or client. Ensuring that individuals consent in writing to being treated as wholesale investors will enhance transparency and protect investor rights. These should also come with standardised language to better ensure that wholesale investors are fully aware of the rights that they will cease to be able to access. We believe these amendments will strengthen the regulatory framework, making it more effective and reflective of current economic realities, whilst balancing the needs of all stakeholders. Thank you for your attention, and we look forward to your questions and further discussion.
Okay, thank you very much. I might just open with a question, and you were here. The benefit has been you've been here for some of the previous sessions, which gives me an opportunity to put to you some of the arguments and points that were made by previous witnesses in order to give you a chance to respond. And feel free, if I ask you a question where you'd like to take it on notice or reserve the right to provide a further, more elaborate answer in the fullness of time, in the event that you want to undertake some consultation with colleagues or what have you. So the first question I want to ask is, and this is a question we've actually asked to a lot of witnesses, what process did you go through in terms of ascertaining the views of your membership regarding these issues in terms of their perspectives, given their own individual client bases, and different members of the profession will have different client bases? What process did you undertake in terms of formulating the essential elements of this submission with respect to the recalibration of the thresholds, firstly, and secondly, with respect to the provision of the, I think we've been referring it as a quack by the profession. Mr. Negline?
Well, just to state on the record, I've never referred to an accountant certificate as a quack. So I've never.
What do you refer to it as?
An accountant certificate.
Oh, okay.
Yeah.
All right.
Yeah. That's all we refer it.
Why are we calling it a quack? Oh, okay.
Yeah.
So there's a bit of committee history to that.
Yeah. Okay. Yeah. Sorry.
So accountant certificate.
Yeah, accountant certificate. Okay. So the first is the thresholds. Okay. So we considered since the early 90s and also since 01, when the various thresholds sort of came in, the 500 or the 2.5 and 250 grand, when they came in, we considered average increases in average weekly wages, the change in the ASX 200, both at a capital level and also at an accumulation level,
right.
Median house prices, CPI, and so on. So we looked at all of those and we said, okay, what have been the increases, and what would be a reasonable level of outcome based on those, based on what we can observe from that. So that's how we arrived at those numbers.
But did you actually, and I'm just trying to get the evidence on the record, did you actually go out to the members of your organisations to obtain their views with respect to applying the obviously considered process you engaged in in terms of formulating the new thresholds? Did you
So
you go out to the profession, the members, to obtain their views?
Yeah, it's a very good question, Senator. So for every consultation that we're involved in, and I look after superannuation and financial advice, and other people look after tax and so on and so forth, as you would expect. For every consultation that is conducted by, whether it be by the government regulators or by the Parliament, such as this one, we send out a weekly email to our members about what's changed, what do you need to know about, so on and so forth. And in that, we ask for feedback from our members to say, there's this consultation going on in relation to wholesale and sophisticated. We would like your feedback, so on and so forth. We regularly get asked questions by our members about, whatever it might be, accounting standards, legislation, whatever it might be. Accountant certificates we get asked a lot of questions about those. So we have a lot of knowledge about what our members think about them already.
Okay. Yep. Good. Mr. Webb?
So I guess we get a lot of feedback from a number of areas in relation to accountant certificates, and for a variety of reasons. So just expanding, I guess, on what I would imagine goes on with my colleagues at the Chartered Accountants Australia and New Zealand, we have a number of committees and groups that are set up across various different sectors of interest, across various different geographical areas of Australia. And also we have various different parts of our business dedicated to various different functions. And one of the things that I suppose comes through quite a lot, and I will admit that there is, of course, I guess, a bias in this in terms of it's really only going to be the members of ours who dislike them that are probably going to raise concerns. But admittedly, they do raise a lot of those considerations, and we felt that some of those considerations, such as, well, I'm not actually responsible for anything in terms of this investment, but I'm required to do this.
Well, can I just hold you there? You're not required to do it. You're as a service provider. Someone asks you for it. If you isn't the answer to that, well, if you don't want to provide it, you don't have to provide that service. Like, you don't have to provide other services if you don't feel comfortable providing that service. Why? And your client can go somewhere else to get that service. Why should you have a blanket prohibition or change the regulatory regime because certain members of a profession don't want to provide that particular service? Am I being overly simplistic?
No, look, I don't think it's overly simplistic at all. I think, it's quite reasonable for an accountant to want the best for their client. And I think if they feel strongly enough that they don't want to actually sign off on an accountant's certificate because they believe that their accountant's not in the best possible situation, it's up to them to make that decision. But at the end of the day, an accountant's certificate, for all intents and purposes, is meant to be a statement of fact, and it's not really meant to be for an accountant to actually kind of put an opinion on that, especially since there may actually be questions over whether or not they've inadvertently provided financial advice in the process, which is not what most accountants do.
Okay. I just want to tease this out, and the other witnesses, feel free to jump in if you want to provide a perspective in this regard. When I was looking at this, and maybe there's uncertainty in the law, but when I was considering the issue of this accounting certificate, it seemed to me, and has been referred to as being intended to be an objective analysis of value at a particular point in time, a bright line test which isn't subject to subjectivity and therefore is less risky than perhaps someone opining as to whether or not someone's a sophisticated investor or not a sophisticated investor based on their experience and knowledge. And yet there seems to be a view in the profession, or amongst a good number of your members, that there's a risk that it crosses the line into the realm of financial advice. What's driving that concern? Are there case studies of accountants being sued on the basis of provision of accountant certificates, or the regulator taken any action, of people being reported for misconduct? What's driving that concern, just so I can better understand it?
I can't comment on that myself. This is not an area that I work with. That would be taken care of by a different area of CPA Australia.
Okay. Can the other witnesses provide any insight into that?
I think that the corporate regulator, ASIC, would be probably better placed to answer those kind of questions. Certainly, I can speak for the IPA. We've had a long history of members raising the accountant certificates, and they're problematic because it's not necessarily always black and white. Whilst the amount for the thresholds may be black and white, how you get to those thresholds is not necessarily clear cut. For example, we get a lot of questions around superannuation. How do you treat different components? There's different asset classes. How do you treat them? How do you not treat them? In all of that assessment, you've got to make sure you don't stray into giving financial advice. And to add to what Richard said as well, we've gotten, and this goes back to more than a decade in my experience dealing with members in this issue that comes up all the time, it's a lot of clients come to their accountant. The accountant feels they want to help the client, but they may not necessarily be able to. The clients put pressure on them, and it's not great for the relationship between the client and the accountant, which is something I think that other sectors may not appreciate. It's not so black and white, here's sign off. You know, accountants have a code of ethics that they have to adhere to. They have to act in the best interests of their clients. So there's a whole lot of other things at play here.
Well, this committee has a lot of experience in terms of looking at those issues.
Professionalism and ethics.
Mr. Nicklon.
Alive and well in some sectors, but not everywhere, right?
Mr. Nicklon.
Yeah. So just to add to what Vicky just said, yes, the thresholds are clear, but that's where the certainty ends in relation to assets that are included or excluded, as Vicky said, but also at the income level. We regularly get asked questions. I mean, a classic example is, I've been asked to sign one of these things from an income and asset test point of view. The clients earn franking credits. Should I include those? It's those tricky things. So it just says the gross value of income over a 3 year averaged over a 3 year period. There's very little definition. So what then happens is that our members will go get legal advice. And of course, being a lawyer, you would know this, Senator Scarr. Get two lawyers in a room and you get three opinions.
Well,
so
I would have thought you include franking credits because it's gross income.
Well, is it gross for tax purposes or gross for general accounting purposes?
I'm not sure. I'm the one asking questions here.
Yes. but that's what I'm saying. So some of them, some of our members are sitting there saying, well, at a tax level, I probably would include it, but are we talking general accounting principles here? Okay. So that's the problem. But
so also, the bright line is not quite so bright. It's a little muddy by the sounds of things.
That's 100% agree.
Well, couldn't you? Isn't an alternative to abolishing them to actually providing some guidance as to franking credits is an obvious one that would be recurring, right? Don't you simply provide additional guidance with respect to it? Isn't that one approach to address it?
Well, we're an association and we can help our members, professional association, and we can help our members comply. Yeah. But we actually can't provide them with advice. That's straying into the area of legal advice. So we kind of don't want to. We kind of can't go there. All we can do is just say, look, as best as we know, here's some information that's been prepared by lawyers. You probably need to consider getting your own formal advice because it's your own PI and business and so on at risk. And professional standing, and that's where the sector finds itself, and that's one of the it's the lack of certainty, and as Vicky said, clients walk in and say, I've had this great investment presented to me, I'm sure everything based on everything we've heard over the last couple of days, and yes, some of the 20 or 30 people listening, we've heard lots of people in the wholesale sector saying, there's nothing to see here, move on, and we're sure that's fine. And that's great. And so clients get asked, approached about these investments. That's great. And then the accountant's sitting there going, okay, show me all the evidence about. I've got to gather the evidence where I can justify signing one of these certificates.
Can I also, Senator, take you through just...
Sorry, Mr Webb, this is for the benefit of the tens of thousands of people listening to us.
My apologies. Yes, thanks, Senator.
Few listen, but many are impacted.
Well, very much so. But I suppose in a lot of cases, what will happen with some of the larger providers of financial products and or advice, and in a lot of these cases, it'll be this entity could actually be undertaking either of those, either the provision of the product or the provision of the advice. What they'll do is they'll quite often prepare a pro forma accountant certificate for signing off by the accountant, which will actually go through and specify what it wants included in there. And sometimes they will say specify the family home, sometimes they won't. It all varies from time to time. There is no standardisation on this. Wow. What's an accountant to do if they're being asked by a client to sign off on certain things that support the document that's been put in front of them?
Act ethically or lose the business. That's what you'd hope they do, but pressure is operating, isn't it?
Well, it is. But what is acting ethically going and perhaps declining to do this on the chance that your client's going to go down the road to someone else's practice who might not necessarily know them quite so well?
Yes. I mean, I guess that is it, right? And then there's more risk for that person, but at least one fundamental person in the equation isn't compromised by doing something that they know is potentially unethical.
Well, let me put it to you this way, Mr. Webb. If the accountants aren't doing it under the model you're proposing, the actual provider of the investment opportunity is going to be doing it, where they've got an obvious conflict in terms of this assessment. Isn't that worse?
What do mortgage brokers do and mortgage providers? They declare someone's income and they look at their income and they sign off on their assets and income and say, yep, okay, you're good to go.
But at least they're brokers in the sense that they've got obligation to their customer.
So does a financial advisor, Senator.
Yeah.
And at law, misleading and deceptive conduct, so does the product provider.
True, true.
And you could also say, this is Vicky Stiliano, you could also say, we talk about manageable conflicts. So listening to some of the other witnesses, if it was simple and straightforward as to meeting or not meeting the tests and the thresholds, you would think that maybe the industry that's involved with all of these people could come up with a simple pro forma that everyone could follow and it would be standardised and people would just follow along, and that's one way of managing the conflict and simplifying and streamlining. If it was that simple, I would have thought that could be done. I mean, we as the accounting bodies have had situations with entities in the financial system to try and standardise documents, and it's been really, really difficult. So we very much see it as a shifting of the risk to a sector that is not directly involved with the investment.
It's curious though, because we have a situation where I say this with qualification, I'd have to check. Everyone appears, all the submissions to this inquiry and all the stakeholders appear happy for the accountants to do this work, except the accountants themselves.
Yeah,
which is somewhat ironic.
We've heard everyone when I think Senator O'Neill, you've typically said, well, how about you guys do it? And we've heard everyone
no.
take a step back. Yeah, we've heard that. It's been a consistent theme. Funny that, isn't it?
Well, the risk doesn't reside with them for that.
Yeah, correct.
And so there's an intersection here between wholesale and retail as well. So wholesale is the cheap to run business. So the one thing that you have to get their business model to work is the tick off from you guys.
Yeah, and
that opens the door to them, right?
Yeah, it's the open sesame, 100%.
Yeah. Where for the retail, it's a very different set of doors that you have to go through.
In actual fact, Senator, we'd actually like to table a document if we have your permission.
Sure, we'd love to see it.
Yeah, we have a few copies here, I believe.
I've already provided them with.
Oh yes, okay,
great.
Thank you. Yep.
So while they're coming to us, can I just clarify something that you said, Mr. Webb, before we get what I think we're getting? Okay, these are the exclusions. The document that you referred to where a product issuer has provided, this is the pro forma I'd like you to fill in, sometimes include the asset of the house and sometimes does not have that. So they're already making a determination separate from ASIC's recommendations around eligibility about what they will and they won't accept in that particular product provider request.
Or advisor request, yes. Correct.
Okay, now that is new. That is new evidence. I haven't read anything of that in my reading to date with what's been submitted. So there's already market differentiation in terms of the level of detail that is being requested of accountants. And what would the typical response of the accountant be? Would they go, okay, well, I understand my obligations and I need to have a look at either one of these elements. You know, houses can be in. At the moment, they are.
Mm-hmm.
I can't actually use this model. Or
they would. Well, sorry, Richard.
Oh, look, I was going to just say before Mr. Negline that it depends on the engagement that the client and their accountant have signed up for. If the client has asked the accountant to fill in the form as it requests to the best of their knowledge, well, that's the engagement, isn't it?
The accountant then has to use their professional judgment. Now, if the request for the certificate says exclude, when you're determining net assets, I want you to exclude, this asset in this particular case, a family home, then one would assume that they are free to do that. Obviously, stating that I have not necessarily included all of the client's assets. That said, the regulatory requirements are tell me what the client's net assets are, which typically does include the family home. So someone has made, who's said don't include the family home, has made their own judgment. Tell us what this person's worth without looking at where they live.
Mm.
Can I ask a particular question in relation to that, the issue of the family home? If the family home say worth $3 million, you're told to exclude the family home. When you do that, do you exclude, say, the mortgage of $1.5 million, which is attached to the family home?
Depends what I would think it would depend on what that debt is used for.
So it's used to
now this is where we come down to this is a professional interpretation. Okay, so this is just me saying what I would conceivably do. And incidentally, I wouldn't be. I'm an accountant, but I'm not allowed to sign these certificates because I don't have a public practicing certificate. So
understood.
Put that to one side.
how many are there who have that public practicing certificate? How many?
That chartered accounts. I'd have to take that on notice, Senator. I don't know.
And
I would also have to take that on notice, Senator.
We've got about 7,000.
Of your total?
It depends on how you measure it, but about 25 who are in Australia and
25,000.
Yes.
Yeah, and 7,000 have this very special qualification.
we have a high proportion who have professional practicing certificates, but that doesn't include those who might be in practice but are not working as principals.
Okay, thank you, Mr. Nicolai.
Okay, so what I would do is, what's that debt being used for? So you might have owned the home unencumbered and decided, okay, well, you know what, I'm going to take a line of credit out of it and I'm going to use that to invest in venture capital or whatever, stocks and shares or whatever takes your fancy. Now that debt is then being used to support other assets, even though it's actually being technically supported by the house. So what I would do is that I would then take that other asset and subtract the debt. That's how I would work it out, because that's what the purpose of that debt is actually being used for. Yeah.
That's what I'd do.
Yeah, but now I would imagine most accountants, from a general accounting principle point of view, would probably take a similar approach.
Yeah. Okay. So you've tabled this document, and I understand it's making the point clearly that there are a heap of obligations that apply with respect to retail clients.
That is washed away from the wholesale market.
But
by statute.
Yeah, but having said that, Mr. Negline, that's looking at one side of the equation. The other side of the equation is if you're going to recalibrate the thresholds to the extent that you're recommending, you are, to use your phrase, you're going to wash away a whole heap of opportunities from that cohort of investors who are currently classified as wholesale investors, who would be reclassified as retail investors. Isn't that correct?
Yes. However, you'd have to have effective grandfathering involved. So those who are in whatever, let's assume that the thresholds do change.
Can I say, if you have that, doesn't it make it worse because you're actually giving the baby boomers an extra bonus for having gotten there first? Aren't you compounding the discrimination?
No, because that's no, I respectfully disagree. So the first issue is you would have to have effective grandfathering. So those who are in would be allowed to stay in, and that's exactly what happens now. So because it's a bright line test, as the senator said at the end of the last session, half a week later or a little bit more, the value of my assets might have fallen, and I might have technically tipped out of the threshold.
Yep.
So that happens now, even though I'd still technically be allowed in. So that the festival has to be effective grandfathering from a certain date, otherwise the whole thing would fall into a considerable mess. Mm. That's the first thing.
And that would need to be varied depending on the product, because some of it might be sort of a short-term investment, but then there might be some property investment that will extend way beyond the 2 years to perhaps 20 years.
Well,
so that moment in time on Monday not only change value on Friday, but needs to last for 20 years in this product, right?
Yeah, correct. Right. And that's what happens now. I mean, you're not in 2 years' time. People who are in a wholesale investment are not getting their assets retested and going, oh, sorry, you've got to get out of this thing. They're once they're in, they're in. Until the investment finishes or they decide they're able to get out and cash themselves out. The other issue is that the wholesale sector is a very, very commercially attractive sector from a regulatory perspective because of all of these things that are washed away. Now, the retail sector is tremendously expensive. Now, tremendously expensive.
Yeah.
Now, I think the ALRC referred a justice. They reported a justice in their report called the Corporations Act porridge. Well, maybe the thing to do is to say, okay, what of all of those rules which we've tabled? If the wholesale sector doesn't need those, does the retail sector need all of them, and which ones come out? Now, I don't have an answer to that question, but it's all those rules which don't include ASIC regulatory guides, don't include ASIC class orders, and so on and so forth. That's just cost upon cost upon cost upon cost. That the wholesale sector just says, oh, I'm out of here, thanks very much. So I can completely understand why there are product providers out there, stockbrokers, so on and so forth, who just say, I just want to go in retail land. I have no educational requirements. I don't have to worry about the ALRC. I've got no compensation scheme of last resort. I don't do DDO.
Oh, you mean they don't? They want to go into wholesale land?
Yeah, they
not
want to go into
retail
wholesale land. Wholesale land. Sorry, I
yeah.
misspoke.
I thought so. Yeah.
That's good commercial sense, isn't it? Really? Why wouldn't you? And then not only that, but also I'm getting accountants to sign a certificate that allows people in my room.
So is it the risk then, Mr. Negline, as we've heard from startup industries in the tech space, medical space, other areas, isn't the risk, if you recalibrate the thresholds to the degree you're talking about, that a lot of those startups who can't access funds from the big end of town because they're simply not at the level to attract the interest, they're going to be deprived of capital and they're simply going to have to take their opportunities overseas into markets where capital's more accessible because they've got different levels of thresholds. And just to buttress that point, as a supplementary question, doesn't it give you cause to pause the fact that the UK went through a consultation process on their thresholds between 2021 and 2023, recalibrated their thresholds, still below what you've proposed, and then within 2 months had to take the extraordinary step of putting them back to where they were because the impact on, in particular in terms of on angel investor startups, was catastrophic.
Sorry.
Mr. Liano.
Yes, thank you. Just to, and this follows on from Tony's point, and I noticed a lot of the witnesses, or some of the witnesses this morning, were also talking about the ecosystem. So the wholesale retail investor discussion is one part of it. Like at IPA, we have a research centre with Deakin University, and we've spent a lot of time looking at the whole question of access to capital, especially for SMEs, startups, and entrepreneurs. And this whole discussion that we're having now is one very small part of it. And, we heard a lot of the evidence, talking about decimation, et cetera, But there is so much more than just this part of the jigsaw puzzle.
Well, do you understand, though, when you say that, we've had so many witnesses and submissions who are in this space tell us it is going to be catastrophic, it is going to decimate certain venture capital funds. People, it's hard enough to raise capital in this country. This is death by 1,000 cuts, one of the earlier witnesses referred to, and you're just going to decimate the startup. Why should I here trying to weigh the evidence? Shouldn't I put a great store on the evidence that's being presented by the associations that are actually specifically representing people in this space?
I think it also depends on the balance, as I say, because, I mean, was there a lot of talk about failure rates, for example? I mean, 1 in 10 startups don't get to 5 years.
So do we prohibit it then?
No, I'm not saying that should be prohibited, but what I'm saying that's the other part of the equation. And using a wholesale retail investor test is one part of it. There are other ways to get seed capital, to get venture capital, private equity into this country. There are lots and lots of
So what are the other ways?
Well, we've got papers on this from Deakin. For example, really promoting collaborations between universities and SMEs and the business sector.
It's too hard. I'll go to the US. That's all too hard.
Well, like the way the United States does it. I mean, we've got entire innovation summits that are being run constantly that talk about how we're going to boost it. We've talked a lot about...
It's a talk fest. I'll take my money to the UK. I can invest there.
Well, it's not a talk fest because there's, you know...
No, I'm playing devil's advocate, right?
There's a lot that's all... We've had the growth funds, for example. Yeah. We've had... guarantee schemes, which is like a guarantee scheme that the government previously had introduced that's been working well and was boosted through COVID.
Sorry, what's a guarantee scheme?
It's where, let's say if you're a startup and you want a certain amount of money and you can't get it from the normal tier 1 financial institutions, that the government will guarantee a certain amount.
Sorry, you mean the taxpayer?
Well, taxpayers, but it's done very successfully in more than 40 other countries that we trade with. So Australia is the laggard in terms of this kind of assistance.
So the government steps in and covers the vacuum.
But then it does it for a certain amount of time, and then it reduces and removes itself. So it's not there as a permanent player. It's worked very, very successfully in a lot of other countries. And so what we're saying is look to what happens everywhere else. Even in the UK, I mean, there was a flight of capital post-Brexit.
So how do you respond? I'd like to give all the witnesses a chance to respond to this. We're looking at the UK example. 2021, they went out to consultation, 2 years of consultation, implement changes very similar to what you're recommending, and within 2 months reversed it. Almost unheard of for a government to act that quickly to reverse something. Doesn't that raise a red flag for us?
I think it depends on the reasons. I haven't looked at the consultation papers, but I do know that there was a flight of capital, and we've got an operation in the UK, and we've had a lot of talk about the impact of Brexit.
Okay. Mr Webb?
Okay, so I think probably...
In terms of the UK?
Well, I can't speak specifically to the UK, but I think it's important to clarify what our position is in relation to this. So we have maintained in our submission that wherever possible, it would be good to see retail protections extended to as many people as possible, just to make sure that everyone's able to benefit from the same things. At the same time, though, we do understand that there are certain products for what this kind of thing is not necessarily going to work. I'll give you an example. So for most managed investment schemes that are provided by the larger providers, they usually come in 2 forms. They come in a retail form or they come in a wholesale form. And the general accepted view of those particular products might be that where they're very close matches to each other, ignoring the fact that there's differing compliance requirements for each, the idea is that if you can invest more money into the same product in the wholesale product, you're going to get lower fees than what you get in the retail product. That is pretty much almost, with the exception of the fees, and the protections, almost a like-for-like comparison. On the other hand, you do get things like, for example, the corporate debt market. The corporate debt market doesn't really have a equivalent in the retail sector. It doesn't really have those It doesn't have those protections in place, and there's some very good reasons why you can't have those protections in place. Essentially, what happens when an issuer goes to market with a corporate debt issue, they print out a sheet showing what the issue is, how much is being called for, what the rate is, what the credit rating is, etc. on a Friday. They want the money in on a Monday. You cannot issue PDSs, you cannot issue target market determinations, can't go through DDO, can't do anything like that for that particular thing. So I think if applying sort of a blanket kind of no, we can't do that because it's too hard, ignores the reality that there are varying different products in the market that are different to this. We've got ASIC who are saying, for example, that things like CFDs and binary options shouldn't be available to retail investors at all.
So I go back to the UK. Doesn't that give us pause for thought? Does it give you pause for thought as to why they reversed their position within a matter of months?
As I said earlier, I haven't given it enough thought.
Okay. Can you take that on notice? Could everyone take that on notice? And some of the other submissions refer to it, and you can actually track through the consultation process. There was then an open letter which was tabled yesterday to the Chancellor from hundreds and hundreds of investors who said there'd been a cataclysmic impact in terms of the venture capital startup space and beseeching a reversal, and this is well after Brexit, and you can track it over the months, the particular months of introducing the new levels, and the Chancellor then reversed it in the 2024 spring budget. So if you could take that on notice, I'd be interested into your thoughts, and even if you could reach out to the accounting, your comparable organisations, if that's possible in the UK, to get their perspective, because on the face of it, you can understand how we see that. I'd been watching the consultation and reading the consultation papers, which I should say, in my view, were more open even to the sort of investment opportunities and the need to protect angel investors and et cetera, to maintain that ecosystem than what our Treasury's was in relation to managed investment schemes. But it's just quite extraordinary. They reversed the changes within a matter of months. So very interested in terms of your views in that regard. But we're running... Sorry, Mr. Neglon.
I'm not an expert in the UK scenario, but I can well understand. So if you just think about it, but think about it from an Australian perspective only, that if you had an increase in... what you have is and I don't want to be misunderstood here, you have the dead weight of retail investor requirements under the Corporations Act from a regulatory perspective. It's, as I said, it's very, very costly to provide product
very
under
onerous.
that. Very onerous. And, the number of compliance people you have, legal, et cetera, publications, et cetera. It's very, very onerous. Whereas the flip side of that is the wholesale market, where a lot of those compliance requirements are washed away. So we have a disconnect here where we have a market that's saying, okay, we're hungry for capital, so on and so forth, but that product can't be provided under this heavy compliance regime, badly written law, too onerous, whatever it is. I actually think we're actually looking at this in the wrong way. The ALRC was, we strongly believe the ALRC was onto something by saying the Corps Act is costing this nation a fortune. Can you please do something about simplifying it? Please, 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 please. And we strongly endorse that because we can't go on. The system, you can't keep on chucking things at it. It's unworkable now. It's almost full. You're up to pussy's boat in terms of the Corps Act and your ability for funds and super funds and so on and so forth to actually comply with all of this sort of stuff. It's almost... I seriously do not know how some of the funds actually make sure they can tick every box.
And in the meantime, this will be my last question, in the meantime you've got those who are at the edges, those who just breach the law, they're out there. AFCA's given examples of people who procure certificates accounting certificates on a fraudulent basis or present certificates which miscategorise people who are currently should be categorised as retail, as wholesale. It probably doesn't matter. If you change the thresholds, the crooks are going to be crooks. How do you, and taking the point you've made, adding extra chapters to the corporations law doesn't seem to be the answer. What's the answer to that? Do we need to recalibrate how we enforce or protect investors from, strictly speaking, the people who are at the margins who are prepared to break the law and just do so willfully to make a quick buck? Are we actually focused on the right things?
Well, I can't answer that question specifically, but you're right. You know, to concur with what you're saying, I think, you know, we'll always have crooks, won't we? And there will always be people wanting to reach into other people's pockets to take their money out nefariously.
Can I just add, this is Vicky speaking, it's also a case of, you would think logically that the lower the threshold, the easier it is to get people closer to that threshold and to include them as wholesale investors. So that's one thing. But I think there's been a lot of discussion around sort of risk and risk appetite, but I think it's also a case of protection. And as this committee knows, we've talked a lot about consumer protection and public interest and public good and best interests and all of that. So I think more of that discussion needs to be injected into this whole debate. Sure. Because it's not just about the risk and how much risk you bear, and you know, everyone's got a different risk profile, but it's also a case of what protections can the regulatory system attach to those different types of those different levels of risk. And I think that, you know, to Tony's point, in this country we seem to never quite, I think in my humble opinion, get that balance quite right. So either we go too far or we go too little. And you listen to some of the evidence from the people in the tech sector, and it's like, oh wow, wouldn't it be great if everyone had access to those wonderful opportunities? So, you know, I'm not saying...
To lose a lot of money in a hurry.
But you would lose a lot of money.
Or to make a lot of money in a hurry.
Exactly, because I don't think people talk enough about the ones that don't become the next Canva or the next Atlassian. And the reality is that 90% don't. So you do need to then attach some level of protection to the different different risk levels, I should say. So I think that also should be part of this discussion, and where thresholds fit in all of that and definitions of thresholds is part of that debate.
Yeah, so sure. Senator, it's Richard speaking. I agree with what Vicky has just said, and I think I'd just add to that I feel that that some of the groups who've been appearing as witnesses today have, I suppose, talked at length about what they feel that the retail protections are there to support. I think there are a whole bunch of things. It isn't just fraud. It is, to a large extent, what Vicky said. It's differing determinations of what investor risk is, and that can differ on a vastly different basis depending on what kind of investor you are. And, you know, in a lot of cases, it really doesn't matter whether or not you've got a large amount of money to invest or not. You still just might have a complete misunderstanding about how the product is going to behave. So, for example, I think, you know, we sort of expect that most people, when they come out of school, are going to have a degree of financial literacy which tells them what a bank account's going to do. On the other hand, a laugh there from my colleague, Mr. Negline. On the other hand, someone who comes out of school with basic financial literacy is probably going to need to have also studied economics at school in order to work out what a fixed interest portfolio is going to do in the event of an interest rate adjustment.
But Mr. Webb, my last question, just teasing out that point, would you agree with the proposition that we can't just look at this in isolation within Australia's borders, that there's a competition for capital all over the world, and we have to be mindful of the settings which some of our major competitors have, who are competing for that set of capital, who are competing for those potential canvas, and they might not be. They might fall in the other large percentage that fail, but there's a competition going on for capital to be spent in particular jurisdictions, and if we get our settings out of whack with our international competitors, that could have a very negative impact on the Australian economy. Do you agree with that?
I agree totally. And I'd also suggest that we make sure we look at this holistically and ensure that domestic consumer protections are also part of this discussion.
But there's a tension there, isn't there?
I don't see why these can't be resolved to the satisfaction of everyone.
Well, yeah.
With a bit of goodwill and ingenuity, anything's possible.
But there's, I understand the aspiration. I share the aspiration, but you sort of get hit with the reality stick that if the thresholds are different in other jurisdictions, people would just go to the other jurisdictions. Mr. Neglite?
Yeah, you're right. There is a competition for capital, but I go. Sorry, I want to sound like a broken record, but I go back to the thing is that Chapter 7. I think as I said, the ALRC we think got it right, saying this thing has to be fixed because it's costing the economy way too much money. We'll all be better off. It'll be much more efficient for us to run our financial services system if we can make this law a lot better, and therefore if we can reduce those costs, just maybe I'm not saying that you can square the circle here. Just maybe the people who are in the wholesale market, if we did increase the thresholds, maybe they could operate in the retail environment because we've made it much more efficient and easier for them to actually go, okay, I can actually work this law out. I can actually use this law. Sure. They still have, at the moment, they still have considerable obligations. Mr. Newman ran through some of those.
Absolutely. And I notice in the document you've tabled, there's a list of those obligations as well for wholesale investors.
No. They're all the things they're out.
Oh, okay.
They're the exclusions.
They're the pages and pages of stuff that wholesale licensees don't have to do.
Okay.
That's, sorry if that was a bit...
So it's exclusions on the first 3 pages and then provisions on the last page?
No.
Last two.
So the last...
Yeah.
The page entitled Wholesale Investor Corp's Reg Provisions.
So that's basically all the things in the regs where the wholesale people are out.
Okay, gotcha.
Yeah.
Okay.
So the whole document is they're out. They don't have to do any of that stuff.
That's helpful for me because I was reading it completely incorrectly.
Yeah. I apologise, Senator, wasn't clear enough.
Yeah, that's good. That's helpful.
I'm happy to fix that up and send you another copy.
Thank you. That's fine. I think we're clear now.
Yeah.
Can I ask 2 questions because we're going to move on to our next witnesses in a moment. There may be more quans because we've only been able to crack open a small amount of where you sit in this ecosystem, and clearly, as in other parts, like with audit, which has been such a preoccupation of this committee, there's a fundamental centrality of the profession of accountants in the whole movement of money around the markets in this country. Like, literally, fundamental isn't a big enough word to hold the centrality of the place that accountants have, right? So you are key to what's going on. The quacks seem to me to be a tool that are described in one way but operating in a rather different way, very disputed in terms of their brightness or their dullness as a tool to allow somebody to actually qualify as a wholesale investor. Now, AFCA have given us an example. Case study 4, systemic issue, failure to adequately assess client's suitability to be classed as a wholesale client. And this seems to be right at the heart of this terrible nut we're trying to crack. AFCA's systemic issues team was referred multiple complaints that raised multiple issues about financial firms' conduct. One of these issues was that the financial firm was not adequately assessing their clients' suitability to be classed as wholesale clients. From the referred complaints, there were several examples of this conduct. In one case, a retail client was not aware that the financial firm had obtained a wholesale client certificate for the purpose of offering the client a wholesale product. Is a wholesale client certificate the same thing as a quack, or is that a different product?
This is Vicky. I could venture to say that if it hasn't directly come from an accountant that's been engaged by the client, who's gone through all the processes that are required, like engagement letters, etc., I think I wouldn't classify it as a quack as such. It could be some other, without having seen the document, it could be some other, it sounds like it might be some other document that's been produced by the financial services product issue or whatever it is, that client may have a completely different and separate relationship with.
May or may not, because it said had obtained a wholesale client certificate. And I just wonder what on earth a certificate is if it's not a quack. Because it's operating in the way that the quack is designed to operate and being used in this ecosystem.
But Senator, there's a bit that's missing there, in that if an accountant is signing that, you need evidence to be able to say, okay, I can confirm what I'm seeing as income, and I can confirm what I'm seeing as assets. Now the client there is saying, I was not aware that this thing had been obtained. Now, so what we don't know is, did the client hand over all of their statements justifying income and assets to the wholesale provider, and then the wholesale provider then walked that down to we do not know whom? There's bits and pieces there that we just don't understand. But
AFCA will give us some info, and I'm concerned about this is the way that wholesale investment is actually being facilitated, which is not only at the edges of what should be tolerated, but seems to be outside proper practice. The client was not made aware of the certificate, so if they're not aware of the certificate, I doubt that they've gone through the processes that you've been describing to us this afternoon. They'd been classed as a wholesale client and placed into a product that was for wholesale clients only, including our investigation, says AFCA. In our view, the financial firm did not show it was adequately assessing a client's suitability to be a wholesale client. Well, can the financial firm adequately assess a client's suitability unless they declare them, the only way is to declare them a sophisticated investor, which they can do without the quack. So they can create their own certification process. Is that happening? Are you aware of that? Have you seen that? Does that explain what's happening here?
Just based on some of the stories and information our members have given us, my conclusion is that all sorts of things are happening. I can only go by what AFCA obviously are the body that deals with the complaints.
That they've indicated, and it's a systemic issue. They describe it not as a singular issue, a systemic issue.
I can only go by, if that's what AFCA's saying, then definitely. I've only got anecdotal evidence that we get from our members. I know that the accountant certificates and dealing with them has been an ongoing issue for our members for a very, very long time. We get a lot of queries about them, but that's my anecdotal evidence.
And how many of your members have been sanctioned for inaccurately or inappropriately providing quacks? Have you had any cases, any investigation?
Not that I can recall. I would have to look into it.
Given the value of a quack and the pressure that you've described, Mr. Webb, I would be very surprised if they have not been misappropriated. And then the question is, well, who reports that to whom and when, and what action is taken by whom? And there's cost involved to reputation, there's a cost involved to the reputation of the sector, there's a cost involved to the people who lose the money, there's the social fallout, the psychological impacts, the mental health, this is not just a little bit of paperwork, it's a big deal. So if you could take on notice anything about sanctions, notifications, actions, public declarations, because this seems to me, from previous inquiries and in this circumstance, that there's a lot that's going on that everybody's going, maybe I should report, but I won't. And in that darkness, disease is spreading. And that's before we get to the SMSF questions that I wanted to ask, because we're getting I'm certainly getting community evidence around exploitation through the rating of SMSFs being facilitated and enabled by accountants in that ecosystem. So I've got concerns about that and where that might be at quite a significant amount for somebody to the end of their career where they have hundreds of thousands of dollars and then they end up becoming a wholesale investor by dint of the level of accessibility, but without the sophistication to actually know what the hell that is going on. So there's another issue. You might want to give me some more information on that. And finally, on notice again, because of the financial abuse inquiry and the awareness raising, I think that's important for the Australian public and for the sectors involved in financial products, which is definitely you. What thoughts have you got to add in this space with regard to wholesale investors about the products that are currently available that enable financial abuse, particularly post-separation between intimate partners?
So I'm happy to talk to that point on behalf of Chartered Accountants now.
Briefly, yes, that'd be, yep.
So we did make a submission to the financial abuse inquiry.
Yep.
It did not discuss this issue of wholesale.
Yep.
What we did target was that we actually wanted to define what was meant by the difference between financial abuse and economic abuse, if any. I think there was a document prepared by Deloitte for Prime Minister and Cabinet.
Yes.
Saying that it was, that the terms are used interchangeably. There are different points of financial abuse. Where we see financial abuse is obviously, intimate partners, subsequent to breakdowns and whatever it is.
Or in family trusts.
Yes, yeah. Right. Typically, women with children may run away because because abuse, but then they have to come back because they can't afford to live elsewhere. But the other area that I want to talk about in particular is elder abuse.
Oh, well, okay, that's a different inquiry. We can't go into that space. What I want you to do
But allied to that is the issue of enduring powers of attorney. So
that's the interconnection with
here.
this.
Correct.
Okay.
So that's the point. There's a very long-winded way.
Yep.
Apologies.
There is a way in there to the wholesale investor.
So that's the point that I wanted to make.
Yep.
That as far as we're concerned, that's the linkage. Yep.
Fantastic. That's really helpful.
That's very helpful.
Thank you. Okay, so because we have had considerable evidence in that committee around elder abuse, and I'm sure that there is a wholesale investor connection.
And Chair Kay Patterson has been absolutely passionate about the issue of enduring powers of attorney.
Yeah,
we've been very active. The three associations and our other professional colleagues have been very active dealing with the Attorneys General Department when they've done their couple of inquiries. So we're very keen to see something done in that space.
Yeah.
But it's not only.
You might want to have a look at the evidence, because I did ask I asked all of the entities that were there at the day, but I did ask the Attorneys General's Department using that, I think, KPMG document. This is the descriptor of some of the behaviours of these people that we're talking about. Do you think that the detriments that you believe could be implemented using the current systems would be sufficient to stop a person of this kind from perpetrating financial abuse? Because there seems to be a gap between people who make the law, the people who live and want to abide within the law, and that law capturing those who have absolute malign intent, and do things like taking people's cash from them and chopping it up in front of them, smashing their phones so they can't get to work. I mean, the kind of niceties we're talking about is, sign that bloody document, or I'm going to, cut your hair off, or maybe more. These are the sorts of interactions that can be part of the coercive practices that could be knowingly or inadvertently sanctioned by members of your profession if they're not aware of it. So if you want to take on notice anything with regard to wholesale investor, the risk there, particularly the elder abuse angle, that would be really helpful.
Well, it is contained in our submission to that inquiry. Yep. The only other thing I would add, without going overboard in relation to this, is that it's not only enduring powers of attorney. I would very much encourage you to look at general powers of attorney, because you can do a great deal of damage. Someone with malign intent can do a great deal of damage with a general power of attorney.
Because they can do it in a very short period of time.
Yeah, and our guess, there seems to be less, for whatever reason, there seems to be less focus on those types of documents. So everyone's focused on EPOAs, and that's fine, but I encourage you to, not forget the other type of attorney document.
Well noted. Thank you very much. Thanks again for being here today, and I call forward our last witnesses.
Sorry, Senator, I just have one question, if I may.
Yes.
Under indulgence. Response to questions on notice?
If possible, by, have you got the materials there, the special magic words?
Sorry, senators, I didn't hear the.
Oh, sorry. Still got the open statement. Crikey. I hope I've still got it. Why don't you give it to me?
For Quans?
Oh, there you go.
1st of November?
It's 1 November.
Great, thank you very much.
Okay, thank you.
Mr Negline, an experienced presenter, thank you.
Thank you, Senator. Well, not quite, but thank you, Senator.
I now welcome representatives from the Australian Securities and Investment Commission and representatives from the Australian Financial Complaints Authority.
4 o'clock on a Friday afternoon. Where else would you want to be? That's not a question. That's rhetorical.
That's not the first question of the afternoon, no. Thank you. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you state your full name and capacity in which you appear today? And we might start down this end.
Thank you. Leah Shaka. I'm Senior Executive Leader of the Financial Advice and Investment Management Team at ASIC.
Thank you.
Kate O'Rourke, Commissioner at ASIC.
Thank you.
Shail Singh, Lead Ombudsman Investment and Advice at AFCA.
Roseanne Rose, Head of Legal at AFCA.
Thank you very much. We're going to have some questions, but I invite you to make an opening statement if you wish to do so.
Does not have an opening statement.
No, Ms O'Rourke.
We do, thank you, Senator. We welcome the opportunity to appear before the Joint Committee today. As you're aware, the Australian Financial Complaints Authority is the Australian Industry Ombudsman Scheme for the financial services sector and a not-for-profit organisation. Our role is to independently resolve disputes that consumers have with financial firms, and in doing so to identify systemic issues that may arise and serious contraventions of the law and to report them to relevant regulators. As the single independent external dispute resolution scheme right across the sector, we have a unique perspective on the issues before the committee. We would like to note, however, that AFCA's jurisdiction is limited to investigating and resolving complaints from retail consumers. This extends to issues with retail consumers have been incorrectly classified as wholesale or sophisticated investors. However, where we see complaints from consumers that have been classified correctly as wholesale investors, we exercise our discretion to exclude those complaints from the AFCA service. Our evidence today is therefore limited to examples where we see wholesale sophisticated tests applied incorrectly by financial firms and the harm that flows from that. Since starting operation in November 2018, AFCA has resolved 450,000 complaints, resulting in over $1.38 billion in payments to consumers. In that time, we received over 22,000 complaints in investments and advice, and of those, 0.6%, so about 140 complaints, relate to wholesale and sophisticated classification issues. AFCA's experience is that current wholesale client and sophisticated investor tests play a fundamental role in the financial services law as they set the threshold where key consumer protections apply. They also operate as a barrier to entry for access to certain high-risk, complex products and wholesale investment markets. Relatively few Australian investors are genuinely wholesale investors, in our opinion, in the sense that they do not have the level of sophistication or the resources to understand the risks inherent with wholesale investments. We consider that the current retail wholesale regulatory settings that are fit for purpose would include simple and easy to apply wholesale tests and clarify that the obligation should rest with the financial firm, not the investor, to determine whether a wholesale designation is appropriate to that individual investor. We welcome the committee's questions and thank you for the opportunity to participate in this discussion.
Thank you very much. Mr Singh, if I can just connect the dots to the last series of questions I asked based on your example number 4, I believe it was, about systemic failure. Can you explain what a certificate, a wholesale client certificate for the purposes of offering the client a wholesale product was in this particular example.
Thank you, Senator. Yes, so that was a quack, just to avoid any doubt. It was a quack. It was a $2.5 million accountant certificate. In this,
what do you refer to it as?
is it a quack? Look, to be honest, that's the first time I've heard the terminology, Senator, so I had to ask my colleague what it meant.
Sorry, I was just making sure the audience heard that. Sorry.
Qualified accountant certificate, let's go with that.
Yeah, but isn't it, if it walks like a duck and it looks like a duck?
That's absolutely right. Interestingly, in this case, and importantly, and I think quite inappropriately really, this was provided by a related entity as well to the financial firm that gave the advice.
Is that financial firm still operating?
It is, Senator. Yes.
Okay. I'm at a point where I think it would be in the public interest for us to get some details about this.
We're happy to provide that on notice, Senator.
And then the committee can consider whether we want to keep that confidential or not, but we need more details.
Yeah, that's not a problem.
So to be clear, the financial firm obtained a wholesale client certificate, which is in fact a quack, which can only be provided by somebody who has a very specific level of certification from either the CPA, the IPA, or Chartered Accountants Australia, New Zealand. Right. Has that individual been named or sanctioned in any way? And was it an individual or was it a team?
It was an individual that was both an accountant and an authorised representative as well of the financial firm. I'm not aware of any sanction, but again, happy to take that on notice, Senator.
Did you report it to any quasi-regulatory authority for the accounting profession?
No, Senator. Under our rules, our recourse is to report systemic issues to ASIC.
Which you did.
Which we did.
You declared that. Okay, well, we'll follow up there in a moment. So you said in addition to this individual being an authorised officer...
authorised representative, correct.
Authorised representative of this company. Was it a company or was it a partnership?
It's a financial firm.
Financial firm?
Yes.
Okay. With an AFSL?
With an AFSL, correct.
Okay. It involved a related entity. Can you expand on that for me?
Yes. So the accountant, who actually was the chartered accountant, was the sole director of a company that was a corporate authorised representative of the financial firm.
Okay, give me that one more time so I understand.
Yeah, sorry, I'll slow that down.
Yep.
So the certificate was provided by a chartered accountant.
Yep.
Who was the sole director of a company that was a corporate authorised representative of the financial firm giving the advice.
So that's replete with conflict of interest?
Correct.
In fact, it's a sole trader set up to actually exploit that conflict of interest to have flows through to the other financial firm.
We certainly were of the view that it was a problematic business model that required reporting.
Okay. So one of the things that's been put to us by representatives of the wholesale sector is that the quack is a bright line, solid, determinant of person's eligibility and under the current regulatory standards and the current limits, the 250 and the 2.5 mil. And they don't want that to disappear at all. You've heard the evidence from the representatives of the accountants, and they just say, no, this is, we don't want to prop up the business model of the wholesale investors, take on all of the risk, and you can see the risk manifest itself in this kind of corrupt behaviour, completely unprofessional and absolutely unethical.
Yes.
How widespread do you believe this is in the sector, given that you've said that there's only 0.6% of the complaints that you've managed over the period of time since 2018 that relate to wholesale and sophisticated classification issues?
It's very hard for me to answer that question because we don't get the entire picture of the ecosystem, and that is
You only get the ones that get to you.
we get the ones that get to us, and the reality is if you provide purely wholesale services, you are not required to be a member of AFCA. So whether it's widespread out there or not,
Okay.
we can't comment beyond the members who operate in this space that are members of AFCA.
So it was good fortune that there was a retail element of this financial firm that meant that you captured them in this circumstance.
Correct. That's what I would agree with that.
Okay, so the literal needle in the haystack moment occurred, and this is a reveal of a particular form of business practice for this one firm.
Correct.
Have you had any other firms do reveal this? Because you call it a systemic issue.
So I think it might just be worth me clarifying what we mean by systemic issue. Under the rules, a systemic issue is when we see conduct that we think might apply to a number of consumers by that particular financial firm.
Right.
So it's systemic to that firm.
It's systemic to that firm, correct, Senator?
Not to the sector.
Not to the sector.
And do you have any other firms that this behaviour was represented into you? Another, retail, wholesale service provider?
Not exactly this business model that I'm aware of. But,
Okay.
We obviously are aware of other sort of conflicted business models that we deal with. But in terms of this conduct, no, my understanding is it relates to this particular financial firm.
Okay. So let's continue on the narrative journey from your entity to the referral to ASIC. So you get this information. What happened when it arrived at ASIC, Ms O'Rourke?
Thank you. Kate O'Rourke from ASIC. So we are just trying to investigate that particular example and hope to be able to share with the committee particular information in relation to that referral. So we do get a number of referrals from AFCA. I don't have immediately yet what happened to that particular one. I'll let you know, Chair, as soon as we've got that information.
Great. And do you have, in your records at ASIC, any other matters of this kind that the committee should be aware of? Are you aware of any systemic concerns in a general term use of systemic, not the specific one that Mr Singh has just?
Okay, so...
Is this a problem, more broadly?
And can I just clarify that you're referring to the misuse of the accountant certificates, particularly, rather than the wider question of the wholesale retail?
Yes, just in this instance first, the quacks, yeah.
The quack, and not specific either to that question of a representative model or sole directorship, a more general question about misuse of accountant certificates.
Yes.
We didn't have anything particular, or we don't have evidence specifically about the breadth of that concern around misuse of accountant certificates. We have heard anecdotally that they can be misused, but I don't have any data or particular case studies to share with you. You'll have seen in our submission that we do think there's value in there being a penalty associated with the misuse of the accountant certificates model, because we think the fact that there isn't one may be exacerbating the misuse of them.
Sorry, if I can
Yes.
just add,
Shaka.
Senator Shaka. In terms of the particular model that Mr Singh outlined, I think that's correct. We have in our submission at paragraph 95 indicated that we've seen slightly different examples, so other mechanisms where the certificates have been misused. In the fundraising context, where trust or company structures have been used to enable inappropriate certification. So we do provide a couple of examples at paragraph 121 in our submission.
Yeah.
So slightly different.
So do you want to
approaches.
just take us through those ones, and then I'm going to come to you, Senator Scarr.
Cool.
Certainly. So we've outlined three examples in the market space where we saw, and so these were retail clients invested in complex derivatives, and they had been incorrectly classified as wholesale clients.
By what mechanism?
So in that particular case, I believe it was trust structures. I may need to come back to you on that one. In the next one, Quickie International, it was a number of accountants who had acted as trustees for trusts set up for the apparent sole purpose of enabling their clients to be classified as wholesale investors. So that was that trust example that I mentioned. In the next example, which is Guevara Group, clients invested in Guevara through a private company and in some cases were classified as wholesale investors through the use of trust and company structures to avoid treatment as retail clients. And in a final case, and this was a criminal matter, the conduct included using 3 forged wholesale client certificates.
Okay. Clearly, these are matters of concern when you think that these are the ones that have been picked up. You just have to wonder how much of this is going on undetected. So who's the cop on the beat watching for all this potential misuse of quacks and trust structures? Are you the enforcement agency?
So I think that we would say that to the extent that there's a regulatory provision in the Corporations Act that allows for people to use or not use particular structures, then it's ASIC who's responsible for the oversight of that use of that tool.
And how thoroughly do you think that potential misuse is being policed? And what conversations have you had with your sort of co-regulators, if I can frame them that way, which is CANS, IPA and CPA?
So I can, in relation, I can't speak more broadly, but perhaps in relation to the Guevara matter, we did write to a range of accountants and accounting professional associations, both in relation to that matter and the Quickie matter, warning against the practice of accountants using those sorts of structures that I mentioned as a way to access the wholesale. So there has been some engagement, but I think certainly specific to those matters, I couldn't comment as to whether there's been a broader engagement.
Just on that, Ms. Shaka, you're right to advise the accounting bodies, and we might ask some questions of the accounting bodies in this regard, but that it's inappropriate, etc., etc. So my concern is that the professionals who engage in that conduct simply say, oh, well, that loophole's closed, we'll move on to the next one, as opposed to...
Because they're not going to lose their capacity to continue, are they? Like, have they been sanctioned? Have they been dismissed from the profession? Are they noted anywhere publicly to be people to be avoided?
I don't know, Senator, in relation to those matters in terms of whether there was any further action taken by those associations.
Was there any further engagement that you're aware of from the accounting bodies? Did ASIC follow up and say, what have you done in relation to person A, person B, person C, person D? If you have done nothing, why not? Has there been that sort of level of engagement?
We'll ask our colleagues in that team, and if we get the information in this hour, we'll pass it through or pass it through on notice. So I think it does raise that wider question of both the immediate and I understand your question to be that for those particular individuals, what next? But I think that wider question of for the rest, to that wider engagement point from the industry bodies or indeed ASIC speaking in speeches or otherwise, how to ensure deterrent impact from a specific case and for people to change their behaviours with the benefit of seeing outcomes. I think that's that wider point that you're making.
I mean, people lose their driving licence if they break the rules. How bad do you have to be before you use your licence to practice as an accountant? I mean, if you've got the highest level a very high level of certification that allows you to sign off on a certificate, which we're calling a quack, that allows you to be a wholesale investor, and somebody can do that and get away with it, it's like going through a red light, causing chaos, and continuing to be able to just keep going.
That was the like I referred to earlier. We thought as part of the submission that ASIC has made that it's worth the committee considering there being consequences. So that misuse of the accounting certificate provision at the moment not having any penalty associated with it is an issue that is part of the consideration that the committee might like to take into account.
Okay, thank you.
And can I add something on this?
Mr. Singh.
We do take the view that the advisor also needs, it's not merely enough that they just look at the certificate and say, well, the $2.5 million mark's been hit. They still need to check that this particular consumer understands the consequences of being classified wholesale. They have ethical duties to do so as well. So
and that point was made by Mr. Newman, that as an AFSL holder, you're not home scot-free without any restrictions. There are, requirements on you.
Absolutely.
But if you breach those, who catches you and what's the consequence?
Yeah, well, in terms of the advisors, obviously we have those disputes can come to us and the financial firm. So we have had cases where we would look at the advisor's conduct in that regard.
And that's only where you've got access to them through the retail wholesale
Exactly.
jointly thing. What happens in the wholesale space? Is that just cowboy land and you can do whatever you like?
In relation to financial advice, there's been a lot of submissions about all of the different protections that apply if you are in the retail sector, like if you're classified as retail.
Yes, they'd be described as burdens and limitations on the market, right?
I did hear that characterisation, and I think I had understood from other submissions and indeed in ours the description of the benefit to consumers that flow from those protections, I think has been set out as well, not to deny that they do impose a regulatory burden. But there are some but very modest restrictions that apply or provisions in terms of the wholesale market that mean that for particular individual consumers there is much less level of protection.
Senator Scarr might help me out here. There was, I believe, evidence yesterday about $1 billion of...
Oh, that's right. So we heard evidence from Mr Morris of Ord Minnett that one of the big banks, I think, had simply transferred across $1 billion worth of business, if you like, with respect to retail clients to Ord Minnett.
Because they just didn't want to do the
simply
work
because
anymore.
they don't want to do it.
Oh, okay. That's interesting.
Well, that is a reflection of how the market is perceiving the way of doing business. The lowest cost option is wholesale, and that's clearly creating an incentive for the sorts of behaviours that have been documented by Mr Singh, the sorts of behaviours that you've mentioned in your submission as well. So much more to ask. I'll go to you, Senator Scarr.
Thank you. I'll go to AFCA first, and I've just got one question. Thank you very much for your submission. Thank you very much for the case studies. Always find the case studies AFCA provides in submissions extraordinarily helpful, and also in your annual report, etc. I think it's very useful if I can give that feedback if anyone's listening. I know you are, but in the ether. I want to quote from your opening statement, quote, "We would like to note, however, that AFCA's jurisdiction is limited to investigating and resolving complaints from retail consumers. This extends to issues where retail consumers have been incorrectly classified as wholesale or sophisticated investors. However, where we see complaints from consumers that have been classified correctly as wholesale investors, we exercise our discretion to exclude those complaints from the AFCA service," end quote. That seems to me to be suggesting that you don't have statutory jurisdiction with respect to complaints made by wholesale investors correctly classified as wholesale investors, but AFCA is exercising its discretion to look into those matters. Why are you looking into those matters if you don't have statutory jurisdiction?
Thank you, Senator. Look, the way...
Haven't you got enough to do?
Yeah, we certainly do. But look, the way the provisions work is generally you're in jurisdiction unless you're out under one of the rules. And there are mandatory exclusions. The wholesale discretionary provision is not a mandatory exclusion, so it's discretionary.
Okay.
Yeah.
So so sorry to be pedantic.
That's okay.
It's the lawyer
it's sort of
in
a bit technical.
So it's not really correct to say AFCA's jurisdiction is limited to investigating and resolving complaints from retail consumers. You do have the discretion to exercise complaints made by wholesale investors?
We do, and can I just add one addition to that? We had an independent review recently conducted by Treasury.
Right.
And Treasury provided some recommendations, and particularly what they said was we should be excluding complaints from professional and sophisticated investors unless they're misclassified. They didn't talk about wholesale by net worth at all.
So was that recommendation made on the basis of policy grounds or on the basis of what your legislation says? You can take that on notice.
I'll take that on notice.
It's just an interest, because the reason I ask this is some stakeholders have made submissions, and I can't remember which. I might refresh my memory and we might contact you, but a few have made the point that they can't understand why in certain situations matters have been progressed by AFCA with respect to clients who are properly classified as wholesale investors. So there seems to be a bit of misunderstanding in that regard.
Happy to comment on that. My view is what we will do is if we feel that there's a misclassification or an allegation of misclassification, that's generally when we progress. If we think that the financial firm has followed all relevant processes and the person, for example, is truly wholesale and knows of the consequences, our approach would be to exclude those matters under the discretion.
And knows of the consequences, is that a statutory obligation?
Sorry?
Knows of the consequences, is that a statutory obligation upon if they are a wholesale investor?
Yeah, very good. Thank you, Senator. The law doesn't have that requirement in it. AFCA's mandate is to do what's fair in the circumstances, having regard to legal principles.
That could be anything. Sorry, Mr.
Well, and there's 912A, which is honest, efficient and fair, and there are a number of other legal grounds, misleading, deceptive conduct as well.
Sure.
So it's case by case, Senator.
Okay.
Yeah.
I'll leave you alone now. But thank you for the submission. That was helpful.
Thank you.
Ms. O'Rourke, I want to quote to you from. Have you been watching?
We've had summaries of what's been occurring, so no, I have not.
All right, so I'm sure you're.
Please quote away, and
I'm sure you're ready for this one. I quote from Section D, the last dot point of your. This is probably
submission.
yeah.
Oh, no problem.
And it says, we do not consider such increases, and in this context, the increases ASIC has proposed. Net asset test increasing from 2.5 million to 4.61 million, gross income threshold increasing from 250,000 to 461,000, also the product test increasing to somewhere north of 900,000. We do not consider such increases would have a material impact on the fundraising community, end quote. Some of the witnesses we've heard from over the course of this inquiry, in particular angel investors in the venture capital space, the startup space, have strongly pushed back against that argument. And we have heard adjectives used such as catastrophic, disastrous, shut down our business, etc., etc. What research was undertaken by ASIC? What evidence do you actually have to justify that statement that such increases, that you do not consider such increases would have a material impact on the fundraising community?
Thank you. And I have, having understood the guts of some of the submissions that were made in writing ahead of these 2 days, understood that that was indeed a contentious issue, and it's obviously a very important issue for the committee is considering the weighing up of adjustments that might be made. And so to answer your direct question, I don't think there's been any specific recent review or external exercise that we've undertaken to measure the exact impact to draw that conclusion. If your question is, did we do a survey or research, I think the answer is that we did not. That is a judgment that we've made, that the increases that we have described would still allow for a significant group of people and entities to be considered wholesale in our community, and that for there to be other mechanisms.
On what, Ms. O'Rourke? Based on what? Rather, is it the finger in the breeze type observation? Like, this is ASIC making a declaration about a fundamental part of the economy that seems to be baseless.
It's ASIC including in our submission a judgment about the capital markets and about the avenues that people have to access capital and the relative impact of increases in these different thresholds that would say that we think that there remains a significant group of people who would be constituted as wholesale investors, even with the sorts of increases that you summarised back to us, that we've included as an example of increases that we think are warranted. With reference to, I think, the alternative small-scale offering.
You didn't. I just want to. You've given a long answer. I just want to tease out some of the earlier parts of your answer. Just at the end, you said the example we gave. It's stronger than that with respect. You actually say we recommend increasing the financial thresholds to account for inflation since their introduction into the Corporations Act.
Yes.
That's not an example. That's a pretty firm recommendation, and then you crunch the numbers applying inflation and you come up with the figures I outlined. You accept the proposition. You've made a pretty strong recommendation there.
So we've participated in a consultation process and made a submission, and I think it's worth clarifying that because I've heard in a number of the earlier submissions, and indeed I understand from the summary, so I haven't heard all of them directly, but there has been ASIC's got this proposal, this is an ASIC recommendation or position, and you're putting it to me like that as well.
That's what it says.
This is a.
That's what it says.
But the context in which we're providing it is information that this committee has set up to consider something, and we're a participant in that, and that is our recommendation for you to consider.
But based on what? That question remains.
Thank you.
An impression or research? Because I can't hear that there was any interaction with the sector. None of them appear to have been consulted. There is no research document.
That's right. So we're participating in a consultation process as a participant, and we have included our view, our judgment
based on.
I'm coming to describe the basis on which we've included it. But we don't, in a consultation process, sometimes people consult each other on their respective submissions, but I don't think there's an expectation that each person who makes a submission to a body has done consultation on theirs. They're part of a wider consultation process where the issues can be tested.
But I'd put it to you that the weight of a submission from ASIC is very, very significant, and that when we read it, that we as a reader, and I'm into reader response theory, I'm going to make out of this, with the ASIC imprimatur on it, that this is carefully considered with all the resources that ASIC has as a public regulator to have an informed, evidence-based proposition that is something more than let's just apply CPI because it's quick and convenient. Because that's kind of the impression I've got. I'm not going to put words in Senator Scarr's mouth, but that's how I'm feeling.
It's useful to understand that a suggestion that something be adjusted a particular way seems a simple way to do it, and I have to say it was in part informed by, as the prior witness said, a recognition of the complexity of the chapters, both 6D and 7, and that if there is going to be some sort of change to those thresholds, doing it in a way that is as simple to understand and apply and consistent across the chapters has some value. I understand if the committee ends up choosing to make adjustments in a different way, a more complex way, that is available to you, but to suggest something be indexed in relation to inflation is not suggested because of a lack of work associated with it. It's that a test that's a proxy for the level of financial sophistication for a person to participate in the retail or the wholesale market that has not been adjusted for 20 years. One way of suitably increasing it when it is a proxy for whether someone can afford to get their own financial advice on a particular proposition. Others too have suggested inflation as an option. Other jurisdictions have also used it. So it's not a outlandish or
But this
considered
is just one
proposition.
among many. Now you're happy to put ASIC's proposition as one among many with no particular elevation because it's ASIC. So that's kind of an interesting proposition for me. But back to you, Senator Scarr.
I'm not resiling from ASIC's voice being important.
Ms O'Rourke, I don't want you to resile. Yeah. I simply suggest, and this committee is also the oversight committee for ASIC, as you're aware, I simply suggest there might be some reflection on the communication, the fact that you've got the chair and another member of the committee both indicating to you when we read that, we of course put great store on what ASIC recommends. I know it's in the context of a consultation. I've got limited time, but I simply suggest ASIC just reflect on that point. I would have found it helpful. I would have found it helpful had ASIC indicated to us in a proactive way whether or not it had taken steps to get the feedback from different sectors, whether or not they'd considered meetings with the angel investors you might have over time. All of that would have been helpful in terms of the context.
And that's a gap in our submission. I think, though, that we had intended to convey the basis on which we had reached that conclusion as three bases. One is that there would remain a significant group of Australian citizens who would be wholesale investors. The second is that there are other means by which there can be small-scale fundraising, and I understand they haven't been indexed either, so that the 2012 remains small and the crowdsourced funding work stream is nascent.
We had this morning.
So, and the third is that there is the capacity to raise through retail once someone is retail. And look, we can discuss again the regulatory burden and the benefits and the costs, but they are the three bases.
So I'm just going to cede to you the whole of the time till 5. Just want you to know that.
You.
But if you can answer Senator Scarr's questions succinctly, that will prevent a lot of qualms. So I'll leave you with that. We won't be able to explain everything.
Sorry, may I finish just that sentence?
Sure.
So there were three bases on which we made that statement. It was not baseless.
I've got them.
Senator Scarr.
But the corollary of there being a significant number is, and again, this is a question of perhaps being considering if there could be a more fulsome approach, is to say, well, there would also be a significant number of people who were denied the opportunity of investing in opportunities which they currently have the opportunity to invest in. That's correct, isn't it?
So there will be a cohort of people.
It's significant. It's a significant number.
Yes, that's right, because the change is that we propose, because there has been no change in these thresholds for such a long period of time.
I understand
it is
the reason.
a significant cohort of people who will change.
Yeah.
And will need to
but
avail
instead,
themselves of retail.
The flavour of the submission is, again, I'm just providing feedback, is, you've still got a significant number who can invest, but you're almost missing the next sentence, which says, it should be noted, though, there will be a significant number who can no longer take advantage of those opportunities. Do you understand what I mean?
Yes.
Okay. In terms of the, and it was helpful that you provided the options in terms of fundraising in relation to the existing avenues available in the Corporations Act for those seeking to raise capital for limited offerings to clients with reduced compliance obligations. So that was very useful. We put that to the stakeholders. I made a list here of the problems that the stakeholders raised with respect to those options. Okay. In terms of crowdsourced funding, in effect, there's been a low amount raised through crowdsourced funding. Numbers we were given were, and I haven't verified this, but 64.5 million out of 3.5 billion of money raised. The cost, 80 to 150,000. Because it's public, you're not allowed to give forecasts, etc. Investors want to see forecasts, legalese. Venture capital funds won't invest in companies that have gone through crowdsourced funding because they've got a cluttered share register. I'm trying to read my writing here. The connection between, say, an angel investor With a startup, you don't have that if you're using crowdsourced funding. So one of the benefits of angel investing is the angel investor doesn't just invest funds, there can be a connection where advice, etc. is given, self-pricing under crowdsourced funding, and confidentiality of information, which can be very sensitive in a startup context. Do you recognise that they're all potential limitations of crowdsourced funding?
I think I have heard some of those. I mean, I think that there's advantages to crowdsourced funding as well, and happy to provide additional information to the committee if that would be helpful.
Sure.
I think the interesting one for me in there is that reference to a cluttered register in circumstances where I understand some of the concerns being expressed are that there'll be fewer people who are available to be participate in holders. So that volume of investors is something that some of the submissions have been seeking to preserve. So I think that's an interesting one to test. If you do want volume in numbers of people, then you are going to have a more cluttered register as the consequence. So if you've got people who can still, what we would say are new thresholds that remain, like I said, a very healthy number of people will still exceed those thresholds and can be angel investors or otherwise. I absolutely accept that the submissions you've received from the angel investor community are not that they have said that this will be, and I won't repeat the words that you said. So I'm not contesting that that's the submissions that you've heard from them.
Okay. And then in relation to what do you refer to it as the 2012 rule?
2012, but
the 2012 rule, is that how you refer to it, Ms. Shacker?
Yes, that works.
The 2012 rule, and the point you raised, Ms. O'Rourke, the $2 million hasn't been updated since the time the thresholds were introduced, so why would you update one and not the other? The size of investments was also raised, that if a company, say, looking at raising $2 million, but they can only have 20 retail investors, then the size of each tranche of investment might put it out of the range of, say, an angel investor who would rather have 20 investments of 10,000 rather than 4 investments of 50. Cash flow requirements of the business, can you hang on until the 12 months ticks over?
Especially for medtech,
and also the issue with respect to staff options, employee share plans and how they interact with the 2012 rule. I'm not looking for an answer to all that, but I'm just saying these are some of the limitations. These are the limitations. So clearly, do you accept that there are limitations,
associated
real
with
and
those.
material limitations in that respect?
Yes, and that's why,
I note the submission does refer to the experience in the UK.
Yes.
So you do specifically and helpfully refer to the experience in the UK. You have given us testimony, and I made a note trying to capture what you've said about there still being a healthy number of people who'll be able to meet the sophisticated investor test or high net worth test, whatever you want to call it, if the thresholds were lifted. So take that as accurate, right? There'll still be a significant number. Doesn't it give pause for reflection, though, that the UK went through a process of 2 years of consultation in relation to this matter, 2 or 3 years, changed the thresholds, still beneath what you're proposing our threshold should be, I think, though there's the issue with the principal place of residence being excluded, I note that, and pension funds. And then the impacts were so devastating on the startup sector in particular, that part of the investment market, that they had to reverse that decision within only 3 months in the 2024 budget. Shouldn't that be an absolute red flag that we need to tread very, very carefully in this space?
I think and I think you described it earlier in the session before, as very unusual for such a significant decision in such a short period of time to be changed. And so I do think that it is very much something to take careful note of. And we have, I thank you for referring to it as helpfully described in the reproduced from the explanatory memorandum, some of the particular concerns that led to that change in discussion. As far as I'm aware, we haven't had a direct conversation with the FCA in order to understand whether there's additional information that would be relevant to that decision that we've made. But to your
question. Sorry, just to that point. Have you had an opportunity to see the open letter that was written to the Chancellor that was signed by, I think it was 2,900 investors?
I have not.
Okay, we can provide that to you.
We can get reference to it. So I think that and I think your reference earlier to, they had a couple of years of consultation. I think this issue in Australia, I think we tried to count how many forums and consultation processes have been really grappling with it, and I think we set out in our submission, it is something that has been considered in lots of different circumstances, including in this one, because of these quite difficult balances that are being drawn here. Yep. We think that the value of increasing the thresholds remains compelling. We think that the balance from having them sat for such a long period of time at the level that they were set then has meant that the cohort, that balance between the people who are participating in wholesale and retail has got out of balance, and that the committee should seriously consider revisions to them. But we, of course, recognise that that is very significant, what happened in the UK, and needs to be considered.
So why isn't that compelling, what happened in the UK, but the fact the thresholds have been there for 20 years is compelling?
Well, we would...
Aren't they both compelling? do you know what I mean? It's a question of weight.
It is a question of weight, but I think it's also worth pausing on what their levels are as reversed, so not as they went to, but as they returned to, and comparing them to where ours are now. Because as you acknowledged earlier, the value of the house is out and the value of the pension fund is out. So I know there has been some questioning about whether all other jurisdictions have higher thresholds than we do. But I think in circumstances where you take out the value of the home and you take out the value of the pension, the remaining thresholds in the UK it's hard because of the Australian property market, but would largely be sitting high. You would be more. It would be sitting higher.
Have you done any modelling to clearly articulate the point that you're making there? Because there's a lot of assumptions embedded in all of this. AI is sophisticated enough to put multiple models in and come out with a comparator adjusting for different things. Has any of that kind of work been undertaken by ASIC to provide us?
We have not done modelling on the impact of the family home, for example, which I think is where I just identified.
Depending on where you live, East Coast, West Coast, regional.
We have not done economic modelling on that.
Okay.
So I could put it to you, Ms O'Rourke, okay, we'll exclude the family home, we'll exclude superannuation assets, and the net asset test should be 500,000 Australian dollars. That would give you parity with the UK. Would you recommend that?
So I think that the committee should actively consider different ways that there could be an increase in the thresholds. And as we've alluded to, we have suggested indexation as the way that when we're balancing simplicity of change and impact of change as our recommendation. I do want to acknowledge, and I think the submission does, that there may be other ways in which thresholds could be increased. And your one that you've just put to me is one we're happy to consider further. I don't have an off-the-cuff position because we haven't in our submission suggested the removal of the home. And if you'd like ASIC to consider that particular approach, we'd be happy to do so.
Sure, if you take that on notice, because, I mean, if I'm looking for parity, say, between the UK and us, you would say, OK, we'll exclude the family home and exclude someone's super, and the figure on currency exchange is 250,000 British pounds, or say $500,000 Australian dollars, right? Which is substantially different from 4.6 million net assets with the family home, right? It is substantially different, I think.
I think it goes to the point that the impact would be dependent on which city or regional area you were to live in.
Correct.
And therefore is a difficult question to make a complete response to your question.
Sure. But we've been talking about the net asset test. We haven't talked about the gross income test.
Yeah.
So the gross income test in the UK is now reverted to what it was, which was Australian 189,000. You're proposing the current gross income test in Australia is 250,000 Australian, which is some 30% more, right? And you're proposing to uplift that to 461,000.
So an easier acknowledgement that is a lower amount. You know, it's harder on the asset one, but on the income one.
Well, it's substantially lower, isn't it?
Yes.
And the justification about the percentage of people who fall within that cohort isn't the same as the justification on the net assets test. Isn't that correct?
It's not the same?
It's not the same. So a number of the stakeholders who've made submissions have said if you want to compare the percentage of Australians who fell within the 2.5 million net asset test in 2020 or 2000 or whenever it was, compared to today, that's increased to whatever the figure is in the teens.
That's the more substantial increase.
Well, it's far more substantial, isn't it? It's far more substantial because only 1% of Australians or 1.5% are earning more than 250,000 a year. Isn't that the case? It's an order of magnitude greater.
And can I understand the question that you're putting to me is that because the difference between the income between the UK and the Australian one is it's substantially lower, that's offset by the fact that that's not where the bulk of people become wholesale. I just want to make sure I understand.
No, so my point is one of the justifications for changing the thresholds that a number of stakeholders have made is the percentage of Australians who now fall within the categorisation of sophisticated investor has increased since those thresholds were first introduced, right? But the reason for that, the proportion of Australians who now fall within the sophisticated investor test is greater under the net asset test limb than it is under the gross income test limb.
Right. So that is what I had understood you'd asked.
Correct.
And I don't have data to verify that. But if that is so, then I think that the differentiation between the UK and the Australian model that you were drawing to my attention earlier is less pronounced, because the focus is on the net asset one, which I think we agreed was complex to apply in comparison when you take out the home and super, whereas your point around income, the income test is lower in the UK. If that's not the driver of these cohorts moving, then I don't know if it makes that inquiry about the assets the more important part of the question, if you're doing that comparison.
Well, sorry, I'll give you an example. The Financial Services Council says we should change the net asset test, but based on the percentages of Australians who are earning gross income more than 250,000 a year, that has not shifted materially since these tests were introduced. Therefore, we should just leave it where it is.
Understand.
Why hasn't ASIC adopted that position?
Okay, thank you. I can go back to the basis for our position, which was, as I said before, around trying to think of a simple way that reflects the increases and indexation being one that applies. Cool. And that was, so I don't want to repeat what I've already said, but I hear you that you've had evidence that that increase will have much more impact depending on which limb is relied on, and that it's the asset test that is going to have the most impact.
Can I put one on notice that behind that assumption that indexation is a good tool to apply is an argument about simplification, right, that is contested by people who've come here and said, in fact, indexation was going to lead to incredible costs and constant change. But behind the whole thing is an assumption that the initial piece of legislation that captured 2% of the population was the perfect model, and that we should continue with the model, and that the changes to technology, education standards, capacity, opportunity for education for new products, that none of that matters, and that perfect model needs to be replicated in this new context. That's the embedded assumption in your indexation model. So do you want to take that on notice and have a think about Is that your view? Is there
It is
not
a
sufficient
trade-off.
change?
It's not that this is something perfect and it must be sustained. It's that there's a trade-off when you're thinking about updating regulation, and there's different ways that you can do it. You can start from scratch, have a whole new system. You can maintain what you've got and update it. And if you're going to update it, what's the trade-off between the different mechanisms that you can do so?
Yeah.
So it's not
Educational uplift or eligibility uplift by indexation. Then that's a choice that you've made in your recommendation to the committee. Is that correct?
That's based on a trade-off, recognising that there are advantages and disadvantages of different things, and of the options that we considered and that we recommended the indexation option.
Thank you.
All right. My last question, I'll need to put on notice, Chair. I need to run to the airport. But
catch a plane with Miss Shaka.
Oh, where are you going?
To Brisbane.
Brisbane.
Oh, so am I.
Yeah.
There you go. We'll continue the discussion. I just want to put on notice the vexed issue of accountant certificates.
Yes.
And I call it a vexed issue because the accountant bodies have just told us they don't want to issue them.
We heard that.
And I know some other jurisdictions have self-certification,
Yes.
but it would seem to me if the recommendation sorry, I don't want to verbal your submission. I won't call it a recommendation, but you make the observation that there could be enhanced obligations for accountant certificates in paragraphs 108 and 109,
and if 9C, which is the summary, and I concede we use the word recommendation, and
Okay.
I will reflect on us using that term in the future.
Yeah, sure.
In light of the feedback that you've given us, but we
Yeah.
have recommended that there are penalties and sanctions be considered for misuse of accountant certificates.
I suspect I don't need to put on a question on notice to the accounting bodies as to whether or not that changes their mind that they don't want to issue them. I suspect they'll say that's just another reason they wouldn't want to issue them. What's the alternative? If the accountants aren't issuing them, should there be self-certification? Because obviously there's an issue in terms of conflict if the issuer is doing it. Could you take that on
Yes.
notice and provide
Yes.
given you've now had the opportunity to hear from the
Thank
accounting
you.
bodies to reflect on their submissions, reflect on the system that occurs overseas and provide some advice.
And we'll reflect on the fact that some of the other tests, the sophisticated test, for example, uses the firm.
Yep.
So there are other certifiers in the system at the moment, but happy to also, and I think we've got a preliminary or a position in relation to concerns about self-certification, but happy to unpack that further and make some further observations.
And just to give you a guide, I don't want to put words into the mouths of our accounting friends, but I see your criminal penalties would be where they were falsely or negligently prepared, which immediately raises the question in my mind as to what you're expecting the accountants to do to verify values. Do they need to go through bank statements, share transactions, go and get a property valuation if the house is included? It just raises a minefield in my mind. So if you could just reflect on all that.
Yeah.
Okay, thank you very much.
Thank you.
Sophisticated investors, S761GA or 70810, you refer to that as tools that would enable some sort of safety and still continue access. Could you reflect on your statements around that in light of evidence received by the committee by other participants? So that'll be a quant that comes to you as well. There'll be more.
Yes,
We've
understand.
run out of time to spend together on this lovely Friday afternoon. Thank you for being here. Can I thank all of the witnesses who've come throughout the day. Thanks all of those who've made submissions. Thank you to Hansard and to Broadcasting. Thank you. To our Secretariat staff for all your hard work in getting us to this journey end. And now I will say that the committee stands adjourned.